All right, just after 9 o'clock on this Friday, April 30th, I'm Miles London. Welcome to Yahoo Finance Live, joined as always by Julie Hyman and Brian Sazi. Let's take a look at futures this morning, and we see futures under a bit of pressure here. All three majors pointing to losses at the open, though we are off our lowest levels of the morning. NASDAQ futures, the laggard here, off about 0.7%. And the parade for big corporate earnings continues, wrapping up the week. Last night, we got results out of Amazon and Twitter. We're going to talk about Amazon's quarter in just a bit. Stock here is up 2%. We'll get into Twitter a little bit later on in the program. That stock under some serious pressure this morning following its latest quarter. And the CEO of Burger King parent company Restaurant Brands, Jose Sil, will join us later on this hour to talk about that company's latest quarter and the state of the fast food trade as we start to reopen the economy here in the U.S. But let's begin with Amazon, out last night with a blockbuster first quarter report, beating expectations on the top and the bottom line. Revenues totaling nearly $110 billion in the quarter. Earnings per share coming in $5 better than expected. Anthony Giaccombo joins us now. He's a managing director over at Loop Capital. Anthony, always great to talk with you. Let's just start with how you're thinking about the momentum Amazon has continued to enjoy from the pandemic, and if you see any signs that is wearing off at all, and how you're thinking about the beneficiary that they've been really from this stay-at-home period.
Amazon undoubtedly has a ton of momentum coming out of the pandemic. I think that one thing that we have heard from investors is they are worried about their ability to comp the comp. You are going to be anniversarying some very difficult year-over-year comparisons. We're not concerned about that. I mean, one thing is that to consider is they now have over 200 million Prime members. That's up a third over the last time that they gave us a number, which is in January of 2020. In addition to that, Prime members are ordering more often, and they're ordering a wider variety of products. And so, we think that they picked up a ton of new customers during the pandemic, and a lot of those customers, the vast majority of those customers, are going to remain Amazon customers. And so, they have a ton of momentum, and obviously it'll slow down a bit because obviously you're going to start to anniversary some really difficult comparisons, but it's not going to slow down as much as some investors fear.
Anthony, it's Julie here. As you look at the different segments, you could maybe see some areas of weakness, but in the really secondary and tertiary segments. I mean, I look at Whole Foods and the really failed promise, one could argue, of that acquisition. Sales there down 16% to just under $4 billion. That said, that number doesn't include online delivery. And at least in my Whole Foods, half the shoppers there are Amazon shoppers who are shopping for people who made delivery online. How are you thinking about that unit at this point?
I'm going to respectfully disagree with you. I think Whole Foods has been a home run for them. I think you actually pointed to the issue, which is that their physical stores number does not include e-commerce sales at all. And you've seen this massive shift, which you alluded to, where more and more people are ordering groceries online. I mean, look, Amazon had to buy Whole Foods because Amazon Fresh was not really gaining any traction for them. Now, Whole Foods is a niche concept, right? Not everyone can afford to spend a whole paycheck on groceries. Not everyone wants natural and organic. And that's why they're now working on this Amazon Fresh chain, which is going to be more just a, sort of conventional supermarket. But I would actually disagree with you. And I think that, once again, talking about the product categories, the sort of dispersion in terms of product categories that people are buying online. Online groceries is a major one, and Amazon is incredibly strong there.
Anthony, there was some bear creep on the street in advance of this quarter. Some analysts down on the stock. Do you think this quarter through and through effectively crushes any bear case on Amazon for this year?
I'm not sure who those bears are, but they might want to look into a new line of work. I mean, look, absolutely. I mean, these were incredibly impressive numbers. I mean, to have this type of top-line growth, this operating margin expansion, to beat consensus by this much, and then guide second quarter, particularly net sales, well above where consensus was. I mean, look, I think that it's easy to start thinking about the law of large numbers, like how fast and how long can they continue to grow at these rates? But you have to think about it in terms of the total addressable market, right? I mean, there's still the vast majority of sales in the U.S. are still happening in brick and mortar stores. There's still a lot of room for the secular, shift to online shopping, and Amazon obviously benefits from that. Amazon is growing like a weed internationally, and AWS now has a $54 billion annual run rate. AWS, sales accelerated, sequentially, and that was not at the expense of profit margin. Their operating margin was actually up. So I'm not sure who these bears are, but I think they're on the wrong side of this trade, quite frankly.
Anthony, thinking about the AWS business, that also gets us to the upcoming CEO transition where Andy Jassy will take over the CEO spot from Jeff Bezos. Maybe thinking longer term, outside of just the most recent quarter's results, how have you thought about that transition and how it shapes or does it maybe shape, the future of how you've seen Amazon, evolving over the next 5 or 10 years?
Yeah, that's a great question. When we talk about that CEO transition, it's sort of personal to me because Andy Jassy was in my section at Harvard Business School, but clearly he made much better career decisions than I did. But neither here nor there. Look, I mean, Andy has been at the company since 1997. He founded AWS. He worked as a technical advisor for Jeff Bezos. They are joined at the hip. So we're not really expecting any major strategic changes. He's been at the table with a lot of the major decisions that they've made. The other thing to remember is that Jeff's not going anywhere, right? He's going to be executive chairman, even if he somehow, he's one of the largest shareholders. So I don't think it's in Andy's best interest to do anything anytime soon that Jeff's not 100% on board with. And by the way, if it ain't broke, don't fix it. And it's clearly not broke, right? So we do not anticipate any major strategic shifts with this change in leadership.
Yeah, a company with a market cap well over $1 trillion, growing at 44% per year, certainly not an issue there. Anthony Chukumba, Managing Director at Loop Capital. Anthony, always great to get some time with you. We'll talk soon.
Sounds good.
All right, let's turn our attention now to some other companies out with their latest quarterly results within the last 18 hours or so. And let's start with Twitter. Everybody in the media, of course, their favorite company, and the stock continues to disappoint once again. We see a slight beat here on the top and the bottom line, but ultimately shares are down 13% because user growth is just not where it needs to be with this. Sazi, let's start with Twitter and thinking about the activist involvement there. Elliott has their stake. The questions are going to come up, obviously, about Jack Dorsey's dual roles. And it's just shocking after we've seen Facebook. We've seen Snap come out with blockbuster quarters. Now we've complemented it with Pinterest and Twitter, both disappointing to the street.
Miles, yeah, and let's stay on the numbers here because I think that's part of the reason why you're seeing the stock down here. It's not just users per se. First and foremost, Twitter didn't show a quarter-over-quarter acceleration in revenue. Now, we've broken down all these social media earnings this week, and that word acceleration has been very critical. All the other social media companies saw quarter-over-quarter quicker sales growth. Twitter did not. And point number two here, to your point, Miles, yes, Twitter showed slower sales growth versus its peers. Facebook's first quarter revenue up 48% year over year, Google 34%, Snap up 66%, Twitter only up 28%. I tweeted out a cool chart this morning showing how much faster Snap sales are growing than Twitter. I mean, it's pretty striking here. And then last but not least, let's keep in mind, Twitter just had a key investor day earlier this year where they came out and said, we want to double revenues by 2023. And now there are some folks on the street after earnings yesterday calling into question if they can hit that mark, just given where the first quarter came out.
Yeah, guys, I want to just add and piggyback on that. Ad sales, all about ad sales for so many of these big tech companies this quarter, right? You had, for example, YouTube ad sales up 49%. One thing that we didn't mention, I don't think in the Amazon numbers, their so-called other sales were up 77%. That includes ad sales, and Amazon earlier on in that evolution. So not a comparable, necessarily straight comparable number, but still, Twitter's ad revenue up 32%. So still growth, but when you look at what these other companies are putting up on the ad side, you just see that this whole narrative that at some point Twitter was going to be able to monetize and unlock this growth. They are still not realizing it in the same magnitude as the other large cap tech companies.
Yeah, and look, I mean, I understand that Twitter is going to continue to try to iterate and make that platform better. But, if we think about what Instagram and Facebook, so the Facebook family of companies, if we think about what they sell, and now Snap is doing it, and this is essentially what happens on TikTok as well, is that they sell stuff to people, right? People go onto Instagram, they see, whatever, probably some knockoff Canada Goose jacket, but then they buy it, right? And Facebook takes a cut of that, and then everyone goes home happy. And that advertiser is going to continue to come back to the platform because they get sales off of that. I mean, Twitter is inside jokes. Twitter is fun for all kinds of reasons that involve how different it is from Facebook and Instagram. But the content on Twitter is not as obviously monetizable. The experience on Twitter is not as obviously monetizable. It's chuckleheads like us tweeting out charts. It was more political news. I guess there's still some, but we're kind of over that now. But it's news. It's things that are happening today, and it's a way to occupy yourself in your free moments. There's nothing aspirational really about being on Twitter, whereas I think there's a lot of things that are aspirational about being on Instagram, and talk about whether that's good for all of our mental health or not. But that is something you can sell against, and I think Twitter has clearly had a more challenging experience with that. I just do not see the path towards that changing. So, I guess that's why you're hearing rumors about things like Twitter Plus and subscription Twitter feeds, because otherwise, no one wants to read my feed and then go buy a T-shirt. There's no synergy there. However hard Twitter is going to try. Although maybe we'll do a shop the look. We'll do a shop the look for us here on the show. Ooh. Brian Sazi.
Bonobos. I'm ready to go.
There we go. Brian Sazi helping out the folks over at Walmart with his bonobos getup today. All right, let's move on to Julie Hyman's favorite space. That is big oil. Exxon and Chevron out with their results. And Julie, we continue to see companies beating expectation. But as you mentioned in our morning meeting today, just fascinating businesses that are in dying industries and still bringing in a couple $100 billion in revenue a year.
Yeah, I mean, in the case of Exxon, right, it has definitely been struggling, and it really was handed a gift this quarter by the higher oil prices. I mean, that's essentially what happened, because there were a lot of headwinds, right? The company, there was a big storm in Texas, of course, that shut down production for quite a while, but oil prices went up so much that it was able to offset it. And actually, surprisingly, Exxon's stock is actually the best performer among the oil majors year to date. That's due in part, of course, to activism. Engine number one and some other activists getting involved in the company, pushing for changes, pushing for it to spend its cash differently, to invest differently, and also to be more proactive when it comes to seeing a post-fossil fuel future, or at least a much diminished fossil fuel future. We've talked a lot about the narrative between the U.S. majors, which have gone the path of Exxon largely, and the European super majors, which have focused more on renewable energy and other sources of revenue. So Exxon getting a little reprieve here. We'll see what ends up happening. Brian, I know that you have been watching this activist campaign at Exxon very closely as well, and there have been some board changes as a result of it.
Yeah, 3 new incoming board members. Julie, that was announced in March. The most prominent, I would say, is Jeff Ubben. I call him Mr. Green. He's all about these green investments, early investor in Nikola. But also, too, you're seeing the effects of that activist pressure here. Exxon calling out, they're trying to save $3 billion in what they call structural costs by 2023. If they do hit that mark, they say they will have trimmed $6 billion in costs out of their business. But I imagine there's a lot of fat, there's a lot of bloat still in Exxon outside of those cost cuts. A lot more to go, I'm sure, to appease any activist investor involved with this stock.
I'm looking forward to the future where Exxon becomes a key holding within an ESG strategy, because I think we all know that is where this is going. All right, off for a short break here on Yahoo Finance Live. Futures under pressure ahead of today's open. On the other side, Brian Chung is going to stop by to talk about the latest inflation data. We're back with that right after this.
Inflation data out this morning, always hotly anticipated, although it was sort of hinted at or included in the larger first quarter GDP numbers earlier in the week. PCE, which is the preferred inflation gauge of the Fed. Our Brian Chung, of course, watching that very closely. If you look at the core, it's creeping closer to that 2% target.
Well, I was actually going to say, do you hear that knocking on the door? I think that's actually inflation that's right outside. We got some new data from the Bureau of Economic Analysis showing that inflation did increase by 0.4% in March. That's when you exclude those volatile pricing components like food and energy, which means that on a year-over-year basis, it clocked in at 1.8%. That is a pandemic high. The last time we saw a core PCE reading that high was in February of 2020, right before the crisis. And there's reason to think that the figures that we got from the BEA will point to inflation rising even further from that point. And that's because you look at personal income numbers up 21%. On a disposable personal income basis, that was up almost 24%. And the savings rate was up by 27.6%, which means that people have more money. They've been pocketing more money, which means they could be set up for a very aggressive spending cycle in the next few months, which means that inflation could go above that 2% reading. For the Federal Reserve's part, they've been saying, don't panic just yet. We'll be patient with our policy, but be ready if those inflation readings do show some of those effects, guys.
All right, Brian, so we'd like to focus here on the Federal Reserve, on the state of the U.S. economy. We just saw the graphic there on the board, some data out of Europe this morning, giving us a read on the state of that recovery, or rather lack thereof. And the question thus becomes, at least the way the pink sheets are framing it over at the FT, is this indeed a double dip recession?
Yeah, well, very different story that we're seeing in the Euro area compared to the GDP numbers that we saw in the United States yesterday in the morning, but GDP contracting by 0.6% on a seasonally adjusted basis compared to the previous quarter. And when you consider that in the previous quarter, there was another contraction that was 0.7% in that quarter, which means that we have back-to-back quarters of GDP contraction in the Euro area. Portugal and Germany were among the worst contractions that we saw in that area, but some countries did eke out growth when you look at Belgium and France, for example. But obviously, we've been hearing all these stories of renewed lockdowns in portions of Europe as some of the variants continue to pose risks, and especially with their vaccine rollout happening a bit slower than it's happening here in the United States. So that appears to be hampering their ability to recover from the crisis, at least so far. But very interesting kind of trends to watch over on the other side of the pond.
Brian, I heard a knock on the door. I thought you were going to pull in Jay Powell to this interview.
Yeah, actually, he just texted me. He said he's on the way. But I don't know. We'll see what he has to say. He is scheduled to speak next Monday, so we'll have the eyes on that with regards to inflation.
He's coming to talk to you about Doge. He's doing some follow-up commentary on that. Brian, thank you so much. Appreciate it. We're going to take a quick break. When we come back, we will have the opening bell. Savita Subramanian of Bank of America will join us.
All right, welcome back to Yahoo Finance Live on this Friday morning. We're about 7 minutes away from the opening bell. We see futures pointing to losses at the open. NASDAQ, the laggard here, off about 0.7% as we wrap up a very busy week for corporate earnings. Joining us now to talk about the earnings outlook and about the setup for stocks over the balance of the year, Savita Subramanian, the head of U.S. Equity and Quant Strategy over at Bank of America Global Research. Savita, great to have you on this morning. Let's just start with your first impressions, or I guess we're in the middle of the impressions here, from first quarter earnings and how it's kind of factored into what you guys are thinking, where earnings might go this year. And I guess a way of asking it is, how much better than the pre-crisis 2019 peak are you now thinking 2021 earnings per share might come in at?
Yeah, great question. So, earnings so far is tracking really healthy. We're tracking a sizable beat at this point. I think we were forecasting a 6% beat, and we're tracking a bit higher than that, 7% beat. What's interesting right now is that we haven't really seen companies react to positive news. So I think where it's getting interesting is just the earnings reactions are actually signaling that investors are fairly, overweight the stocks that are actually beating estimates, and we're not seeing that much of a, alpha from beat. So right now we're tracking, less than 100 basis points of alpha when a stock actually beats on earnings and revenues. And historically, that's been closer to 2 to 3%. So I think this is a very anemic reaction. Now, in terms of full year, we are expecting 2021 to eclipse 2019. We're seeing really strong signs of an economic recovery. We've got stimulus. We've got kind of everything that lines up to set the stage for a very bullish earnings recovery. I think the one risk to that thesis is inflation, and we can talk more about that. But I think what we're hearing so far is that inflation is good and that companies are able to pass on, rising raw input costs and labor costs through pricing. But if that changes for any reason, I think that's where you start to see margins compress, and that's where things go wrong. So that's one of the factors we're watching. We're expecting to see over 30% earnings growth this year. It's going to be a blockbuster year for earnings. The problem is the market is already pricing in that level of earnings and maybe a little bit more than that. And in our view, we may not see further strong gains from the S&P 500, but we could continue to see gains from some of the more cyclical areas of the market.
Savita, it's Julie here. Not only are you guys not looking for further gains from here, you're actually looking, your in target for the S&P is 3,800. So you're looking for a drift lower from here. What gives there? Does that reflect some of the risks you were talking about, inflation, not being able to pass on costs, some margin compression? What's going on?
Absolutely. Yeah, what's going on? So, absolutely. I think that the risks are inflation, and so far so good. So that's not necessarily what's making us more cautious towards the end of the year. But I think that the news flow is going to get a little bit more negative. And we're already hearing it. We're already hearing about payback for stimulus, right? How are we going to pay back all this money that we borrowed from the government? It's probably going to be through some kind of a hike in tax rates, which potentially hurts some of the higher end consumption. Capital gains rates are potentially going to move higher, which potentially hurts the appetite for equities of individual investors, which have been a major participator in this bull market, especially over the last 12 months. So I think that a lot of those types of factors make me a little bit nervous. And then on the inflation front, it's not so much earnings I'm worried about, but it's more about the Fed and how the Fed is able to, kind of absorb potentially higher inflation that might not be transitory. And I think that's the $1 million question. Is what we're seeing transitory and manageable, and it's going to go away because, we're going from 0 to 100 on the economy? Or is it the signs of a longer, more secular, inflationary cycle coming off of massive fiscal stimulus and, the lowest interest rates we've seen in, by some measures, 5,000 years. So, it almost seems like the stage is set for things to get a little bit worse on the cost of capital side, on the inflation side, rather than better.
How do we know if it's transitory or not, Savita? Sorry, Brian.
This is exactly right.
How are we going to know? How long do we have to wait?
So I think what you want to watch are a few things. And there are canaries in the S&P 500 that basically sniff out strong inflationary pressure. And we have a basket of stocks that have basically been very correlated and leading indicators of inflation. so far they've been moving higher in a demonstrable fashion. And these are, kind of, the companies you would think of as the canaries of the economy, their machinery, their energy, their, kind of raw materials plays. Now, if those stocks taper off, or if you start to see a deceleration in gains, then I think that what the market is telling us is that inflation is manageable. The other thing I would look at is margins, and I would watch when we're starting to see pricing power go away from companies. And so far we've seen demand surge, and that's been good for pricing. But if that stops or if that tapers off, I think that's another tell. And then from a longer term perspective, I think what we need to watch are some of the, the forces that have kept inflation low. Where are we in those cycles? So for example, think about disruption and, just in retail, we've seen internet take share from brick and mortar, and that's been a source of disinflationary pressure. Now, where are we in that cycle? Well, at this point, 60% of sales by our credit card data is internet and 40% is brick and mortar. We're coming off of, a very high level of online retail because all we could do was online retail. So I think that those are the barometers to watch, is to think about where we are in that secular trend. Demographics, I don't know if demographics are necessarily going to be disinflationary. This was the mantra that we heard for the last 20 years, is that as the population ages, folks spend less, and that's a suppressant on inflation. I mean, one of the other counter arguments is that as there are fewer and fewer workers, wage inflation could actually go through the roof. So I think demographics is not necessarily a slam dunk on inflation or deflation. So those are some of the barometers I would watch. But again, I don't think the market is pricing this in. When you look at investors' positioning, when you look at valuations, we're still in an environment where a lot of the secular disinflationary beneficiaries are trading at significant premia to the inflation winners.
There you saw the opening bell on Wall Street on this Friday morning. Lots of earnings reports to digest. Charles Schwab is actually ringing that opening bell. Savita, I'm going to bring you into the battle Julie and I have been having on corporate taxes really over the past month. So no pressure here. You don't have to take sides, but we look at the historical data, and the data says that the markets could shake off higher taxes. Where do you think that's the case here?
I think to a certain extent. I mean, I think that what you're going to see is a meaningful drop in earnings. But to your point, I mean, here's what we've found in our quant work. And this is where, I'm a numbers gal. We look at all these regressions and kind of try to track relationships. There's really no strong relationship between corporate tax rates, capital gains tax rates, even individual tax rates, and markets. So it's hard to make a call one way or another. There are very strong themes from a sector perspective. So as you start to see individual income tax rates increase, especially at the wealthy, you've definitely seen discount retail outperform luxury. I mean, you've seen some of these sort of obvious trends take place. At an overall level, I think that a tax hike on corporates, somewhere in the middle between 35% and where we are now, would be absorbed by companies. A lot of that tax benefit or hit goes away through just natural competitive forces. But I do think it's a negative headline. I think it's optically negative for investor confidence, for corporate confidence, et cetera. In terms of capital gains rate hikes, I think that's a big deal, because if you think about it, individual investors have made a lot of money on mega cap tech over the last 10 years. And if all of a sudden, if they sell those stocks and they're taxed at a significantly higher rate than what they were expecting to pay, that might force some selling, ahead of potential changes in that tax consequence. So I think that's an area that's particularly vulnerable by some of the rhetoric we're hearing in Washington, which is yet another reason that we're not particularly bullish on communication services, on FANG, on some of these mega cap growth names that have led the market.
Well, Julie, it sounds as though maybe I'm right.
Sorry, Julie. Let's do it. Let's do round two next time.
Fair enough. All right, we'll leave it there. Savita Subramanian, always good to see you. Have a great weekend.
Great to see you.
All right, let's go over to our very own Jared Blickery for a look at the markets on this Friday morning. Jared.
Yeah, we're opening up a little bit weak here. All the majors on the Wi-Fi Interactive that I'm looking at, each down about 0.5%, and the Nasdaq sinking a bit lower now. You can see it's down about 65 basis points. Russell 2000, the small caps, down about 0.4%. And we look in the Nasdaq 100, something's going to jump out there. Amazon extremely close to a record high, but not quite there yet. Let's just take a quick look at a one-year chart. These are blowout results, but they have really done nothing but go sideways since late August, actually probably back to July. So if they can get above this hurdle here, probably going to kick off another leg up. And that's something a lot of those investors have been waiting for. Everything else you can see mired in the red just about. Microsoft off 1%, Tesla down 0.9%. Got a couple green spots here. Alexion Pharmaceuticals up over 2, Pinduoduo 1, but for the most part, and everything's in the red. Now, in the sector action today, we have utilities, discretionary, and staples. Those are all in the green, but just barely. You can see staples unchanged there. And why is that? A lot of people buying stuff that they actually need. That's why those stocks tend to become a defensive play when we have the market down. Utilities, well, that's understandable as well, but discretionary is really just that Amazon story. And here's communication services coming off a record high yesterday, thanks to those Facebook earnings. So a bit of profit taking here this morning. And then also energy down 1%. And we got to take a look inside the energy sector because we got those earnings from the two majors today. And as Julie was talking about, for Exxon and Chevron, they really got a windfall just from the fact that the price of crude oil rose. And the consensus on the street is now gearing towards the higher numbers, 70, 80. I don't really hear people talking about $50 crude, at least WTI anymore. So Chevron's down 2%. Exxon, as Julie noted, the best performer of the majors. Year to date, it is up about 41, 42% there. Still has a little bit of work to do before it gets that next leg up, but probably going to be determined by the price of crude oil. All right, so let's take a look at the travel sector here. And so mixed picture. We saw the cruise lines have a bit of trouble yesterday, despite Royal Caribbean getting some positive guidance from the CDC. You can see Royal Caribbean in the upper right here. That's up about 0.2%. But we got some decent gains in the airlines. United's up about 0.5%. So is American. You see at the bottom. But the travel sites like Booking and Marriott, those are down on your left. Those are down over 1%, guys.
Jared, I want to go back to the NASDAQ for a second, and it is the final day of the month, and so we actually get a nice look at what the 1 month gains have been in this sector, because we were just talking to Savita Subramanian of Bank of America, talking about how results have just been knocking it out of the park. Corporate results have, and we saw some pops earlier this week. Today, a little bit on the downside, but we started to see a little bit of the NASDAQ really get its act together after it was such a value rally. Let's call it from the election, through the end of February.
Yeah, and I'll tell you something notable happened yesterday, which was the NASDAQ touched a record intraday high, wasn't able to close at a record high, though. This is a NASDAQ composite over the last 2 months. These are some ominous candles in here. Those big red guys, you typically don't want to see too many of those at the top of a rally. Now we'll have to see what the end of the day brings, but the weekly candle could be a little bit ominous here. I'm not going to throw in the towel or anything because we're so close to these record highs, but I'll tell you what, you look at the breadth in the overall market, like the New York Stock Exchange listed stocks, the S&P 500 stocks, those are still pretty strong, but we've been seeing breadth deterioration in the NASDAQ composite and the 100, especially the composite, because that's more geared towards those less weighty names like Amazon that we're talking about today. So a little bit of defense may be warranted here, especially as we're heading into May, but don't go away.
That's right. Who are we to forget about the seasonals that await us on the other side of this weekend? All right, Jared Blickery with a look at how markets are trading just after today's opening bell. All right, we're off for a short break here. On the other side, we're going to be talking about the renewable energy trade. John Carrington, CEO of STEM, will join us for that conversation coming up here right after this.
Renewable energy, of course, squarely at the center of the president's plan in terms of climate change, ameliorating or arresting our march towards it. And we were talking to a company now that is trying to do its part and make some money while doing it in that area. It's called STEM. The CEO, John Carrington, joining us now after just completing a deal to go public through a SPAC deal with Star Peak Energy Transition. John, thanks for being here. First of all, I got to ask you to break down what it is exactly that you do. I went through your investor presentation. I know it talks a lot about energy storage and sort of smart energy storage. Effectively, it's a battery company, yes, and sort of services around battery. What are the applications and what exactly do you guys do?
Sure, and thank you very much for having me on. So what we do is we provide our customers with a clean energy storage solution that helps our customers save money on energy. They also help reduce carbon and also provide more grid resiliency. But all of this is operated and orchestrated by our artificial intelligence software platform that we call Athena. So we are not a battery company, we're really a software company, and that AI technology that we've created helps drive the savings and the use cases that vary by market for our customers. And our customers include commercial industrials and Fortune 500s, the likes of Amazon, Walmart, Home Depot, Alphabet, and Facebook. And then on the other side of the equation, we have these renewable developers and asset owners. And this group will use the Athena platform and our storage system to help drive additional returns to their projects. So we are certainly not a battery company. We procure battery hardware from the tier 1 OEMs. We're really about the software platform, Athena, that we put on top of all those systems.
So John, you're working with a lot of the big tech companies. What are the big tech companies coming to you for? What do they need you for?
So there's a few things, Brian. Number one, they are looking to save money on their energy bills, and we provide up to 30% savings on that front. The other thing they want to do is provide an ESG narrative. Every corporate comes to us saying, how can we be a better grid citizen? How can we participate in markets? And we enable that with Athena. So what we'll do is we will contract with one of our Fortune 500 customers. We will put these systems into their locations, and it will automatically interact with the market. It will predict what the building's going to be doing and the use case that we have for that market, and we'll extract as much value as we can. They, in turn, are saving money, and they can tell their shareholders that they're being a better grid citizen, and actually they can generate revenue from our systems based upon the way we contract our systems with them.
And how competitive, if there is one, how competitive is the battle with Tesla's Powerwall system?
Well, you know, we're only in the C&I and project developer side, so that's primarily a residential play. We're not in that market today. In fact, Tesla's a very good supplier to us, so we don't run into them at the residential side.
And so, as always, because you went public through a SPAC, you guys get to make some predictions, right, about how your revenue is going to grow. I am curious, going public in this fashion, what kind of pressure do you feel to deliver on some of those predictions? You know, for 2021, you guys are looking for $147 million, but you're looking for it to grow into over $1 billion over the next 5 years.
Yeah, so, a couple things on that front. First of all, I don't feel any more pressure being public than private. We had a habit of making our numbers and our commitments to our shareholders. But I would say that the growth in 2021, we feel very good about. We reaffirmed that in January. In fact, through the third quarter of last year, we had 80% of the bookings required for our 2021 revenue numbers. So we were pretty much locked already through the third quarter. The fourth quarter was obviously good, and then into the first quarter continued to be activity that we'll put into 2021. So while the numbers are big, as you've outlined, the growth in the market's massive. We have a $1.2 trillion market. This is growing at 25x over the next 10 years. That's according to Wood Mackenzie, so third-party source. McKinsey and others have forecasted a similar growth rate. And so we're also taking a pretty conservative approach on our share position in those new and growing markets, whereas in California, which is the largest storage market today, we have a 75% market share. We are larger than our next 4 competitors combined. So we've really haircut that. We feel like the numbers are conservative in our model, and we believe we'll attain those. And in fact, you know, that billion-dollar mark is certainly out there, and I'm well aware of it. And we're excited to continue to execute. And look, this balance sheet changes everything. Part of the reason we couldn't grow as quickly as we'd like to is the balance sheet. When you talk to renewable developers, these are 20 and 25-year deals, and we were a venture company with 12 to 18 months of cash runway that, you know, we just didn't align. Now we have eliminated that concern, so we have a great balance sheet to go address that $1.2 trillion market, and we couldn't be happier with the partners we have to help us go do that.
Well, we'll keep in touch as you continue on your path there. John Carrington, the CEO of STEM. Thanks, John. We are now going to we're going to take a quick break. When we come back, we'll check in with the CEO of Restaurant Brands, Jose Sil, after that company reported its latest quarter and saw some big same-store sales growth.
Restaurant Brands is out with better than expected first quarter results on the back of sales and profit gains at Burger King and Popeyes. Shares are higher in the early going here following the report. Fresh off his earnings call, Restaurant Brands CEO Jose Sil is here with us with a first on Yahoo Finance chat. Jose, always good to see you here. Very interested what you're seeing in the U.S. in terms of where, in sales, where markets where the vaccine rates have picked up. What have you seen from consumers there?
Hey, Brian, thanks for having me. Great to be here again. Look, we're excited about the progress we made in Q1. We saw mobility improve in the U.S. Over the quarter. Our plans were solid for Burger King, for Popeyes, for Tim Hortons in Canada as well. And we saw good progress for all three brands during the quarter. Obviously, the mobility changes have an impact on people being out in the streets and their visitation to restaurants. The vaccine rollout in the U.S. has been a positive movement for the economy and for our business as well. But for us, it goes beyond the macro events. I think the plans that we put in place with Burger King, with value being a key part of it, as well as continued innovation on some of our core items, as well as our premium items, with hand-breaded chicken sandwich being a very important innovation for the back half of the year. We're really excited about Burger King in the U.S. and the progress we're making. Still have a lot of work to do. And with Popeyes, obviously, the chicken sandwich continues to be a driver of business. Our overall platform for Popeyes is growing. We introduced the Cajun Flounder during the quarter, and that was a big hit for the Lent season. And our digital business for Popeyes and for Burger King continues to grow. And then the final piece would be the progress we made with Tim's in Canada. We launched fresh cracked eggs. Our digital Roll Up to Win program was really successful in the quarter, and in particular, towards the end of the quarter, we saw really good progress. We had 2+ million downloads of the app and had tremendous digital sales over 30% during the quarter, which is a really strong performance. Our headlines for the first quarter give us confidence that we're on the right path. Positive 2-year system-wide sales growth development, one of our best first quarters ever, and certainly in the last 5 years. And Tim's digital showing the work we can do from a digital standpoint to engage with our customers and drive incremental sales and visits.
So sales coming back, that's good, Jose. Are you able to find the labor you need to service demand? We've heard from a lot of restaurants this week. There's a pretty serious labor shortage right now.
Finding great talent has always been a priority for the restaurant business. I've been in this for over 20 years, and I used to run our company restaurants at Burger King years ago, and that was number one priority. I talked to franchisees and owners around the world, here in the U.S., in Canada, and elsewhere as well. That's a number one priority all the time. Certainly, there are moments in time when it becomes a little more complicated and challenging. I think we may be in one of those moments, but our teams are doing a great job. Our franchisees do a fantastic job of creating hiring events and hiring parties and creating excitement and awareness for the need for talent in the restaurants, but more importantly, the type of culture and the type of exciting opportunities that exist in the restaurant business. Folks that start as hourly employees in restaurants, many of them have made it all the way to the top in different brands, including in our businesses as well. So there's a focus on hiring. There's a focus on creating a great environment in the restaurants so that we retain talent and we retain our folks to be able to serve guests in the restaurants. It's a continuous and ongoing responsibility and obligation, and we're focused intently on it, and our franchisees are as well.
Jose, I know you got a number of questions about it on the call, but I want to ask a little bit more about what's happening at the Tim Hortons business and how different the dynamics have been in Canada relative to the U.S. And I guess for the Tim's story specifically, how much of it is the COVID impact, and then how much of it is you guys continuing to try to move forward with that brand after I think a couple of years that might have been disappointing to you guys ahead of the pandemic.
Hey, Miles, how you doing? Yeah, Tim's is obviously a big part of our business, and we've been sharing broadly over the last probably 4 quarters or so our Back to Basics plan in Canada, something that we've aligned with our franchise owners in Canada, and there's a lot of excitement around it. The focus of that plan is around quality food to match our quality beverages, and one of the key elements of that was the launch of, you just showed the reel of it, the launch of fresh cracked eggs for breakfast, and we saw really good progress and momentum in Canada during the first quarter. In particular, when we launched it in February, we saw our breakfast food sales as a category grow year over year and on a 2-year basis, as well as our morning day part starting to show signs of positive growth, even in the face of a very difficult environment where Canada is quite different from the U.S. What we're accustomed to here in the U.S. is a little bit further behind in Canada today. They're still in lockdowns. Ontario, which is where almost 40% of the population resides and about 50% of our restaurants exist, is in strict lockdowns through May 20th, and that has an impact on mobility, which obviously impacts our business. That said, we're investing in the business in Canada. We've committed to an 80 million Canadian dollar investment in the advertising fund, and franchisees are also supporting that with an increase in their advertising contributions. We believe in the plan, we believe in the team, we believe in the work that our franchise owners are doing, and we're investing and committing behind that. Once things open up, we think we're going to be really well positioned to capture growth and continue to see growth in the business for the long term.
And Jose, the last time we talked to you was around the time of the Burger King $1 menu launch. What have you seen in that business? Any indications you are taking the fight to the McDonald's dollar menu?
Well, our focus has always been on balance and having a balanced offer, and I think we've kind of misstepped over maybe over the last year or so. We haven't had that balance consistently, and the launch of the value menu was really important. We launched it at the end of December of 2020, so it's been in place throughout the quarter, and it helped us drive year-over-year improvement in traffic gains as well as versus the industry. So we're encouraged. It's early days. We have one of the most compelling value offers now. There's no one out there with a cheeseburger with bacon like we have for $1, and it's bringing customers back more frequently, and we're excited about it. We think it's an early part of the journey, and we're going to continue to invest behind it, both in terms of communication to create awareness, but also investing in innovation to bring new news to the platform. Balance will always be a key part of our approach with Burger King, and we have a long-term view on building an awesome core menu with high quality ingredients, our premium products, including the hand breaded chicken sandwich, which is coming soon, and obviously a balanced approach on value will be a key part of it. And in addition to that, we're working on breakfast, which we think will be a big part of our growth story for Burger King in the U.S. for years to come.
Well, indeed, be on the lookout. We'll leave it there. Restaurant Brand CEO Jose Cil, always good to see you. Have a good weekend.
Thanks, Brian. You too. All the best.
All right, stick around. We'll be right back with a quick check at the markets.
All right, welcome back to Yahoo Finance Live on this Friday morning as we get set to wrap up the month of April. We see major averages under a little bit of pressure this morning as we get the month's final session underway, off about 0.4% across the board. Let's talk a little bit about some exchange arcana that crossed the tape this morning. Brian Sazzi, you flagged it for us. Honeywell is changing its listing from the New York Stock Exchange to the NASDAQ. An interesting move. How are you thinking about this? And hopefully we can talk to Honeywell, get some more color on this in the weeks ahead.
My first take was wow, because I actually talked to Honeywell's CEO, Darius Adamczyk, at the time, a couple months ago. I believe it was late last year when they celebrated 100 years on the New York Stock Exchange. This is very big. But I can't say I'm surprised. Honeywell has been spinning a story to investors that it is, in fact, a tech company. They have a lot of tech, a lot of software in their portfolio. So I can't say I'm totally surprised by this, but wow, 100 years on the New York Stock Exchange, Honeywell going to the NASDAQ. That's big stuff.
Yeah, and we can get into the story about, the battle between the stock exchange or New York Stock Exchange and the NASDAQ, the fees companies pay, the multiple that might be assigned to stocks based on where they're listed. Always a lot into this. And so certainly one that we'll follow up on, even if on the surface it sort of seems like some benign news here. So as always, thanks for flagging that for us. All right, off for a short break here on Yahoo Finance Live. On the other side, a lot more coming up on this Friday morning. We're back with all that right after this.
It's just after 10 a.m. on this Friday, April 30th. This is Yahoo Finance Live. I'm Julie Hyman with Miles Udland and Brian Sozzi. We are, of course, getting to the end of a peak earnings week. We have all been very busy this week. We're all very tired, but we're also looking back at the numbers and how they compared to estimates. And that's something that Miles wrote about in this morning's morning brief. It was quite interesting to, we all know, Miles, that companies beat estimates on balance every single quarter, but they beat by different margins, right? And this quarter they beat by quite a lot. And so we can sort of extrapolate what that tells us about not just where expectations were, but how this earnings season is, and indeed that companies are really performing here.
Yeah, I mean, look, we could do a whole 2-hour show. We could do multiple specials about the art of managing the quarter and beating that expectation, from an executive team. But what we're seeing this quarter, Julie, and we've discussed it every day on the program. When you look at the results, let's say out of a company like an Apple, like a Facebook, where you have 40, 50 analysts covering this stock, and the company still beats estimates by just a massive amount, and almost kind of puts the company's growth into a trajectory that consensus had not really considered before. Some of this is about the economic cycle. A lot of this comes to companies pulled their guidance last year, and the way that analysts on Wall Street are framing their expectations is based off of what companies are telling them. So when they tell them nothing, naturally you're likely to miss that estimate. But we had some data around this to firm up the feeling we had that something weird was happening. The folks over at Refinitiv flagging for us that 86.8%, so 87% of companies in the S&P 500 that had reported their results through Thursday morning had topped expectations. So we can call that pretty much every company that has reported results beat expectations, and the magnitude on average of their beat for earnings, not for revenue, but for earnings, was about 24%. So again, that example is if everyone thought you were going to report $1 of earnings, on average, companies are coming in with $1.25 of earnings, and on average, 9 out of 10 companies are coming in with that kind of a beat. And so it shows how far away from the guess, the dart throw, if you will, results have actually ended up. And so I think, and that's the best that Refinitiv has on its data, which goes back to 1994. And then if you look at where earnings are tracking overall, we talked about this with Savita Subramanian of Bank of America Global Research a little bit earlier. We're looking at the best quarter for corporate results since 2010. You would expect that coming out of such a depressed period, coming out of a recession, probably not in recession anymore, but we're accelerating out of one. Earnings growth obviously picks up, but it just has been jarring how far away, even aggressive estimates for results have been relative to where they've come in. And it's just a totally different dynamic from what we've gotten used to during the last cycle, where growth was okay, but it just didn't really feel like people were racing to chase just how good things were out there.
And Miles, what's jarring is the amount of data that is coming at investors' faces. I mean, as an investor, do you believe that the strong earnings growth from the first quarter, in some cases up over 200%, depending what companies you look at, AMD, operating profits up close to 300% in the most recent quarter. Do you look at these 2-year stack comparisons? You were talking about this a couple of weeks ago. A lot of the companies are putting that out as well. Or do you look at, take your cue off of what companies are saying about April sales and profits to date? It's a confusing earnings season, Miles.
Yeah, I mean, look at a company like McDonald's. They came out, with some of their best growth that they've seen. On a 2-year stack, they're still looking at 13% same-store sales growth, which for a business that, Sazi, you were an analyst back at the time when, they basically had years on end of same-store sales comps that were 2%. They were negative, I think, for 6 or 8 quarters in a row, something like that in the early 2010s. I mean, things were grim at McDonald's, and now we're looking at a 13% 2-year stack. Yeah, that's going to be a growth story, but it's going to be interesting, I think, this time next year, right, to tease out what part of it is the new economic cycle and what part of it is lapping COVID comps. And I think we got so used to secular stagnation in the 2010s, it just feels like we're not going to repeat that kind of dynamic this time around.
At least it's not seeing evidence of that as of yet. You were just talking about McDonald's is at a record high. Amazon's at a record high today as well. And as we look at those earnings beats, I'm focusing in on the financials because according to Bloomberg data, within the S&P 500, the financial companies that have reported so far, 13 of them have beat estimates. None of them have matched or missed. So definitely reflecting what we've seen in the broader corporate world here. Let's talk to one of the companies within the financial industry that has beat. That's Raymond James. The company saw last quarter records for net revenue, net income, client assets, fee-based assets, advisor headcount. So really reflecting the strength that we have seen elsewhere in the industry, but specific to it as well. Paul Riley, the Raymond James CEO, is joining us now. Paul, it's great to see you. a big part of your story has been adding more advisors, and really it was a lot of new advisors who were bringing in new client money for Raymond James. You've talked a little bit about how you were attracting them in what has been a competitive environment. How much of that formula is money, and how much of it is quality of life? I mean, certainly those the freshman class at Goldman Sachs got a lot of attention after they publicly complained about the working hours there.
Yeah, Julie. So first, great to be back and talk to all of you. It's been interesting. So first, we've always been a very, very long-term view in our firm. So our number one secret to growing advisor count is not losing advisors. Our attrition, our regretted attrition is less than 1% a year. So the first thing is you have to make an environment where people want to be here. We also tell advisors they own their book, and if they want to leave, we'll help them move their clients to another firm. And so no one's here because they feel like they're a prisoner. They're here because they want to be here. So that environment and sense of partnership has been the secret to retaining advisors. That is also the culture we're able to recruit people to. So part of the reason that we're able to get so many people is first that culture, and people that are here are testament to how we treat people. Secondly, I believe we're the industry leader in terms of an advisor's desktop. We've been mobile. For 4 years, you could do everything on this at your home that you could do, on your desktop in the office. So we were, really the first to really fully launch that, and we've continued to increase the advisor's capability to work with their clients. And third, there is, when you're recruiting, certainly people want to be paid if they feel like there's a market for their book or their transition. So we've typically have been one of the lowest in the industry in that, but people need to feel like they had fair value. And in fact, we announced last quarter, we actually increased in our employee channel that transition assistance because we were just behind everyone. And since we did that, our backlog is way, way up just because we're more competitive. We're not at the top, but we're more competitive. So I think it's all three. I think advisors are looking, where can they serve their clients the best? Where can they enjoy to come to work? But they want to feel like they're being economically treated fairly. So it's a combination of all three.
Paul, I'm curious how much the current market environment, where it seems like the public is more interested in the stock market than it's been in some time. You think about the enthusiasm that my friends who are not traders have for their Robinhood accounts, for example. How much that feeds into that flywheel of the advisor space, people wanting to I guess be more aggressive with growing their client base and serving their client base, because for a long time, it might have just been a set it and forget it industry, but it feels like things have probably changed quite a bit given the public's enthusiasm about markets today.
Yeah, so I think that's important that the Robinhoods and other direct channels are great for younger first-time investors who are getting educated on stocks. It was almost for a period of time that everybody was in funds and didn't really follow stocks to some extent, a lot of investors. So the interest in trying to understand stocks and how they're priced, not that they're always maybe priced perfectly and some of the moves, but it's an education for people. That's great. If you look at the advisors, though, you look at our client sentiment. We just got our latest client sentiment report, and it shows that we're back to about 2019 levels in terms of, clients feeling good about the market. Good news, 95%, think their advisors are doing a great job. But what's lagging behind? We're still about 10% below in terms of confidence in the market. About 62% are confident or somewhat confident. And that's versus 73 or 4% back in 2019. And I think that's up 3 points from last quarter. So I think people are still looking at this COVID recovery, what the new tax plans would be and others, but they're getting more and more confident. And it's also fueled by record cash. I mean, we talk about the record cash at banks, you talk about record cash in, investment funds, companies, but we have record cash from our clients too. And, so there's a lot of cash around seeking investment. In the fixed income market, it's hard unless you're after very safe and lower yielding returns. It's hard to put somewhere, their money somewhere where you can get dividend income or other things. So they're looking to the market. So I think all of that, again, combined with stimulus and recovery, is propelling people to say, hey, it should be at least a good year or two in the market.
And Paul, there's a lot of focus right now, and there has been on the mental health, the physical health of workers inside of investment banks. What are your thoughts on this debate?
Yeah, so I think that certain environments have always been tough. Some firms are known for their almost hazing's maybe a bad word, but this part of the culture is you come in, you work really hard, you work long hours, you get to know everybody. And there's, and I think our firm, maybe based on where we are, it's not as bad. But I will say right now that it is hard. Everyone's working hard. And it's ironic, if you look at the number one, when we get our associate surveys back, the number one issue is stress. And it's interesting in stress because, yes, people are busy, but they're working at home. They've got the flexibility. So it's a combination, I think, of not knowing what it's going to be like when we're going to come back to the office, which we are slower than most. We were on a mobile journey before this COVID hit. But I think that people are stressed both on the work environment because it is busy and on this, for some people working from home with kids and others and not having a place or not knowing when they're going to go back or what's happening with school. It's a stressful time for everyone. And of course, the COVID fears. So I think the stress is built out in many, many ways. And one of them is that it is busy, but I think it's much deeper than that.
Have you had to put new safeguards in place, Paul, to protect worker health? And if so, what are they?
Yeah, so we've done many things. First, we are still voluntary. We've capped how many people could be in our office. Our home offices was 20%. We moved it up to 30, but we're probably about 15% occupancy. We capped our branches at 50%, and most of our branches for our advisors are smaller. So we just moved that up to 60% using their judgment. So we do have some markets where branches are closed, but most are open to some extent. And again, it's voluntary for people to come in. But there's mandatory temperature checks at home office. We have electronic temperature screening that catches people going in, attestation every day, rules on travel, how long you have to quarantine, spacing requirements. We all wear these little yellow badges that tell us if we're in 6 feet of someone. It vibrates if we are. And the reason we use them is if someone has COVID, we're able to tell anyone that they're within 6 feet of during the day that they could be potentially exposed. Luckily, we haven't had many cases. So we're doing everything we can to protect our associates. I think openly our management team has said they're all been, vaccinated. Of course, that's people's choice. And hopefully we're going to do a survey to see if we're getting closer to herd immunity to see in areas if we can open offices. So returning to office is going to be harder than telling everyone to go home, especially for us since we already had our mobile devices. But we want people to feel comfortable. We're going to ease in, and we certainly have the technology and all the protocols require masks in the office, limited size of meetings. We're doing a lot of things to keep the environment very, very safe, and we'll continue to err on the side of safety till the data shows it's very, very safe.
And hopefully that will happen sooner rather than later. Yes. Paul Riley, thanks so much for being here. It's great to see you. Be well. Paul, of course, is the Raymond James CEO. We're going to take a break. When we come back, we'll be talking records in a number of individual stocks. We'll be right back.
All right, welcome back to Yahoo Finance Live on this Friday morning, final trading day of the month of April. Stocks under a bit of pressure here. Though off our lows of the morning, we see the majors down about 0.4%, 0.5%. NASDAQ now the outperformer, off just 0.3%. Let's take a look at a couple names that are on the move. Let's start with Twitter. That stock is off double-digit percentages, down as much as 14% earlier in the session. Last indication, stock off about 12.5%. Company last night coming out with slightly better than expected top and bottom line results, but ultimately it does seem that the street here was disappointed in the company's inability to really catch the wave. And Julie, earlier this week, we talked about the results out of Alphabet, the results out of Facebook. Last week, we saw the results out of Snap. And really, Twitter is, 28% revenue growth. That's fine, but it's not accelerating into what is, clearly a growing market and one that has robust demand as the economy recovers out of the pandemic.
Yeah, I mean, there are sort of two persistent questions about Twitter. One is this just what it is, right? Like, this is just what Twitter is, and it's not going to be this big growth machine or big monetization machine that people have talked about for so long. The other question, of course, is whether Jack Dorsey should be running two companies. And I think, that question persists. His other company, Square's doing pretty darn well. So, maybe you focus on the thing that's doing better and find somebody else to run the one that's not. I don't know.
Yeah, and I forget exactly what the language was, but he signed that new agreement, right, where it's like a 1-year review with the board about his performance, and so it does seem that there's visibility on an out for the board if they wanted to go that route and if they wanted to think about replacing him. But it doesn't seem like that story is going to come up over the next couple of quarters, but maybe we're sitting here this time next year, for the 2022 annual meeting, and then that's kind of that conversation. Let's talk about a couple of consumer names trading at record highs today. Amazon last night out with its latest quarterly report. Revenues there growing 44%. Sazi, the company's worth $1.75 trillion, and yet they still have top line growth almost doubling up that of Twitter, which we just discussed. And sure, they're lapping some, a weird period. We had the shutdown and then the stock up and people couldn't get stuff from Amazon. But, really continuing the momentum of their stay-at-home trade, and that's notwithstanding the AWS strength.
Yeah, Amazon inching closer to that $2 trillion market cap. I'm sure it'll be here before we all know it. But two things, Miles, I don't think we talked about when we were discussing Amazon at the top of the show here. Their advertising business, it is growing like a monster. Sales in the most recent quarter up 73%. That accelerated meaningfully quarter over quarter, and it appears from a lot of notes I've been reading from the street in the aftermath of that quarter, they're getting a lot of business from consumer products companies in the advertising industry. So that is a pure profit center for the likes of Amazon. Then next up, I think it's discounted the type of logistics network that Amazon continues to build out, most notably last mile. This company is spending billions of dollars to get you goods to your house as quickly as possible. That could really just widen that competitive moat in the years ahead.
Sazi, that was the first question Ross Sandler over at Barclays asked of Amazon management on the call, was about that last mile delivery network and the density that has increased. And, I think it was 2019, because I remember walking around without a mask when I was seeing these results cross, that Amazon said it was going to spend, I think, $800 million a year on that network. And they may have upped that target as well over the last couple of quarters. Certainly that investment paying off. Another name at a record high this morning, just want to call it out, McDonald's shares. Company earlier this week out with its latest quarterly result. We see off the highs here in mid-morning trade, but just another name that has really picked up on a lot of that stay-at-home trade, a lot of the consumer momentum. We've seen fast food as a big winner. Just talked to Jose Sale of Restaurant Brands about some of that momentum. And I think, McDonald's, obviously, shareholders want to see stock go up forever. I think we'd all like to have more options other than our local McDonald's for dining, but they have enjoyed the ability to remain open through the pandemic. We will see what happens on the cost side. Commodities as well as labor costs certainly going to be a pressure for them going forward. But again, earlier today, McDonald's shares touching an intraday record. All right, off for a short break here on Yahoo Finance Live. A lot more coming up. Right on the other side of this break, we're going to talk specifically about the state of the real estate market here in the tri-state area. Back with that right after this.
Welcome back to Yahoo Finance Live. We have talked a lot about the boom in the suburbs that we've seen in terms of housing. Let's talk about the flip side of that. What's happening in New York City? Ellie Johnson is joining us now. She's the president of Berkshire Hathaway New York Property. Ellie, thank you for being here. What are you seeing in New York right now? I mean, there's been a lot of sort of anecdotal talk about what's happening with prices, what's happening with sales. What are you seeing in your day-to-day?
We're actually very excited. It's been extremely busy. Our first quarter was about 2% above last year. It doesn't sound like much, but for New York City, it's in the right direction. We're seeing multiple offers in different price points. And I think one of the exciting things that recently happened was last Friday, where an apartment traded for the first trade at 220 Central Park South that sold for 23% above what the seller paid for in, at the pricing of 2019. So that's a step in the right direction.
Ellie, it's Miles here. And I think when you look at suburban markets that have gotten a lot of the attention from the media over the last year, you hear about the kinds of concessions that buyers are making. I mean, people are waiving their inspection, for God's sake. What have you seen in the city market? And has that gotten as crazy on that side, or have things operated a little bit more like normal times as we've gotten going here?
New York City is one of those markets that you have to seize the moment of a buyer's market. And some people are calling it the FOMO syndrome, the fear of missing out. And we are seeing discounts in new development, and that has been the greatest increase in sales. Like, for example, we closed, a lot of our transactions, about 175 of those transactions were under new development. And those developers are offering a lot of different discounts and concessions to the buyers. And however, on resale, because of COVID, sellers became more realistic with pricing adjustments were made prior to. And those properties that are trading right now and are getting multiple offers are properties that the prices have been readjusted to current market conditions. So we don't have the properties of the suburbs.
And Ellie, talk to me about the different price tranches and levels in New York City and how the different ones are faring.
Just to give you an example, the luxury market is considered a property for $1 million and above, and anything below that. So when you go to a lot of people are really coming into the city, taking the opportunity because of the changes in lifestyle with COVID. People are trading up, or people are looking to buy bigger places, quite frankly. So you see more demand on those apartments, and a lot of that is new construction, of course. But some examples of discounts, and you have to really go building by building and price by price. If you're doing an Excel development, for example, or related, who are some of the largest developers in New York City and have different product across different price points, you're going to see everything from no discounts downtown from buildings that are selling between 1 million and 4 million. And then you're seeing discounts up to 25 to 35% on luxury buildings. So that's in the condo market. The townhouse market improved very nicely, and I think it's steadily moving in the right direction. Again, people are looking for more space, privacy. And, it's neighborhood by neighborhood. Like if you go, a lot of people consider Manhattan, right, the 5 boroughs. And when you look at Queens, for example, I mean, they have had an increase of 56% year over year. And, the Rockaways, 24%. And, we're seeing a lot of that, while you see the Upper West Side, who went down about 16%. And in Tribeca, even though there's a lot of activity and there's great inventory there, we're still at about 7%, down from a year ago.
Really interesting. So the Queens and the Rockaways are hot. You heard it here first. Ellie, thanks so much. Ellie Johnson, Berkshire Hathaway New York Property President. And remember, stay tuned to Yahoo Finance for the exclusive live stream of the 2021 Berkshire Hathaway shareholder meeting. It's sponsored by Moo, and it kicks off tomorrow at 12:30 p.m. Eastern. We'll be right back with the CEO of Stanley Black & Decker.
Stanley Black & Decker hammered home another strong quarter this week as the industrial economy reopens and homeowners continue to remodel their homes during the pandemic. The company's first quarter sales surged 34% and profit margins grew in all segments of the company. Stanley Black & Decker also lifted the high end of its full-year profit guidance by 70 cents. Joining us now is Stanley Black & Decker CEO James Loree. James, good to speak with you here. It's been a while. So go through the quarter here. This is a pretty strong quarter from you guys. What parts of the business are growing the strongest as economies around the world are reopening?
Well, let me just give you a quick walk around the world and a couple of statistics on the products themselves. You know, the organic growth in North America was 41%. U.S. retail, which is the home centers and Amazon, was up 48%. Europe was up 47%. With the UK, believe it or not, 80% growth. And France, Italy, Spain, and others greater than 30%. The emerging markets up 77%. Latin America, 77%. Asia was up 62%. I mean, there is a global boom going on for at least the tool market and some other markets as well. So, and then just on the products, power tools up 50%, 5-0. I mean, a typical great quarter for us would be maybe 10, 12, 14%, but 50%, hand tools, 28%. And get this, outdoor, 120% growth. It's just all over the place.
Jim, back in my prior life as an analyst, I covered you guys for close to 10 years. And what always impressed me, you guys are true cost savings magicians. Now, this year, you called out a $235 million hit from inflation. How are you going to overcome that?
Well, we'll get about 235 of inflation, as you said, and then about 30 to 50% of that will be covered in price, and the other remaining part will be covered through cost productivity and something we call margin resilience, which is an effort we've been working on for a couple of years now, where we're taking artificial intelligence and machine learning and Industry 4.0, which you and I talked about in the past, and applying it to the value pools in the company. And that really provides another 100 million or so of cushion to help offset that inflation. You know, I've been dealing with inflation for 2 decades as a C-level executive in this company, and we are not at all concerned about the impact on the bottom line here with all the great offsets that we have.
And, you know, Jim, when you look at the breakdown between, you know, the pro market and the consumer market for, you know, for a lot of your tools, and you think about the growth trajectory there, specifically on the home side, on the consumer side, are some of those one-time expenditures? Someone buys a home, all of a sudden they've got a couple grand of stuff they didn't know they needed to buy? Or do you think this is, you know, people thinking more seriously about investing in their home, doing more DIY, trying to figure out how to actually use a power drill for the first time, and sticking with that, you know, through the cycle here?
Yeah, our research certainly indicates the latter. I will say there's a number of dynamics going on with the consumer and the pros, frankly, right now. But there is a global resurgence of DIY, and it is driven by a generational change where homes are being repurposed. There's a lot of people with a lot of time that are at home. They're looking for things to do. They can do things constructively and productively on the home. And that's a big help. But there's also a reconnection with the home as an epicenter of, you know, one's existence, at least for the time being. And I think it's going to continue on. And the garden as well. And that I mentioned the outdoor business growth. I mean, that's just spectacular in terms of people spending time investing in their lawns and in their gardens.
And Jim, our very own Julie Hyman, her morning starts in many respects with very loud gas-powered leaf blowers outside of her window in New Jersey. Where is this industry at in terms of turning power tools into electric?
Well, it's, you know, for the handheld stuff, you know, the hedge trimmers and the clippers and those types of things, it's well underway. I mean, we're talking, you know, 35, 40% or more. For the items with wheels like riding mowers and push mowers and those types of things, it is, you know, nominal. There's almost no penetration of electric. And we, Stanley Black & Decker, are going to be the company that electrifies the lawn and garden market. We're buying, we have an 80%, an option to acquire the remaining 80% of a company called MTD, which is an Ohio company, one of the big lawn and garden equipment manufacturers that serves retail and the pro. And we're going to take our knowledge of motor technology, battery technology, and controls, and their knowledge of how you produce those types of units, those big, large riding mowers and push mowers, and we're going to combine them. We'll be executing this option most likely in July, August, and we'll own 100% of this company. It's about a $3 billion company, and then we're off to the races. We're gonna make it happen.
All right, so there is hope for our very own Julie Hyman. Jim, before we let you go, how is the chip shortage impacting what you do?
Well, there's a number of shortages that we're dealing with. The first one was battery cells, and we've solved that problem. And the chip shortage, where we're at with that is it's not constraining us at this point at all. But if we start to get to a point where we're a couple $100 million more of growth per quarter, it's going to be challenging. So we're really working on that. But right now we can go at this run rate and a couple $100 million more of revenue at the run rate before we start to get impacted. So I think we're in good shape for the remainder of this year, and we're working on solving 2022 right now, assuming that this red hot growth continues in the industry.
All right, we'll leave it there. Stanley Black & Decker CEO Jim Loree, always good to see you. Stay safe. Have a great weekend.
Great to see you, to all of you. Thank you. Take care.
All right, from the future of electric power tools to the future of Greek yogurt, Chobani President Peter McGinnis stops by to share what the yogurt giant is cooking up next.
the past year, a lot of people stuck at home have been eating an awful lot of yogurt. Let's talk about that and the dynamics of the business with Peter McGinnis. He's president and chief operating officer at Chobani, of course, one of the biggest yogurt brands. Peter, I first want to talk to you about a theme that we've been talking about with a lot of our guests recently, and that has to do with input costs and the inflation that we're seeing in a lot of commodities. And I know at Chobani, you guys are really focused on keeping your products affordable. So how are you sort of digesting, if you will, increased milk costs, increased labor costs that we're seeing really across industries while still keeping a lid on prices?
Yeah, I mean, we're seeing inflation like many and most companies are throughout the US and globally. A lot of the inflation we're seeing, if you look at resin and distribution logistics, specifically trucks and truck drivers, we think are temporary. And demand has been so high for our creamer business and oat milk business and yogurt business that we've been able to absorb all of that. To be honest with you, and we have not passed any of that on to the consumer because accessibility and better food for more people has been paramount to the company. And we do see we think a lot of this is temporary. It's not going to be long term. And then on the labor market's tight. There's a lot of competition for labor as the economy opens up. But we've taken care of our employees, and that's been that age-old debate: is that been an expense or an investment? And so childcare subsidies and special bonuses and paying people to get vaccinated and raising 15 minimum many months ago to an average of 19, we have a healthy, productive, happy workforce. So our retention is high. So while that is a macro problem, we've weathered and fared better than most. And so, in terms of our employees and in terms of our labor, we're in good shape.
Yeah, that's especially interesting because yesterday we heard from Pilgrim's Pride, which is a big chicken processor, of course, saying they were having trouble finding people. Yeah, they were having trouble finding people, though, particularly because people were getting stimulus checks, and that was sort of a competition for them. Are you guys expanding your workforce right now? Are you hiring more people? And are you seeing any of that?
We are hiring right now. We continue to hire because we're breaking into new categories. So as we got into oat milk 14 months ago, we basically built another plant within a plant. And that business is expanding, and our creamer business is expanding. And we just launched ready to drink cold brew coffee, which is a whole nother category. I mean, a year ago, we were in one category, yogurt, and now we're in 4. And so with the expansion into these new growth categories comes innovation and comes the need to add to our workforce. So we're currently hiring. And like I said, we are good on the labor front because long since Hamdi started this company, we've taken care of our employees. That's kind of embedded in our DNA and culture. And that has been an expense historically. But we always said it's good business to take care of your employees because they're more productive and you have higher retention and lower attrition. And so as a result and consequence of that deliberate action of taking care of our employees and supporting them, we have high retention. And since the brand is strong and growing and liked, we do really well on the recruiting front. So we don't have any issues on the labor front at all right now.
Peter, I remember sitting inside a Chobani cafe with you in 2015 when we were talking about a potential IPO. Chobani, it's still not public. What are your current thinking on a potential on an IPO, and why no IPO yet?
Brian, I've known you for years. Nice try. I'm not going to talk about the IPO today. I don't blame you for trying, but I'm not going to talk about the IPO today.
So let's talk about sales then for just a second. You talked about how you were seeing higher demand for your products and that you've got this expanded suite of products. So IPO or no IPO, you guys are focusing on growing. What do the sales look like right now? And what do you see the growth trajectory like as we start to open back up, come out of the pandemic, maybe people eating out, not eating as much yogurt at home?
Yeah, and like a lot of our products are on the go and at home. So we have a lot of drinks as well, probiotic beverages, yogurt beverages. We have within oat milk, we have barista, big barista business. So that's at cafes. So we're very bullish on the back half of the year. We had a very strong 2020. Q1 was very strong, top line growth across all of our business units. The best thing is that our core yogurt business is growing. Even the original products from 13 years ago, our core yogurt cup is growing. And then of course our flip, craveable, indulgent, better for you snack is growing double digits, which it's great to see that as Americans look for healthier snacks. But even our drinks, our core yogurt drinks are growing, and we launched Complete. So the yogurt business is growing at a rapid clip in a very strong way. In addition to oat milks, that category is growing triple digits. We're growing ahead of the category. And then when you go into the creamer business, growing 20, 25%, we're growing 4 to 5x that. And then we just recently got into RTD coffee, and that's off to a great start. So growth across all business units, but growth in our core business as well. So it's not like we're innovating out of a base or core decline. And so we see that continuing. We think Americans have formed healthier habits when it comes to snacking, and we have new baselines of growth. We lapped last March, and last March was a massive panic buying, surge buying that we all know, because there's a new baseline, and healthy habits have been formed with consumers as they look and desire healthier snacks.
Well, we definitely have some fans on our staff here, Peter. Great to catch up with you. We'll keep at it on the IPO questions. Don't worry, President and Chief Operating Officer at Chobani.
I know you will, Julie.
Take care of yourself, Peter. We'll check in soon. You too. Coming up next, we'll talk about where there is a labor shortage. It's in restaurants.
right, welcome back to Yahoo Finance Live, wrapping up a very busy week for earnings. And Sazi, one thing that has certainly stood out, we've asked pretty much every executive we've had on the program about, is where their labor costs are headed over the next year. And we heard from Jose Sill earlier today about the pressures they're seeing in the restaurant business.
Yeah, labor inflation in the restaurant space, Miles and Julie, is very much here. And it's not just the $15 an hour wage debate. It's, can restaurants find human beings to come back into the restaurants and work to service the demand they are now seeing as economies open? But here's what Restaurant Brands CEO Jose Sill had to say on the topic of labor inflation.
There are moments in time when it becomes a little more complicated and challenging. I think we may be in one of those moments, but our teams are doing a great job. Our franchisees do a fantastic job of creating hiring events and hiring parties and creating excitement and awareness for the need for talent in the restaurants, but more importantly, the type of culture and the type of exciting opportunities that exist in the restaurant business.
And also in that moment is McDonald's. McDonald's CEO calling out labor inflation this week in his earnings call. Also, Domino's Pizza CFO Stu Levy saying they are also seeing labor inflation as well. And if you invest in restaurant stocks, you really have to take a step back and say, hey, can profit margins be good this year? Sure, you're seeing sales come back hard, but the costs of doing business are starting to go through the roof.
They are, but I would say on the wage front here, I mean, fast food has really been the last bastion of bottom wages, right? We have seen Target, we've seen Walmart, we've seen all the big box retailers raise their wages. Maybe it's high time that fast food gets with the program.
Seems like we're going to find out one way or another as we come into a recovery where we're not going to have the meme from the last time of PhDs working at Starbucks, right? Labor is in short supply, and we're going to find out just how much pricing power labor does indeed have. All right, for Julie and Brian, that's going to do it for us here in the 9 to 11 block this week. Markets under some pressure here as we head into the late morning trading session here. Zach Guzman and Kiko Fujita have you for the next couple of hours here on Yahoo Finance Live. Three of us. See you back here Monday morning, 9 o'clock Eastern.
Welcome to Yahoo Finance Live. I'm Akiko Fujita, along with Zach Guzman on this Friday. And we are seeing blockbuster earnings from Amazon failing to lift the broader market. You see the red arrows across the board there. The S&P 500 and the NASDAQ retreating from those record highs we saw yesterday, while the Dow right now is trading down more than 220 points. Stimulus checks fuel a surge in U.S. household income. The 21% pop in March, the largest increase on record. Ransomware epidemic. Washington calls for tighter regulations in the crypto space as cyber criminals threaten to derail growth. We're talking to the chief security officer from Coinbase later in the show. And momentum on tap for Molson Coors. CEO Gavin Hattersley joins us on the back of the company's earnings surprise to discuss what's ahead for the beverage firm. But let's begin with those big earnings that we got out after the bell yesterday. Amazon posting a 44% increase in sales in the quarter, proving the pandemic run they've seen is not going to end anytime soon, at least for now. Earnings per share came in at $15.79 on revenue of $108.5 billion. The company saying it expects revenue to come in between 110 and 116 billion in the current quarter. Let's bring in Ron Josie, JMP Securities Senior Internet Analyst. Ron, I'm going to flip the question here first because we always talk about the strength for Amazon. What were the holes that you saw in the earnings that came out yesterday?
You know, Akiko, was such a strong quarterly report. It's hard to talk holes. Let's see, maybe you can talk, well, let me talk about the pros and then we can get into holes if there are any. So as you mentioned, revenue came in much better than expected. Most importantly, though, aside from the financials, what we're really focused on here, their Prime members are shopping more frequently and doing so across category, which talks about just a lasting overall demand cycle that could continue for some time. And there's now 200 million Prime members. The second key point that we wanted to highlight is just AWS growth is reaccelerating. And third, talking about the positives, I know you talked about negatives here, but the positives here is that profitability was very strong, particularly in Europe. And typically we would answer the question, Akiko, well, we'd like to see more profitability. We'd like to see sort of a lot of this growth fall to the bottom line. But we saw that this quarter as all of the infrastructure buildup that Amazon's been doing for years upon years is finally showing up in terms of fixed cost leverage. So it's when you think about holes, it's hard to sort of pinpoint one thing because in this case, it seems as if the pandemic-related surge should continue going forward as just wallet share of retail spend, not only here in the US, but across the world is growing. And that's something that can continue.
It's always a good sign when you struggle to find holes here. So that's another good sign for Amazon. But digging further into it, I guess, comps obviously moving forward in the pandemic going to be tough here. Talking about Amazon and the strength of e-commerce in the next quarter, seems like it would be tough. Even there, they filled that hole. They're talking about Prime Day being in Q2, so that could be another big boost here. But how do comps look? Because obviously, the longer this goes on, it's going to be difficult for Amazon to keep this up. And that seems to be the overhang, too. If you could pull one thing out from the earnings week this week, it looks like that might be difficult. But how's Amazon shaping up for that?
Yeah, no, it's a good question. I'd like to believe we have that in our models. And when we did our model, we assumed Prime Day was going to be in 3Q like it was for the past several years, X last year. So we actually moved numbers around and brought, Prime Day up in 2Q and then brought our 3Q numbers down. Comps are comps. I think they're baked into what we're expecting. I think you're right in terms of broader growth questions that maybe arise. But when we take a step back and we think, okay, e-commerce grew, call it mid-30s in 2020, maybe grows 20 plus, maybe gets back to the 15 to 20% plus cadence this year and going forward. To have Amazon consistently deliver growth that's at or above industry levels suggests that they're not only maintaining their share, they're also growing their share. So you're right that comps get tougher. I don't think that's a necessarily bad thing. I'd like to believe we've incorporated that in our model, but that's why, when we started coming on here and we kicked off some of the positives, highlighting just frequency, usage, and cross-categorization, meaning people are buying more often and more things across different categories. That's what's driving just continued growth as we think about the next year plus and really long term of the company.
And Ron, we heard from the company yesterday saying they're going to raise wages for about 500,000 of their workers. Certainly the company's been under some pressure about the working conditions, the benefits, especially at the fulfillment center. How big of a headwind do you think that's going to be moving forward?
Yeah, I think they talked about $1 billion worth of overall costs. And what's even more fascinating in terms of a headwind, their operating income for this past quarter beat the high end of their guidance by about $2 billion. And when you look at why, international was a big driver of that, as was the domestic US. And so getting back to the comment around leveraging their fixed cost build out of infrastructure that they have, and frankly, that's a huge benefit that Amazon has, and it's going to be very hard for anyone to catch up. I think there's a lot of leverage that can continue. And when we think about salaries and wages and everything else, that's something that Amazon has to do. And frankly, they do it for multiple reasons. One is you and I need to get our packages, right? And same day is going to be more of a normalized thing. But then also, it's a great place to work. And you saw that within their metrics as well. And frankly, they need to continue to attract their users if they can get to the growth rates that they're talking about and that we're expecting. So frankly, it's a cost of doing business, but it's a good cost because it drives the overall flywheel in terms of improving employee satisfaction.
Yeah, Ron, I know we want to get to Twitter to follow on this in just a second, but real quick before we shift from Amazon, you got a price target. You upped it to $4,500 a share. Obviously, we're sitting here at all-time highs. So, I mean, if you had to name one driver that you'd be most confident in to hit that price target of $4,500, what would it be?
I'll give you two. I think it's continued growth overall. So your question on like comps, and then frankly, I think profitability likely becomes better every single quarter than what we're looking for and what the street's looking for.
Ron, let's talk about another stock in the tech space, Twitter, down nearly 14% right now. The company warned of rising expenses, a slowdown in user growth, but they did post an ad revenue growth of 32% year on year. Total engagement was up as well. How much of the moves we're seeing in the market today you think are justified, or is this a bit of an overreaction?
Yeah, I mean, it's sort of interesting, right? We just got off of listening to Snap and Facebook and Google in the past week or so, and others for sure, Pinterest in the ad space, and what we're seeing is an incredibly strong advertising environment as more ad dollars shift online because that's where the eyeballs are. From a Twitter perspective, and we've been saying this forever, they're more of a brand specific purchase, and their goal going forward is to be more balance between brand and direct response. It's going to take time to get there. They had their analyst day a few weeks back, I think late February, early March, and they gave mile markers the next several years of $7.5 billion in revenue, and that's where they're marching to. I think the move today likely just, we came off of listening to phenomenal results at Snap and Google and Facebook and others, and I think just expectations probably got a little bit ahead of themselves.
Ron Josie, GMP Securities Senior Internet Analyst. It's good to talk to you on this Friday. Thanks so much for your time.
Thank you, Kiko. Thank you.
Turning our attention to Molson Coors now, the company posting an upside surprise in its latest quarterly report, beating on the top and bottom lines. Revenue came in at $2.2 billion in the period. Net sales, though, did decrease about 9.7% on a reported basis. Let's bring in Gavin Hattersley, Molson Coors CEO. We've also got Brian Sozzi joining in on the conversation. Gavin, it's great to talk to you today. You highlighted a number of challenges in the quarter, one of them being the outage that we saw over in Texas, but also some cybersecurity incidents. How confident are you that some of those headwinds are contained in this quarter and the momentum can pick up in the path ahead?
Well, good morning, and thanks very much for having me on. Yes, as tough as the first quarter was with some of the factors that were thrown at us, we were very pleased with the progress that we made against our revitalization plan. We launched new innovation with Topo Chico in 16 markets. Our new brand, Blue Moon Light Sky, that we launched last year, continues to do extremely well for us. Coors Light actually had its best performance from an overall segment point of view in 4 years. The UK market has started to open up in the second quarter, which is really helpful for us from an on-premise point of view. And we feel good about our prospects for the rest of the year, and that gave us the confidence to reaffirm the guidance that we issued earlier in the first quarter.
Gavin, I want to lock in on your ambitions in the energy drink space. You recently inked a deal with The Rock for his ZOA energy drink, and I'm seeing more of that drink appear in my local grocery stores. How big a brand do you think that can be this year?
Well, as you know, Brian, the energy drink space is massive, and our partnership with The Rock is tremendous. He's not just a celebrity endorsement. He's a partner with us in this venture, and the ZOA is just starting to hit the stores. We just had our first order from our distributors, and it was significantly more than we expected. And it's a big market, $16 billion market in the United States, and we think we can get a meaningful share of that.
Gavin, when we look at the seltzer side of the business, obviously you guys are talking about Topo Chico here, but also Vizzy, a big piece of the business. We also heard from Boston Beer Company earlier in the week and the way that they've been able to grow their share of the category, truly now to 28% of the seltzer category. What are you seeing in terms of Vizzy adoption and how it maybe differentiates itself from the other seltzers, and what you expect to see in the coming quarters for growth there?
Well, Vizzy's been a real success for us. We launched it in April last year with essentially one SKU and one variety pack, and picked up 3 points of market share in the seltzer space by the end of the year. And we've extended into a variety pack number 2. We've launched a Vizzy lemonade, which is now the second fastest turning lemonade in the market, which is just tremendous given that it's only been in the market for a couple of weeks. And the combination of Vizzy and Topo Chico has increased our seltzer share by more than 50%. So, we have a goal out there to get to 10 share of the seltzer market by the end of this year. And combination of those two with Proof Point and Coors Seltzers got us close to a 7 share already. So we've got a lot of innovation coming behind Vizzy and behind Topo Chico and Proof Point in the balance of the year. So feeling very good about our offerings in this space. I said in the call yesterday that Vizzy had a record week last week for us, so we're pretty excited about it.
And Gavin, I recently asked Coke's CEO James Quincy about the response to the Topo Chico launch. You're working in partnership with that. He said it has started well in Texas, so that's good, I'm sure. But what does the distribution plans look like for that brand this year?
Well, we've had a spectacular start to Topo Chico, and it's not just Texas. It's Southern California, it's New Mexico. We've launched in 16 markets. I think it's 7 states and 9 big metro areas. And we think that this, based on its response that it's received in its early days, that this has national potential. But we're certainly going to focus in on those 16 markets that we've launched in at this point in time. We're working hard to increase the supply for Topo Chico, but the demand from the retailers and from the consumers, and excitingly from on-premise as well, has been very strong for Topo Chico. So we're excited about that one too.
Gavin, give me a sense of what you're seeing from a macro standpoint. You certainly have a good pulse on a lot of these restaurants, bars reopening, seeing the activity picking up too. What are you seeing, and to what extent has the business from before the pandemic returned?
Well, I'll give you one example overseas. In the UK, bars and restaurants opened, I think it was on the 12th of April, and it is the pent-up demand from consumers is very strong. I mean, it's outdoor dining only in the UK at the moment, and our performance in the 30 to 40% of the outlets that have opened for on-premise dining has been higher than it was in pre-pandemic levels. So I think there's a strong desire for consumers to get back to what they were doing before the pandemic. And it's more spotty in the United States, depending on how the market has opened up. But where it has opened up meaningfully, we're seeing strong performance in the on-premise. Consumers are going back to brands that they know and trust, and that certainly helped us from a Miller Lite, Coors Light, Blue Moon point of view in the US, and Carling in the UK. So there's a lot of pent-up demand there.
Yeah, one slide certainly piqued my interest on your earnings day, and I'm sure the interest of a lot of longer-term investors. You are looking to reinstate the dividend in the back half of the year. How much are you looking to bring back in terms of a dividend payment?
Well, look, we are working with our board on that, and we've said now several times over the last 3 months that based on the work we've done with our revitalization plan, the way we're coming out of the pandemic, we do think our board will be in a position to reinstate a dividend. Haven't finalized the quantum of that yet, though.
All right, well, clearly a lot. Appreciate you weighing in on all that stuff with us here today, and impressive results there. Molson Coors CEO Gavin Hattersley alongside Yahoo Finance's Brian Stasi. Appreciate you both for the conversation there. I want to shift over to another company we're watching here on the earnings front. That would be Clorox. We're seeing shares fall in today's session after the company gave investors the update around the latest quarter, and interesting to see the way that costs are starting to rise for that company, particularly when it comes to logistics and shipping. Of course, they saw quite a boost in the pandemic, but that coming back to hit them in terms of logistics, saying that they saw decreased margins, at least when you look at it. The first time we've seen the company report margin contraction in 10 quarters due to rising logistic costs in the pandemic. Overall, though, we did see a top-line miss, too. Revenue coming in flat at $1.78 billion versus the $1.86 billion analysts were expecting. Of course, this is one of those companies that a lot of people have been expecting more growth from due to the way we've seen the rise in purchases when it comes to cleaning products. Clorox shares, though, off by about 3% today. Coming up, we're going to be digging deeper into earnings season here as we look at maybe some of the overlooked sectors. Despite being the strongest performer here year to date, energy continually overlooked by a lot of investors. We'll dig into the way that Chevron might be worth a second look with our next guest on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live as earnings season rolls on and Amazon impresses with their results. Maybe it's worth comparing the way that we've seen some of the mega tech companies start to advance here in relation to the cyclical rotation that we've been seeing play out over the last few months, of course, sparked by the moves that we've seen in yields in the 10-year. So breaking it all down for us, I want to bring on our next guest here, Victoria Green, G Squared Private Wealth Chief Investment Officer, joins us right now. And Victoria, I mean, it's been impressive, the earnings that we got this week from the big tech companies. And we've seen some of those rewarded, maybe some less so. But talk to me about where you put us here in that rotation as they continue to impress.
Yeah, so you've really seen a lot. I mean, look at Apple was just record smashing, and I don't know how they had that much profits. I didn't even buy a new iPhone this quarter. So, but apparently everybody else did. You know, Apple and MacBooks and all of the sales were fantastic, but they didn't get rewarded. Amazon's barely getting rewarded. You know, Facebook got a little bit of reward for fantastic sales, but you look around and you got to wonder how long they can keep up this pace. The market seems to be saying that's all well and good, but what are you going to do for me going forward? Is the chip shortage going to hurt Apple? What's Facebook going to do with privacy? You know, and with Amazon, I don't know how you could get much better results than that. And obviously, it's still very well loved on the street, most people raising their price targets, and yet you've really not seen a huge return today, even after blowout earnings. I think that just shows a little bit of fatigue on the growth side. And, you know, we've been telling people to be a little wary of the FANGs and the big tech, you know, and we are a proponent of the value rotation. And I think you have to look at this and say, going forward, can they actually increase their pace of earnings beats, or is this maybe going to be the topping out at some point? And I think that's a valid question to ask.
Or Victoria, is the flip side that the expectations just ran up way too high. If you look at some of these numbers we've gotten from a Facebook or an Apple, I mean, it seems to point to the momentum continuing. And yet, to your point, we're not seeing the stock necessarily get rewarded. I wonder what that says in terms of how you would look at these individual stocks and the potential for those stocks to move, not necessarily the business case.
Sure. And I think the thing you have to look at is the pace of growth, right? Can they continue to increase the pace of growth? They're going to continue to be growth stocks, but I think investors are starting to question, can they really keep up this transformative growth they've had? And obviously, Amazon and Apple and all these guys have really integrated into our lives, and I think the bulk of us obviously use them. You can see that from their earnings. But is the pace of earnings going to be really able to keep up with this growth? I'm not sure about that. And so we look at that and say it's not bad to be a little bit of a profit taker. You know, you've got to have profits in these stocks by now and be looking for something maybe with a little bit more upside. I'm not calling for the death of the FANG stocks at all. I think they're fantastic stocks. But at the same point, maybe there's some cheaper opportunities across the market with more upside, because at some point you just have to step back and say, wow, can they really keep up this pace of expansion? And that's going to be hard to do.
Let's talk a little bit more about those cheaper opportunities out there, because even despite the fact that energy has been the best performing sector in the S&P 500, interesting to see one of the picks that you got, Chevron, on the list here. And that's a company, I mean, the stock's been flat basically for the last 5 years, but we keep hearing about this super cycle in the price of oil. Goldman Sachs still predicting about $80 a barrel by the summer. If that were to play out, I mean, I imagine it would be quite some upside here still for Chevron. So talk to me about that thesis and where you see energy going.
Yeah, and Chevron disappointed a little bit, I think mostly on their buyback news, and people are very impatient, and I think they wanted to get more clarification on when share buybacks would start, and they waffled a little bit there. They wouldn't give an exact date. You know, I think they're interested in starting. I mean, they had great cash flow, record cash flow since the pandemic started. They're raising their dividend 5 cents. You know, they've got a lot of things to love. They snapped up Noble last year for steel, you know, and that is fantastic Permian acreage. So you have to look at them being very well positioned to benefit from oil, hopefully more normalizing in the 60s and 80s. And I may not be quoting this 100% correctly, but I believe for every $1 increase in the price of oil, that's about a $50 million increase to Chevron on its cash flows, and it's hugely impactful because of the acreage they have in Colorado and in the Permian. And they've got to be looking around and liking where they sit. You know, and I think you have to look at them and their balance sheet, and there's a lot to love. And I do think at some point they will start with share buybacks. But look across the energy sector, you had a bunch of beats. Exxon, profitable, surprised everybody. You know, BP, Total, Shell, all of the big guys, they have good things to say and they had good earnings. And so you look around here and say, what is cheaper and what has upside? And you got to like the energy market right now.
Another one of your stock picks, IBM, which you say is a rare value tech stock. What do you see that you like?
Yeah, nobody loves Big Blue, and I've been talking about IBM now for a year or two, and I think I've been laughed out of the room a few times, but it is a stock I really like. It trades at like a 14, 15 time PE. It has a 5% dividend. It has a new transformative CEO. He just got started last year, and they're really moving this company forward in a brand new direction. Don't underestimate IBM's ability to reinvent itself. Remember, it kind of saw the death of the PC business coming a little bit, spun that off to the Lenovo, came more about the services, and now they're spinning off services and looking more at the hybrid cloud and the AI side. And they have a huge lead in the AI side. You know, Watson's been around forever, ever since it was the first person to beat a human grandmaster at chess back in, I think, the 90s. They've been working on AI, and AI coming forward in the healthcare business and AI coming forward in how people run their business is going to be a huge opportunity. But remember, if you're a company and now all of a sudden you want to use AI for analytics or growth or logistics, it's not necessarily intuitive how to set it up in your company. And IBM has a lot of experience helping companies actually integrate AI to make the new company more successful.
It may not be a popular pick, Victoria, but I applaud the conviction there. Victoria Green, G Squared Private Wealth Chief Investment Officer. Coming up, the EU cracks down on Apple, why the European Commission says Apple abused its dominance in the marketplace. Plus, a religious celebration turns deadly in Israel. That's coming up in our Worldview. Northern Israel, the first mass religious gathering held since Israel lifted COVID-19 restrictions. Reports estimate roughly 100,000 ultra-Orthodox Jews had gathered to celebrate Lag BaOmer when a crowd began piling into a narrow passage leading many to fall on top of each other. The incident marks one of the country's deadliest civilian disasters, and Prime Minister Benjamin Netanyahu has called for a national day of mourning on Sunday. Brazil has reached a grim milestone in the pandemic, with the country's death toll passing 400,000. That puts the country just behind the U.S. as the deadliest nation. More Brazilians have died from the virus in the first 4 months of this year than all of last year. Health officials have blamed a local variant and President Jair Bolsonaro's handling of the health crisis for the deadly spread. In a video message, Bolsonaro acknowledged the milestone but repeated his opposition to social distancing measures. Less than 7% of the population has been vaccinated so far. And several states in India say they have run out of COVID-19 vaccines, even as the country prepares to expand its vaccination drive. India is set to begin vaccinating all adults this weekend, but the world's biggest producer of vaccines says it doesn't have enough stockpiled to keep up with the demand. The infections surged to another daily record on Friday, with more than 386,000 new cases reported. The number of deaths jumped by 3,500. Just 9% of the population has received a vaccine dose so far.
Let's check in on the action across the pond, because a lot of headlines to discuss there today, including accusations from European regulators that Apple used App Store rules to hamstring rival music streaming competitors. And for more on that, I want to bring on Yahoo Finance's Latoya Harding, who has the details for us today. Latoya?
Yeah, that's right. The EU has charged Apple with breaking antitrust law, and it stems from a Spotify complaint back in 2019, which said that the tech giant abused its control over the distribution of music streaming apps. The European Commission said its preliminary conclusion was that Apple's rules did distort competition in the market by raising costs for rival music streaming app developers. It said that Apple abused its dominant position and that it has a monopoly in the market and that its power cannot go Apple. The first is the mandatory use of Apple's own in-app purchase system to buy digital content. So Apple charges a 30% commission fee for all purchases. And the second is that Apple limited the ability of app developers to inform Apple users of cheaper alternatives. So Apple will have the chance to argue its case before the EC reaches a decision. But if found guilty, it does face a fine of up to 10% of its annual revenue and be forced to adjust its business practices. Of course, the company can also appeal any decision in court.
And interestingly, shifting away from Apple to the vaccine front, we got the update from AstraZeneca and how their vaccine has actually weighed on profits, that costs there are exceeding the revenues they've been able to bring in. We knew going into this, they said that they weren't going to try and profit off the vaccine, which is a break from some of the other companies developing these, including Moderna and Pfizer. But how big of a drag are we talking here when it comes to trying to play their part in the pandemic?
Yeah, well, that's right. I mean, the company, again, did confirm that it wouldn't make a profit from the jab itself, but COVID vaccines did contribute up to $275 million in sales, AstraZeneca said today. And Astra was leading the FTSE 100 today throughout the session, closing 5% higher in London. And of course, it had better than expected first results in terms of its revenue. Revenue rose 15% to $7.32 billion in the first few months of the year, again beating estimates of $6.9 billion. And again, Astra reiterated its full-year guidance for core earnings, and this is the first time that the company as well has given any financial details from the distribution of its vaccine and the sales of its vaccine. But again, there was that confirmation today that it wouldn't actually make a profit from the jab, although it delivered in the first quarter approximately 68 million doses across the globe.
Yahoo Finance's Latoya Harding in London for us today. Thank you. Coming up, class is in session for Yahoo U. Brian Chung with a lesson on something that we talk a lot about on this show. That is market cap. That's coming up on the other side of the break. It is time for this week's lesson in Yahoo U. Today we are talking about market cap. And as always, Yahoo Finance's Brian Chung here to lead the class for us. Brian.
Well, Kiko, class is in session, and today we're talking about market caps. Now, I'm actually going to guess that most of our viewers already know what a market cap is, right? It's how big a company is. But what's fascinating about market caps is it also tells us something about the market itself. Wait, what? All right, well, let's take a step back first. So market capitalization is calculated as the stock price multiplied by the total number of outstanding shares. And you can easily find these figures on our Yahoo Finance site, shameless plug. So if a stock, for example, is, let's say, $20, right, and there are 1 million outstanding shares out there, again, sorry for my terrible handwriting, pretty easy calculation here. The market cap is going to be 20 times a million. That's $20 million. Now, of course, companies come in all market caps and all different types of shapes and sizes, and there's no SEC definition for this. So again, the definitions are going to depend on who you're asking broadly, but a large company is defined as those above $10 billion in market cap, whereas mid-size is going to be between 2 and 10 billion, and then small broadly is going to be between 300 million and $2 billion. Now, there's also kind of subgroups within these. So mega cap companies, which would be a subgroup of large, would be those above $200 billion, for example. And then anything that's smaller than $300 million might be referred to as a micro cap company. All right, so here's the question, though. When we talk about the market, right, when you see us on Yahoo Finance quote the S&P 500, who's covered in that, right? Is it just large? Is it large, medium? Is it large, medium, and small? Are there any small companies in there? Well, the range is pretty large, as you can imagine. And market cap, as I explained, will fluctuate day to day because of the stock prices. But as of earlier this week, the largest cap stock in the S&P 500 by weighting was Apple. And their market cap's about $2.2 trillion. So that not only makes them a mega cap, that makes them like a mega cap company. Now, the smallest stock, for example, that's weighted in the S&P 500 is a company called Holly Frontier Corporation. It's a petroleum refiner that's based in Texas, and their market cap only $5.6 billion. That's about 400 times smaller than Apple. So again, that means that Holly Frontier is actually mid. Well, it's the mid of the mid, right? Again, between $2 and $10 billion, which means that there are no small caps covered in the S&P 500. So the question is, where might we see some small caps? And for that, we have to zoom beyond the S&P 500, which is why we have something called the Russells. And the Frank Russell Company came up with this in the 1980s, and the Russell 3000 is not a wrapper. It's the universe of the 3,000 largest U.S. traded stocks. So this is going to include a lot of smaller companies, but also the bigger fish like Apple. So let's say, for example, you lined up all the companies from smallest to largest. Again, the largest 1,000 companies would be covered under Russell. The smaller 2,000 companies after that would be in the Russell 2000. So if you want to see how small caps are doing, you're going to look at the Russell 2000, which is just those small cap companies. Now, of course, by definition, it's, of course, the large stocks that are the major market movers. And that's why when we talk about the market on our programs and we look at the Dow or the S&P 500, that's a pretty good proxy for those large companies. But again, it doesn't cover those smaller microcap companies, which could have a completely different growth potential. It's something very important for investors to keep in mind when they look at the market, but also try to cherry pick the stocks that they own. And that is this week's Yahoo U.
I challenge you to find a Fed reporter out there who can make an Andre 3000 joke as flawlessly as Brian Chung just did. God's gift to the market. Brian, appreciate it. We'll check back in with you later on in the show. We're going to take a quick break here on Yahoo Finance Live, but when we return, digging into security concerns when it comes to crypto and what people might overlook there when it comes to Coinbase. We'll be chatting with Coinbase's chief security officer about the way that they've stepped up security there as it becomes an issue that more people are talking about. We'll chat with him right after this. Stay with us. Welcome back to Yahoo Finance Live. In this week's Crypto Corner, the dust has settled since crypto exchange Coinbase made its public debut earlier this month with their direct listing. The stock's traded slightly lower as analysts have come on to this program with price targets at $500, $550, even $600 a share. But one point they've all returned to has been maybe one of the most overlooked value props that Coinbase brings to the table in their eyes, which would be custody and security in a space that's rife with examples of big crypto hacks when it comes to centralized exchanges. So how has Coinbase been able to build up its security fortress, and what should new adopters in the crypto space know about the threats that may be mounting behind the scenes? Well, here to break that down for us is Coinbase Chief Security Officer Philip Martin. And Philip, appreciate you coming on here to chat, man. There's a lot of misconceptions, I think, about when it comes to hacks in the crypto space, because people might think about Mt. Gox and what happened there with kind of centralized hacks of platforms. But it seems like the same concerns that might hit your bank account and password hacks and logging into individual accounts are kind of the same there. So talk to me about what you see and what people should know.
Yeah, and thanks for that introduction. I think that's actually the most important message that I have today, is that a lot of the same risks that consumers deal with in their online lives over the rest of the services they use are also present in cryptocurrency. I think the two most important things to tell consumers here is that, or to remind them of, is number one, scams exist in cryptocurrency just like they exist everywhere else in the world. If it's too good to be true, it probably is. And two is some basic hygiene measures can really improve your own personal security, both in cryptocurrency and broadly across your sort of internet service portfolio. That is, very, very briefly, number one, use a password manager, right? Use unique passwords across every single website that you interact with, and a password manager can make that just super easy. And number two, use two-factor authentication. That is a situation where you have both a username and password and a second form of authentication, like a code in a text you get, which you should only use if that's your only option, or better would be a code from an app you use, or a hardware token like a YubiKey.
Yeah, and I mean, in the rare cases that we've heard of complaints from customers, when these things happen, when somehow, bad actors have been able to work around maybe things that are put in place like two-factor authentication, it's different than what we might see with banks and credit card fraud, because banks generally would return that. With crypto, obviously, irreversible transactions are interesting for that. So how does Coinbase maybe look at that piece of it and the role that they can play in maybe A, preventing some of these bad actors, but then also B, making customers whole, since it's a bit different than traditional banking?
Yeah, Zach, you're exactly right. The irreversible nature of transactions in cryptocurrency are really a key difference between the what happens post attack in traditional finance versus cryptocurrency. And in cryptocurrency, we spend, Coinbase in particular spends just a ton of time and effort and care building in pre-loss controls, detecting when bad things are happening and stopping them from happening once they happen, right? And I think we're very, very focused on ensuring that not only are we stopping bad things from happening, but we're also working with our partners across the crypto economy to say, hey, look, if these funds have left Coinbase's platform and go to yours, these are the results of a crime, and we want them back. Right, so we're extremely active in building that kind of a community within cryptocurrency.
Philip, ransomware attacks getting a lot of attention from the government right now when you consider that about $350 million was collected last year, triple what it was the previous year. You've got a government task force now looking at how to regulate this space. There's no question it's coming in some form. When you know the vulnerabilities and where they are, what do you think that regulation should look like?
Yeah, I think that's a really interesting question, Kiko. I think for ransomware in particular, there's some very interesting parallels you can draw to the development of traditional sort of kidnap for ransom activities that have been developing for, I assume, for hundreds of years. And I think that we can bring regulation to bear around minimum levels of security, or establishing standards for security. I think that's the right way for us to push. I think we push on the other side into trying to regulate the payment of ransoms, that's where we get into a very tricky area of incentives that I think is going to be a minefield to walk through.
What about looking at some of the regulations that we've seen in traditional exchanges? A lot of people look at KYC, for example, know your customer rules. Should that be extended to those like Coinbase?
So this is a very common misconception that we don't do that. We, in fact, are subject to the same AML KYC standards as any other bank. We're a member of FinCEN and around the world, right? We are both meeting standards in the US and every other country in which we operate and have fiat banking rails.
Lastly, I mean, when we look at the security issues here, obviously Coinbase has been pretty, protective, and they got a policy in place when it comes to adding assets to the platform. There are ones that haven't been added that are traded quite common. I would think about Dogecoin maybe being one of them. How does security play into maybe a piece of that decision? What do you look at when it comes to project-specific factors in adding assets to the platform?
Sure, that's such a great question. I obviously can't address any specific cryptocurrency, but generically, I think we look at what we call, from a security perspective, what we call custodiability, right? Which is the principle asking ourselves, when we receive one of whatever cryptocurrency this is, do we believe the cryptocurrency protocol is built such that we will be able to give one back to whichever customer gave it to us? And then not have something other than, so something in the underlying protocol prevent that or cause a loss related to the protocol. It's very, very in-depth, technical, hard work, and the team does a great job of making sure we're listing safe, secure assets.
Bill Martin, Coinbase Chief Security Officer, joining us from Sunnyvale today. Thanks so much for your time.
Thank you.
Coming up, shares of Twitter are getting punished in this session on the back of their earnings numbers. Miles Udland's going to walk us through those numbers on the other side of the break. Concerns about slowing user growth and rising expenses weighing on shares of Twitter in the session. That stock down more than 10%. Let's bring in Miles Udland for the latest on the price action there. Miles, we were talking about this earlier. Is there a case to be made that there's a bit of an overreaction in the market, given that these numbers weren't bad? Ad revenue was up 32% year on year. And sure, this was the first quarter where they removed President Trump. We heard from the company talking about some of the headwinds they experienced. But what did you take away from the numbers?
Yeah, so I think if you look at Twitter right now, so as you mentioned, Akiko, revenue growth pretty solid over the same quarter last year, 1.04 billion, so 28% on the overall top line. The company earned 8 cents per share. That was a little bit better, or 16 cents adjusted, a little bit better than the street was looking for. But the company got a number of questions on the call, and it was really right there. I believe it was the first question that management received from an analyst. And it was, basically, why are Facebook and Alphabet, which are significantly larger platforms than you, and I think Facebook is probably the more relevant comp in this situation, why is Facebook reporting advertising revenue growth up 46%, given their scale, when you are in a growth phase or trying to re-accelerate user growth? They're trying to grow that top of funnel, and they did see user growth pick up in the most recent quarter. And I think the problem, Nikiko, you mentioned Trump and some of the political stuff. I mean, on the call, Twitter talked about how the insurrection and the inauguration, both political events, are things that advertisers are just not interested in. They discussed, how George Floyd protests last spring hampered the second quarter. There was a huge surge in activity on the platform during the beginning of the pandemic, but those things are hard to monetize. And yet those are, of course, guys, right, the most important times to be on Twitter. And so I think the company is still stuck in that mode. I'm not really sure how they're going to get out of it, how they do get out of it from here. But right now, we all know the main use cases for Twitter, and the company continues to, note for the street that those are the hardest moments for the company to then go and monetize.
Yeah, Miles, I mean, just backing up and comparing it, right, to what we saw elsewhere from another advertising company that got absolutely spanked this week, which would be Pinterest. Saw a similar kind of 12% move to the downside after they reported. But it was a similar story. I mean, they impressed. It was 78% jump year over year in terms of revenue, but it was a user miss that I think people focused in on. But when it comes to Twitter, I mean, that stock hit all-time highs, right, when they were talking about subscriptions and new ways to monetize. So we didn't hear that so much on the earnings call. But if that thesis kind of sparked Twitter's moves higher, I imagine when it's put in place, it would deliver on what they're trying to do here. So, I mean, it sounds like maybe I would buy into, not sure if you would buy into this, but the overreaction here today is just people being kind of impatient with those plans that they heard of before.
Well, look, the stock came public in 2013 and immediately traded to 70 something, whatever that record was. So, I mean, Jared Blickery can tell us about what happens when stocks get back to a 7-year resistance level, right, from a technical standpoint. And I think everyone wants Twitter to work. Everyone who invests with the company or anyone who is following the company is a heavy user, right? I think there's probably plenty of analysts out there who are covering Facebook and, let alone all types of other companies who are interacting with the product on a, somewhat regular basis. I can guarantee you that everyone who's covering Twitter, certainly all of us here producing this show, we're on Twitter all the time. So everybody sees the product front and center, and everyone says, this has to work. This should work. And, Zach, I think a lot of that price rally comes around the product development has gotten a lot faster. Spaces went from 0 to existing in the kind of time frame that would have taken maybe 18 months in the old Twitter world. So the company is changing its cadence around new product. I think the company has certainly been invigorated, by the involvement of Elliott. And I think, that the way they tweaked Jack's employment arrangement doesn't make it imminent that he's going to leave, but it certainly incentivizes him and the team to continue to iterate at this kind of a clip. But when you do have the stock trading up to a record and you basically show below best-in-class growth, because that's kind of what the quarter amounted to, the growth wasn't as good as Facebook, I think it makes sense that you see a little bit of this steam taken out. Not to mention, as I know you guys have discussed, all the hype around basically earnings across the board. If you don't have a huge beat, you might as well call it a miss in this environment.
Yeah, it's very true. They gotta expedite tapping subscriptions and getting revenue from one Miles Udland, I believe, on the platform is what they gotta do. But appreciate you coming on here to chat with us all things Twitter. We're going to take another break here on the show, but when we return, digging into not just the earnings beats that we saw here from Amazon, but the underlying economic data that shows a huge recovery for the month of March when it comes to spending out there. We'll dig into those details on the other side of the break. Stay with us. Welcome in to Yahoo Finance Live. I'm Zach Guzman alongside Akiko Fujita as we have all some of the gains we've seen this week on what has been a pretty strong week for earnings. Right now, we can see the Dow off by about 200 points, selling off a bit despite Amazon hitting new all-time highs after delivering the icing on the sweet, sweet cake that has been earnings beats all week. Why one investor says even with that, it might be time to take a second look at some small caps. Plus, ahead of tomorrow's Berkshire Hathaway shareholders meeting, a chat with one of Warren Buffett's favorite portfolio companies, Nebraska Furniture Mart chairman Irv Blumkin will join us to break down what it's like working with the Oracle of Omaha and following in that portfolio, and a shareholder vote to finally approve the merger between two Canadian cannabis giants, Tilray and Aurora, to become the largest cannabis company by revenue in the world. We'll break down that deal in detail later on in the show. But first, personal income surging by the most on record in the month of March. Consumer spending data also showing a rebound that was much stronger than expected, fueled in part by both literal and figurative shots in the arm with a 1-2 punch of vaccines and stimmy checks. And for more on that, I want to bring in Yahoo Finance's Brian Chung for more details on both those fronts. Brian?
Well, Zach, the figures from the Bureau of Economic Analysis showing that there could be a pretty strong snapback as that vaccine rollout does continue, as you mentioned. Personal income up 21%, disposable personal income up almost 24%. That made for a savings rate of about 27.6%. So people's income are going up. They were able to put more money in the bank, and that's maybe why we saw inflation rising. Core personal consumption expenditures, again, this is the Federal Reserve's key measure of inflation, rising 1.8% year over year. That's the highest reading that we've seen in this pandemic. So translation, inflation is here. We've heard from the likes of Morgan Stanley since that release this morning. They say that inflation, this measure, could peak as high as 2.6% in April and May. That would be interesting to see how the Federal Reserve responds, because keep in mind, the central bank's target is 2%. But at least for right now, it shows that there could be a lot of inflation coming later on in this spring and into the summer, guys.
And Brian, we also got consumer confidence certainly hitting a new high. What stood out to you there?
Yeah, I've been running around like a madman with all this economic data that's been coming out. But as you mentioned, the University of Michigan with a final reading on consumer sentiment, it came in at 88.3. That's up from the first reading that it had for the month of April. And that is higher than the March reading. You can see that chart ahead of you. That's the highest reading that we've had since the depths of the pandemic, although below where consumer sentiment was pre-pandemic. So this does show that consumers are getting more optimistic about the economy. It seems like the expectation is that this reading will continue to go higher. And when you pair that with the BEA statistics that I just laid out ahead of you in that first question, people's income going up, they have more savings in the bank, sentiment going up, that means that people could be much more confident to go out and buy not only goods, but also services. We saw ING earlier this morning saying that they would expect consumers to get a lot more bullish on booking plane tickets and going into leisure spending, which means that those services industries that have been so hard hit during the pandemic could be set up for a rebound very soon.
All right, Brian Chung, bringing us the latest there on the economic data front. Appreciate that. Want to turn back over to the markets, though, as we had Amazon earlier in the session hitting an all-time high off the back of very strong earnings, which has been the trend for a lot of the mega tech companies we've gotten updates from this week. But our next guest here is digging into opportunities potentially presenting themselves in small caps worth a second look. He says, let's bring him in. Hal Reynolds is Los Angeles Capital Chief Investment Officer. He joins us right now. And Hal, I mean, obviously, some of these results have been rather impressive, whether it's Alphabet, Facebook, Amazon, and now here in today's session. But talk to me about what you're seeing when it comes to relative valuations among the small caps.
Sure. Well, good afternoon. And, you know, we continue to like the small caps. Everyone knows they've had a great run since the March 23rd low last year, and they're up, 80, 90% globally. So not just in the US, but really around the world. But we continue to like them really on the heels of a lot of fundamental momentum in the market. So obviously the triple threat of, central banks being committed to low rates, the continued fiscal stimulus programs, which we think will continue to grow. And then, of course, on the whole, generally good vaccination news. But clearly, the consumer spending numbers are just enormous. And that being such a big part of, GDP and a big part of the success in the small cap sector. So we continue to like smaller stocks. Now, having said that, I will add we still like a handful of mega cap growth stocks. And so our core portfolios are overweighted in smaller companies, but we can continue to hold market, or in some names slightly higher than market weights in some of the largest mega caps.
So how do you break down some of the small cap names? What are particular sectors that you see real opportunities in?
Well, we really like the value side of the equation. For so long, really for most of the last 5 years, we've been on the growth side of the equation. Earnings have been driven by human capital. And we all know, of course, human capital really does drive things on the growth side. But, with obviously the improving economic numbers, you had 80% of companies, beating estimates in the first quarter. So really impressive numbers there. Profit margins are already above 2019 levels. I mean, that's how quick the recovery is. That, of course, has been the great surprise to me. But really, we like the value side of the equation. That's really where we are more than the growth side.
Yeah, when it comes to valuations, I mean, obviously, earnings, if you have the growth to show for it, you might not start to panic about valuations. But given what we saw kind of play out last month or a couple months ago when it came to the spike in yields and the 10-year, given that they could move higher here moving forward, I mean, are you kind of projecting maybe not a return to the same volatility we saw when it comes to some of those growth names and the sell-off that they got hit with when we did see yields start to spike?
There's no doubt if we continue to see inflation numbers in the next several months come in closer to 3%, and of course the central banks have said they're not going to respond immediately. They're shooting for 2. We heard from Chairman Powell that he thinks a lot of these are transitory effects and are short-lived. We'll see if it plays out that way. There's no doubt that growth stocks are vulnerable from a valuation standpoint to a steepening yield curve. They always have been. And so if real yields or inflation continue to pick up, and the Fed is committed, obviously, to low rates, say through year end, that's going to be hard on the valuations of growth companies. The good news is, oh, go ahead. I'm sorry.
You talked about the focus on some value names. You also see non-U.S. value stocks. How should our viewers be thinking about that?
Well, of course, generally the rest of the world lags the U.S. Let's put China aside. But in terms of the PAC Basin ex-China, looking at Europe, they lag us. Certainly in terms of looking at Europe, where the vaccination rollouts have been far slower, with the exception of the UK, they're clearly behind us. But we actually find European value stocks really poised to do well as they have more success in their vaccinations and as the healthcare outlook improves. So we like the valuations in Europe.
Hal Reynolds, Los Angeles Capital Chief Investment Officer. Good to talk to you today. Let's turn our attention to the oil patch. The big oil companies getting hit in this session. Chevron and Exxon now both down, with Chevron seeing the steepest losses, down about 3% there. This despite a recovery in oil prices and demand, helping both players return to profitability in the quarter. Exxon reported $2.7 billion in profit, while Chevron's profit came in a little lower at $1.4 billion. The results still far below pre-pandemic levels, but Chevron announcing it's raising its dividend by 4% in a sign of confidence in the recovery. And we should point out, energy is still the top performing sector on the S&P 500 so far this year. So some profit taking perhaps that's happening on the back of those numbers. Coming up, we've got our weekly tax time segment, taking a look at some of those increases in capital gains taxes proposed by President Biden, the impact that's likely to have to taxpayers. That discussion on the other side of the break. President Joe Biden doubling down on his proposal to increase taxes on the wealthiest Americans in his address to Congress this week. His American Families Plan seeks to raise $1.5 trillion on tax hikes for capital gains as well as ordinary income. He's also pushing to increase tax audits for those who are earning more than $400,000 a year. For a discussion on the implications there, let's bring in Rob Seltzer, Business Management. Rob, it's good to talk to you today. Let me just first ask you how realistic you think this is. When you look at all the structuring that needs to happen, obviously, I'm not going to have you weigh on the politics, but when we talk about an increase, ultimately, where do you anticipate it to fall?
Well, the politics, I think, are important because there's a very, it's a razor-thin majority in the Senate. So it's more of a wish list, and there's going to have to be some compromise there. I think that the ordinary income rate will go up, that from 37 to 39.6, but the capital gains, I would be surprised if it ends up being what he's wanting, because when you raise taxes too high, it's counterproductive in terms of raising revenue. So people would just hold on to items as opposed to selling them, which would defeat the purpose of trying to raise additional revenue. In addition, he needs to have everyone on board to make that happen. So I don't see the 39.6 affecting the millionaires, so to speak. It's somewhat misleading because it's not people who are making $1 million each year. It's I've had my home. I'm in Los Angeles, and to have $1 million capital gain on a piece of real estate is not unusual. And so you would be, quote unquote, a millionaire just for that year and then take a real big haircut. I think one thing that people can do to try to plan for this is, even if it's higher to some degree, is to do installment sales so that the gain is reflected over a period of years as opposed to, taking it in one fell swoop. And that's easier with blocks of stock than it is with real estate, where you have to structure the transaction accordingly.
For sure. And congrats, by the way, on the real estate appreciation out there. But when we look at maybe some of the other moves that people take when it comes to the wealthy around those things, I mean, deferring capital gains is something that the wealthy do very well. So I'm not sure which one of these seems most likely to actually have an impact when it comes to raising revenues. I mean, obviously, it seems like raising taxes when it comes to personal income going to probably be easier. Corporate tax rate, that'll come up. When it comes to capital gains, though, what are those loopholes that really need to be closed when it comes to the way that the wealthy, though they say they want to be taxed higher frequently in the media, the loopholes that they might use to avoid those things?
I think the installment sale is one way of doing it. One thing that people need to realize, at least with my clients and even with some of the wealthier ones, they've got millions of dollars in pension plans that will be rollover IRAs. That's all taxed as ordinary income upon the distributions. So there's the capital gains tax really doesn't affect that. It's only on the personal portfolios. But I think that people will try to do loss harvesting and be, people try to be tax efficient in managing their portfolio now. But I think it's even more critical if rates rise. And, I think they will. I think that the ordinary income rate has been there recently. So raising from 37 to 39.6 isn't a big push. I think that raising the corporate tax from 21% will happen. Will he get 28%? I don't know about that. It'll probably end up being a compromise, maybe 25. But
so Rob, if we're if there are those who are watching that could potentially fall within the tax bracket the president has proposed, what do you advise that they do?
If you're talking about ordinary income, the rates, trying to use it, if you have your own business and you have the ordinary income, then using a defined benefit pension plan is probably the most powerful way to shelter ordinary income. I have clients
In the
yes.
capital gains rate change, what are the strategies for that? What do you tell people to do as they look ahead to potential changes there?
I think if you can do do the installment sale, like I said before, because then you'll keep your AGI below the rate where it triggers, and by doing so, if you have, let's say you have a $1 million gain, and let's say 200 of it would not, put you into that higher level. You do an installment sale over 5 years, you avoid that tax. It's not a tax deferral, it's lowering the tax completely. So that's one way of doing it. And then trying to match the losses with the gains so that you can do loss harvesting to try to reduce your gains.
All right, Rob Seltzer, I might have to call you back and dig into some details here, but appreciate you talking bigger picture with us on today's show. Rob Seltzer at Seltzer Business Management, appreciate it. We're going to take a quick break here on Yahoo Finance Live, but when we return, just a day away from the Berkshire shareholders meeting, going to be digging into one of the companies that the Oracle of Omaha counts in his portfolio, and we'll chat with the chairman at Nebraska Furniture Mart right after this. Stay with us. Welcome back to Yahoo Finance Live. The much anticipated Berkshire shareholders meeting is upon us. And of course, as usual, Yahoo Finance has you covered with exclusive live coverage beginning at 12:30 Eastern Time on May 1st to cover more than 3 hours of Warren Buffett live and unfiltered. He's, of course, been running Berkshire for more than 55 years. And through those years, he's made some incredible deals, acquiring a number of companies, including our next guest company on a handshake deal back in 1983. That company, Nebraska Furniture Mart, has since blossomed into one of Buffett's favorite portfolio companies. And joining us now for more on that is Irv Blumkin, Nebraska Furniture Mart chairman. And Irv, appreciate you coming on here to chat with us today. I mean, it's been a while since that handshake deal happened with your grandma back then, but talk to me about how maybe the business has changed and what you've seen in this pandemic as more people try and brighten up their homes.
Well, for sure, we've had to pivot and reinvent processes, and the business continues to grow. We happen to be in a very great space in a terrible societal pandemic. But overall, we continue to grow. We can continue to pivot and try to adjust to meeting the customer's needs.
Irv, what specifically do you mean by that? How have you seen customer behavior change as a result of the pandemic?
Well, we closed for about 30 days, a little longer in other markets, and completely went online. People now check online to see if you have the inventory or the information sometimes before they come in the store. So there was a big, huge digital push, and we added services like same day, next day delivery, virtual shopping, live chat. And so I would say before the pandemic we had some of those, but not all of those, and we did what we had to do to make sure we serviced the customer the way they wanted to be served.
And Irv, obviously, there are a lot of reasons why Warren Buffett loved your business back then. I'd be curious to get your take on what it's like dealing with him now and kind of the focus therein when you're still dealing with a legendary investor and having him be a part of this business. How have things changed in working with him over the years?
Well, as you mentioned, Warren bought our company 38 years ago on a handshake, never took an audit. And from that day on, it's pretty much been exactly the same. Warren is, as much as you read about him and hear about him, I would say it's a factor of 1,000 times better than that from our perspective. He lets us run the business. And when we need his advice or input, he's happy to give it to us. And he's very responsive. And you just couldn't ask for a better more perfect partner or friend.
Curious what you're going to be looking for at the shareholder meeting tomorrow.
I'm sorry?
I'm curious what you're going to be listening for tomorrow.
Every time I've gone and heard Warren speak, there are always learning lessons. He's such a big thinker, and yet he puts it in terms people understand, and I'll be happy to hear about what he's thinking about some of the cryptocurrencies. If a subject like that comes out, I'll be happy to hear about what he thinks the outlook is, inflation. Just every time is just a learning lesson, and I'm sure we'll all walk away with something that will impact either our business or our personal lives.
Yeah, no doubt. Probably a shout out for what you guys have been doing there too. You guys recently opened a new store in Dallas out here where I am. I guess it's been here for a bit because I've driven by it a few times. But what have you seen maybe in terms of your guys' expansion and the rollout there? We've been talking a lot about inflation. You just mentioned kind of some of the risks there. Anything you're seeing there on that front to maybe show that we've moved into a different piece of this recovery now?
Well, demand for our product has been extremely high. And our biggest challenge today is supply chain and pricing and price changes. And I would say that, we're here to try to serve the customer, and every day there's a new issue. It could be foam allocations. It could be shipping containers. It could be they can't get containers. It could be stalled in the ports. So we've just had to move and find out what we could do to better serve our customers. But overall, the demand has been unbelievable. And specifically in Dallas, we've got a development called Grandscape. And, during the pandemic, things pretty much when it came to hospitality and restaurants, really shut down. And now, since we announced the opening about 3 weeks ago, a year late, it's really had great response and great traffic, and people are ready to get out and start shopping and being physical rather than just digital.
Well, Irv Blumpkin, it's great to have you on today, Nebraska Furniture Mart Chairman. Great to talk to you. Coming up, we've got an update on that merger, or proposed merger, we should say, between Afria and rival Tilray. Plus, we look back, at least in the first round of the NFL draft. Our Yahoo Finance reporter, or Yahoo Sports reporter, joins us shortly after this break. Earlier this month, we saw Afria shareholders voting overwhelmingly in favor of that takeover of rival Tilray. Tilray shareholders today giving the thumbs up on that deal as well. Let's bring in Yahoo Finance Canada's senior writer, Jeff Lagerquist. Jeff, where does this lead the deal, or leave the deal?
So we have Tilray shareholders giving the thumbs up to the all-stock deal that is set to create a new global powerhouse in the cannabis industry, or at least that's how it's been billed. So I'm told that all that's really left is a little bit of legal crossing the T's and dotting the I's.
And this will be, shares will trade under the Tilray banner, right? I mean, when we talk about where this goes, this will be the largest company by revenue. I guess, I don't know which term to use since we're dealing with two different countries here in Canada and the US, but basically dethroning Curaleaf and the lead that they had.
Yeah, absolutely. And dethroning the Canadian rivals as well, Canopy Growth and the like. So this is going to be a new big player on the block. It will trade under the Tilray ticker, but the management will be from Afria. So we will have Carl Merton as CFO, I believe, and also Erwin Simon as CFO.
Yeah, and Jeff, I mean, when we talk about When we talk about where we're at in this cycle, obviously the Canadian peers locked out. We've been talking a lot about changes when it comes to U.S. legalization. Canopy has their deal in place, but what are we looking at when it comes to the way that some of these companies are going to be wanting to improve their footprints here in the U.S. to take on what has been quicker growth now from the U.S. multi-state operators down here?
Yeah, absolutely. Everybody is eager to get up and running in the United States. On the Aphria side of this deal, we see them being active in the craft brewing space through their acquisition of Sweetwater Brewing. They are sort of rolling out some cannabis-themed craft beers to sort of introduce the American public to their cannabis brands. On the Tilray side of the deal, they own a company called Manitoba Harvest, which is sort of CBD hemp-infused foods.
Will be interesting to watch there. Jeff Lagerquist, Yahoo Finance Canada's senior writer. Good to talk to you today. A bit of a pivot here, moving on to sports with day 2 of the NFL draft. No real surprises, at least at the top of the first round. Clemson QB Trevor Lawrence going to the Jaguars as expected. Let's bring in Eric Edholm, Yahoo Sports reporter. Eric, we're looking ahead to the next rounds, but I wonder if we look back to what played out last night, were there any surprises in there for you?
Absolutely. I think the first big surprise came at number 3 overall. The San Francisco 49ers had traded up to the number 3 spot, paid a hefty price to do so as well. And for weeks, the name of Alabama's Mac Jones was one that was frequently sort of tied to the 49ers. They pulled a little switcheroo, though. They took Trey Lance from North Dakota State, same school that Carson Wentz of the Colts went to. That school producing 2 quarterbacks that high in the draft is a story unto itself. Not to mention the fact that Lance is only 20 years old, won't turn 21 until later in the year. So a very young, untested, lower level of competition player going to a team that could be built for a Super Bowl. So that was our first big surprise, I think, in the draft, followed by Justin Fields ending up with the Chicago Bears.
Yeah, Eric, I'm glad you mentioned my Chicago Bears there because you gave them an A in terms of your draft rating for the Bears moving up. We gave away, though, a first-round pick in next year's draft, and obviously have Nick Foles as well as Andy Dalton now on the roster. But, to pair the sports and finance worlds, you generally want to buy low and sell high. We're not necessarily doing that with the quarterbacks on the docket. But what did you make of this trade? Because there was a lot of value given up to go after and chase this quarterback here.
Yeah, and if you want to take the metaphor a little farther, this is, this is sort of protecting your immediate asset with Dalton, who's going to probably be your early season starter, maybe, although Fields certainly could outplay him. And he represents hope for the future, too. This is a player who was my number 2 quarterback on the board behind Trevor Lawrence. NFL people were a little bit more ambivalent about him. I think there was some sense that you needed to speed up his timing a little bit, but his natural ability is phenomenal. I'm here in Chicago, too. I promise I'm not going easy on the hometown folks. I would grade them as tough as I would any other team. I just happen to think they hit a grand slam with this pick, even at the cost of moving up and giving up a future first. This was the move I think the Bears felt they had to make in order to give some promise at that position, which for years has been a black hole. They really haven't they've had one Pro Bowl quarterback in their existence, Jim McMahon, back in 1985, never had a 4,000-yard passer, and it seems like it's been a really dark spot for the team in recent years.
Eric, away from the individual picks, in many ways, this was kind of a return to normalcy or what a new normal looks like for the league. They had the big event with people in attendance in Cleveland. How do you assess it? How do you think they did?
Yeah, I think it was a pretty tremendous success. Last year's draft, of course, was about 6-8 weeks into the pandemic. The sports were completely shut down. The draft created this sort of oasis and an unusual level of excitement, even as the draft is so popular these days. That was sort of a different beast. The early TV ratings for last night were phenomenal. And as you mentioned, fans were there. The NFL made sure to promote the fact they were fully vaccinated. They had to go through this application process just to get in front of the stage and into that enclosed area there. So it seems like it went off without a hitch. The excitement level was very high. Cleveland is a town that has been sort of beset by disappointment in football recently. So it was nice for the Browns fans to come in as a playoff team and have to wait a couple hours before they hear the local team's pick. And I think the fans were pretty juiced up by that point. It was a lot of energy in the crowd as they made the choice. And they made a good pick, too. Greg Newsome, a corner out of Northwestern. So all in all, I think the night was success. TV ratings stronger than they were pre-pandemic in 2019 as well. So a lot of big thumbs up for the NFL.
Yeah, and Eric, lastly, too, just I'd be remiss if I didn't ask about the man who generally is always praised for the way that he trades value in the draft. That would be Bill Belichick. And Mac Jones falling to him. What did you make about that and how it could be big for the Pats this season?
Yeah, we mentioned Jones possibly going number 3. So I think based on that chatter, there really wasn't an expectation that he would make it all the way to number 15, which is where the Patriots were selecting. They didn't have to move up. They didn't have to give up future assets. Jones was compared to, of all people throughout the process, Tom Brady. Now, is he going to be a 7-time Super Bowl champion? Who knows? But the traits, the intangibles, kind of the look and the style of his play, very similar to Brady. So it just sets up a fascinating narrative. He's sort of following in the footsteps of Brady. And of course, now has to also beat out Cam Newton for the job. But I don't think this could have worked out better for the Patriots. And it certainly is fascinating for Jones, who led Alabama to a national title last year.
Well, Eric, appreciate you jumping on with us. Of course, a reminder to keep it locked to Yahoo Sports for all their phenomenal draft coverage. And it continues. The action continues tonight. Appreciate it. We're going to take another quick break here on Yahoo Finance Live, but when we return, digging deeper into the market action after we saw Amazon hit a new all-time high off the back of their earnings. Shares, though, coming back a bit, now up just by about 1%. We'll break it all down on the other side. Stay with us. Welcome back to Yahoo Finance Live. I want to spotlight the big mover we've all been watching in today's session. That would, of course, be Amazon. That spiked to new all-time highs here off the back of their earnings. I want to bring on Jared Blickery here to discuss with us because, Jared, we got the numbers, right? 44% jump in revenue, 108 billion here versus the 104.57 expected. Earnings much higher than expected as well. And as we were discussing earlier on in the show, this one might get overlooked a little bit here, but maybe some posturing to protect themselves ahead of tough comps coming in the quarters ahead. They're moving Prime Day up to Q2 to maybe cushion a little bit. One of the analysts we brought on said that that might be a smart move. But what do you make of the quarter and how it's wrapping up a relatively strong week here for earnings?
Well, I think Amazon, in line with a lot of the other mega cap earnings that came out, not all of them, but very strong. And it looks like there's a lot of pulled forward demand. I mean, that's a phrase that we've heard since probably over the last year too many times, but we're actually seeing it right now. And you couple it with some of the spending and savings data that we're getting. I mean, we're in not just double digits, but we're looking at 20, 21% here. People have a lot of money to spend, and they're also saving, but we know that doesn't last. I think in the first quarter, about half of the $2 trillion had been dispensed to people, and so that means the other half probably going to come in this quarter, the current quarter. But that leaves open questions about what happens for the rest of the year. And I think the big takeaway with Apple, for instance, was that yes, it's going to be great in the current quarter as it was the last quarter, but their supply chain problems are going to probably manifest in the back half of the year. And then you have other people, like you can take the disaster in Twitter earnings today. They're seeing a huge jump, but they're not able to beat on revenue and MAUs, monthly active users, the way some of these other social platforms are. So even the ones that did really well, like Pinterest, for instance, and also Snap, those guys are saying, well, you know, in the back half of the year, things are going to decelerate. Facebook said the same thing. So the big picture for me is how much deceleration we get in the future. And if we see any weakness over the coming quarter, I think that's what would be priced in.
Another name that we've been watching, or we should say a sector we've been watching, oil, both Chevron and ExxonMobil reporting today. Certainly looks like things are moving in the right direction with both companies returning to profitability after the steep losses they saw last year. I'm curious, Jared, to get your thoughts on how it's moving today, given that it is under some pressure in the session.
Yes, they are. And it's worth noting, as I think Zach does just about every day, energy, one of the best performing sectors, along with financials. Those are the top two for the year. And let's take a look at some of the charts here on the Wi-Fi Interactive. So Chevron down the most, 3%. And let's actually change this to a year-to-date view. And you can see Exxon here up over 40%. And this is a company that's really trying to reposition itself as part of as the green movement just marches on, really trying to adapt to climate change and getting ahead. Well, I'd say they're already behind the curve there, but getting ahead as much as they can of the problem. Now, they had this huge turnaround strategy that they had to kind of scrap last year. They wanted to implement all these changes by 2025. I think the capital structure in a lot of these companies has been taxed, but thanks to the oil prices, windfall increases in oil prices, almost $60 to $65 a barrel is where we were before the pandemic. That's finally helped them kind of turn the corner here, but they need to do leverage more. They need to sell off more assets. The Permian Basin never coming back the way it was before. And Exxon's strategy was kind of to double down on the Permian basis before the pandemic. So it's reoriented. I think it's going to be slow going. And because it is an energy company and these U.S. majors defend their dividend to the death, and they've actually done that successfully, unlike their foreign majors, given that they still have a bit of work to do. And I think as the value and cyclical trade continues to play out, and I think it has a lot of legs here, and I think crude oil also has some room to grow. We can even check out a chart of crude oil. A lot of analysts are saying $70, $80 of Brent, it's a little bit lower in WTI. That's a definite possibility. So here's crude oil. It's off 2% today, but we did get a small breakout. I think we can see this if I turn this down to a 1 month granularity. Yeah, we got this breakout yesterday. it's pretty normal to come back down and test the breakout level, which is exactly what we've done. I think that $57 to $60 a barrel is probably a floor in WTI right now. We're not going to see sub 50 for a very long time.
Well, Jared, as I love to point out, energy and financials very strong this year. One of the weak sides, though. Let's focus in on the weak performers this year, and that would be Peloton. We got to break down to a new 2021 low here off the news that another workout at home company, Ergata, which focuses in more on ergs and rowing technology, putting some pressure here on Peloton. And I'd be curious to get your take because, we talk so much about Peloton not just being one of those fads in workout at home, but supposed to be a company that's leveraging technology in the community. So kind of surprised to see maybe some threats coming from, just another workout machine.
Well, there's so much loaded in there. I don't think we have time to get to all of it because I was skeptical when Peloton first came out. Well, when they first IPO'd, this was one of the original Jen Rogers trade back in the day. She loved this company, so I knew, and also because of Brian Sozzi, he was a fanatic about it, and I think he still is. So I saw that user base, but then it's so easily copyable. That's one issue. Then the pandemic hit, and it became a work from home darling, an exercise from home darling. And then expectations, I think, got a little bit ahead of what they're actually able to deliver. And there was some news today. The CEO, John Foley, was making some comments at a homecoming event, and he said Peloton is going to give members the ability to pause classes. Well, this affects their revenue, presumably, and their bottom line. Some other tidbits, they're going to offer 3 new ways to view scenic workouts. That may be exciting to some of the people who use it. Can't really comment on that, but they are introducing new features to include what they call Program 2.0 and a Strive score. So I think it's going to be interesting to see how they develop their own internal, not their production capabilities, because that's really what they are. They're an entertainment platform, the way I see them, but you could actually see them in 2 or 3 different ways, maybe as a tech platform, as an exercise platform first, but they do want that high multiple and that high valuation. I just don't see how they're going to be able to disrupt the industry that much further going forward.
How about all of the above in terms of the classification? It is a new one, right? That's why we focus so much on the company. Jared Blickray, thanks so much for that. Coming up, comments from Labor Secretary Marty Walsh, rattling investor confidence in some of the gig economy stocks. We saw the steep drop yesterday on names like Uber, Lyft, and DoorDash. We'll explain exactly what he said on the other side of the break. it's time for our hot takes. And today we're talking about the gig economy. Zach, yesterday we saw shares of Uber, Lyft, DoorDash all seeing steep losses in this session, some of those extending their losses today. But this coming on the back of an interview that Labor Secretary Marty Walsh did with Reuters, where he talked about how he thinks gig workers should be classified. Take a look at what he said. He said, we are looking at it, but in a lot of cases, gig workers should be classified as employees. In some cases, they are treated respectfully, and in some cases, they're not. And I think it has to be consistent across the board. We saw on the back of that, the sell-off, the move is a bit surprising to me, given that this is not a new conversation. Investors have been in tune to the risk of potential regulation coming, potential changes on the federal law. And Walsh added to Reuters that he plans to have discussions with these companies that employ a lot of the gig workers, which does suggest that this is going to be a bit of a drawn out process. And you could argue when we talk about tech regulation, for example, with the big tech names, we don't even really see a stock reaction these days because those conversations have been going on for so long. So there's no question these companies are going to be looking at that kind of pressure coming in, because while we have seen states like California, for example, vote on how gig workers should be classified, in that case with Prop 22, they voted to exempt some of these employees from the new state law that would have classified them as full-time employees. But this is a discussion that's not going to yield results overnight.
Yeah, it's not. And I mean, it's right to look at California because we saw the way that these stocks traded around Prop 22. But I think my take here, Kiko, is that 7.5% drop in Uber. It's kind of funny. It's live by the sword, die by the sword. You remember how hard they fought to make sure that that didn't pass, and the amount of money they poured into it, and what they were threatening. Keep in mind, we heard Uber talking about potentially pulling out of the state of California because of the way that they would have had to pay their workers as employees in that battle. So you could make the argument that some of the share reaction was a result of the way that they kind of played the extremes in that battle to push back against Prop 22 and the way that they didn't want to classify workers, because they made it seem as if it would be the end of times for Uber if it came through. So maybe that's why investors, kind of ironically, may have been triggered to send shares lower. But you're right. I mean, this is clearly a nuanced argument, not necessarily going to be a one-size-fits-all piece here. But we've seen the pressure mounting, not just here in the U.S., but abroad as well. When we saw, the Supreme Court there in the U.K. rule the way they did. So I don't know. I mean, ratings on the wall here, but clearly more pressure coming to these companies. And also, as you've highlighted before, a complex argument, because a lot of employees don't necessarily want to be seen as full-time employees either.
Well, and you could argue from an investor standpoint, there was a sigh of relief when Prop 22 did pass, which these companies supported after pouring so much money into it. And the thinking was that that could provide a template for federal law. And obviously, Marty Walsh were indicating it's not a one-size-fits-all, and they're going to be looking at all the other options. That does it for Zach and I in the 11 a.m. to 1 p.m. Eastern hour. We've got much more coming up ahead here on Yahoo Finance Live. Keep it right here.
Hello, everybody, and welcome to the 1 o'clock hour of Yahoo Finance Live. I'm Alexis Christoforous, along with my co-host Nabil Marcellus, in today for Kristen Myers. And here's what's happening. Those federal stimulus checks helped to fuel a record 21% surge in household incomes last month, while spending soared more than 4%. We're going to dig into what that means for the economic recovery, inflation, and the stock market. Once a hotbed for the coronavirus, California now boasts the lowest COVID-19 rate in the country. How did they do it, and what can other states learn from them? All this as Governor Gavin Newsom continues to face calls for a rare recall election. And the Warren Buffett faithful will gather virtually this weekend for Berkshire Hathaway's annual shareholder meeting. Once again, Yahoo Finance is the exclusive online host. We'll get a preview of what the Oracle of Omaha is planning to say from our editor-in-chief, Andy Serwer. But first, want to turn to Wall Street right now, where, Sabeel, it looks like stocks are in sell-off mode right now. We're retreating from those record highs, and that's despite some really strong economic reports earlier today. What gives?
That's right, Alexis. So in spite of blowout earnings from Amazon, we're seeing stocks all in the red, all three major indices. We're seeing that sell-off. So the Dow is down more than 200 points, the S&P down 26 points, and the NASDAQ down 75 points. Now, today we're seeing that personal incomes actually broke records in March, and that's largely thanks to the rollout of stimulus checks. I want to bring in Yahoo Finance's Jared Blickery to break down the impact that's had on markets.
Well, I'll tell you what, we've had so many hot reports lately that the impact on the markets sometimes has been that they react to it with the anticipation that the economy is getting too overheated, and therefore the Federal Reserve is going to have to put the brakes on. And so sometimes you see the market react negatively to what are really blowout reports. And it could be a little bit of that going on today. We got a lot of earnings, and I think there's a bit of a hangover from some of them. But let's take the economic data here. We got personal income for March coming in at 21.1%. As you said, a record going back to the beginning of data in 1946. Only yesterday or the day before, we got the personal savings rate. That was about 21%. So people are getting money, they're saving money, they're also spending money. Now, the personal spending number only came in at 4.2%, but that's still pretty high for historical standards. And we also got some other data regarding inflation. This is really, really relevant because most people talk about CPI or Consumer Price Index, but the Federal Reserve looks at something called the PCE inflation or the PCE deflator. That number, the headline number, came in at 2.3%. And for the month of March. And if you take out food and energy, it's a bit lower, 1.8%. The Federal Reserve says they want to see it at 2%. And so since it's been below that level for a long time, they want to see it at least rise above for a period of time, though they don't tell us how many months. And also we got University of Michigan consumer sentiment. Now, the consumer sentiment came in at 88.3. That's greater than Wall Street expectations. And they also have another component called one-year inflation. And people expect that over the next year, we're going to get inflation of 3.4%. That's far above the Fed's 2%. But the expectation of having higher inflation, the Fed believes, also feeds into the fact. It's almost like a self-fulfilling prophecy. So a lot of pretty hot data here, and market just saying, all right, well, we're going to shrug this off for now. We got earnings going on and everything, but in the grand scheme of things, it could be slightly bearish if things heat up too much.
And Jared, as you mentioned, investors have been poring over earnings. And when it comes to big tech, we saw blowout earnings when it comes to Alphabet, Apple, now Amazon. But given their market dominance, how much of a surprise is that really?
Well, I think there was a big surprise because we saw some blowout numbers, even basis the elevated Wall Street expectations. And I say elevated because they were getting marked up in recent weeks and months, but we're also coming off of a very low hurdle. So when you compare it to what was going on last year, that's why the numbers are so big. And even Wall Street got most of the mega caps wrong. When you take a look at what Apple posted, what Alphabet posted, what Amazon posted and released yesterday evening, those all speak to blowout numbers. And I just have a little bit of commentary here. You can see Amazon still up 1%. And by the way, it hit a record high earlier. And I will deviate 1 second here just so I can get my 2 cents in. Amazon has been trading sideways since last August, September, and was finally able to break out today. When that happens, usually it goes up a little bit, comes down, tests a breakout level, and then it goes up. What you don't want to happen is it's a false breakout, and then you just go back down. We'll have to see how that plays out. But Morgan Stanley raised their price target to 4,500 from 4,200, and this is the second highest on the street. And they're saying Amazon's results highlight the still inflecting and increasingly global e-commerce business, improving fulfillment and shipping efficiency, plus growing advertising and AWS businesses. So you take it all into stride here. I think the current quarter is going to be hot as well. That's the second quarter. But a lot of these results, this incredible growth is going to start to fade in the second half. And it's just when does that start to get priced in? I think that's going to be the bottom line here, guys.
It certainly is. All right. Thanks for laying it all out for us, Jared. Let's keep this markets conversation going now with Keith Fitzgerald. He is Chief Investment Officer at Fitzgerald Group. Keith, always good to see you. So you were just listening in on what Jared had to say. Are we in a scenario where good news for Wall Street is actually bad news for investors right now because an overheated economy means the Fed is going to have to move sooner rather than later on interest rates?
Well, I tell you, that's a great question. It's certainly always a risk. What's good is bad and what's bad is good. That's where we were coming out of the financial crisis, and everybody's worried about over-accelerating. But I think the environment's changed, particularly when it comes to companies like big tech. You're dealing with a situation where these things aren't even remotely priced into their future growth. Technology is the largest single growth trend of our lifetime. And as the world re-engages, the decisions you make now set the tone for your portfolio for the next 5, 10, even 20 years. So it's very important to be in the game right now, even though prices are flirting with new time highs.
That's what I was going to say. So we're seeing, when it comes to big tech, really high valuations, Keith. Do you think that big tech's still the biggest opportunity out there for investors?
There's no question in my mind that that's the case, because these companies, if you look at it, are 30, 40, 50, even 60% growth year over year. Now, granted, the bar was so low you could limbo under it to begin with coming out of COVID, but that does not change the fact that the world needs what they make. The world has to have what they make. And everybody, for example, in the gig economy uses what they make. We're talking about a time where only 30% of the cloud activity reflects the work we do. Imagine what that does when it goes to 50%, 60%, 70% a couple years from now. The numbers are going to explode.
So, Keith, were you part of that rotation out of big tech and into cyclicals that we saw at the beginning of this year? It seems like things have stabilized a little bit there right now, but what was your position and what do you like within big tech at the moment?
No, actually, I took the opposite approach, and I put out a memo to my clients to say the herd always gets this bet wrong, and they did, again, because big tech is once again going to the head of the class, and it's outperforming any of those cyclical trades. And the reason is people got so focused on the details, Alexis, they lost sight of the big picture. The big picture is the world is opening, the economy is reengaging, money is cheap, and there's a lot of it to go around. There are still great companies. So I actually went in heavier onto many of the big tech names we're talking about today. And they're still, it's like riding a winning horse in the middle of the race. They're still my favorites. Apple, Microsoft, Palantir, even though it's getting beaten to smithereens, has yet to see its potential.
And Keith, when it comes to owning big tech, obviously there's the threat of a government crackdown, but we've seen these CEOs go on Capitol Hill so many times. They're prepared. They have their advisors, their teams, and they don't really trip up in front of those lawmakers. So do you think that that's no longer a threat to big tech, even if they're called in for more hearings on Washington having to do with potential monopolies?
I tell you what, this is not going to make me any friends inside the Beltway, but you know, the Washington politicians are outmaneuvered, outlawyered, outguessed, and out-technologied every single time they try to go to bat. The idea is right. You can argue that big tech needs to be reined in. There's no question about that. But I don't think it's going to amount to much. They tried this with Microsoft. They tried this with the Bell system. They tried this with numerous other companies. And every single time, the markets sorted out, not the politicians.
Now, Keith, we saw Biden's first 100 days in office. Today marks the 100th day. There's a lot of big government in there, a lot of big spending, and a lot of plans to tax the rich, including raising the capital gains tax to more than 43%. What's your take on the impact that's going to have on investment going forward, if any? I ask because we saw that quick knee-jerk reaction to the downside, and then markets seem to shrug it off.
Well, I think the markets are going to try their best to shrug it off, but I think that this is going to be the law of unintended consequences at its best. History shows very clearly that this is a popular idea, but it has never worked since the dawn of time. So Where does that come down for an investor? I think you've got to constantly play forward. There's things you can control, like which stocks you buy and why, and things you can't, like what the government's going to do next.
And Keith, how worried do you think investors are of an impending capital gains tax or more taxes when it comes to investing?
That's a tough call because you really don't know who holds what. You don't know what's in retirement plans. So there's a lot of conjecture that people are going to sell off if the capital gains tax goes higher. I'm not sure that's true because I think many of the big liquid stocks are in fact held in retirement accounts where that kind of stuff doesn't matter. So to me, the real question is going to be what he does with making taxes retroactive, potentially what gets put on the table with the use of pass-through trusts, death taxes, those kinds of things are issues that I really worry about. And ultimately, I think the government will make a play for our retirement assets because you're talking about $17, $20 trillion they haven't got their meat hooks into yet.
Yeah, there's a lot of money at stake there. Hey, Keith, what are you doing in terms of inflation and hedging inflation, which we see in all the economic data is, running hotter and hotter?
That's an interesting question because, again, my take on that is a little bit different than the average bear. The issue is really not inflation, it's deflation because the government doesn't measure it properly and they have every incentive to keep the numbers low, which is why you and I experience things like medicine or our breakfast that cost 60% more than they did 5 years ago. The way around that is to buy companies whose growth rate and products can constantly be adapted and margins can be maintained, chief among which, ironically enough, given our earlier discussion, is big tech.
All right, Keith Fitzgerald of the Fitzgerald Group. Always a pleasure. Enjoy your weekend. And coming up here, the latest on COVID-19 and how California's infection rate is plummeting.
As the vaccine rollout continues, America makes progress on the pandemic. And in fact, California, a state where the governor actually had to implement the shutdowns, first to do it in the country. Now that state has the lowest rate of COVID-19 cases. I want to bring in Dr. James Simmons, hospitalist nurse practitioner in Los Angeles, California. And doctor, tell me, how has California really succeeded in fighting back against this pandemic?
First of all, thank you so much for having me. I really appreciate it. This is the last time I was on. We were definitely in a different situation. You know, I think it's really interesting, and there's probably three things that are really going on here as to why California has gotten to this fantastic place where we are. Number one is the vaccine. You know, people here in California have been really excited about the vaccine. The rollout has not faced some of the same challenges that other states have faced, particularly in terms of supply chain and distribution of the vaccine. In fact, 61% of adults in California over the age of 18 have at least one dose of a vaccine now, and we are vaccinating about 1% of people every single day. So it's definitely the vaccine. You know, the second thing, and this is a little bit sometimes uncomfortable to talk about. One of the things that we might have in California more than other places is a natural immunity because it was so bad here early on. So natural immunity, of course, comes after infection. And we had, you know, 3.6 more or less million cases of individuals confirmed with COVID-19. But the thought is that that number could be 4 to 5 times higher of people who actually had COVID-19. So we have sort of this natural immunity towards herd immunity because of a high infection rate early on, vaccines, you know, and then number 3, we just haven't had the same variants that some of the other states have had. The Cal 20C variant here that really did a number on the population back in December and January, as you can see here with this graphic, that really was the dominant variant here, has continued to be the dominant variant. We haven't seen the high rates of the B117 or the B1351 variants that other states are experiencing. So it's, you know, some could say also that we've had stricter lockdowns and more folks are willing to wear their masks here. I don't want to get too political about that, but either way, this sort of merging has led us to this place, lowest in the country.
And that's certainly something to be proud of, Dr. Simmons. But can you tell us what's happening there on the ground? Are you finding that there is starting to be a slowdown in people wanting to get the vaccine? Is there hesitancy, you know, after the whole J&J situation, where perhaps the younger set is now saying, I don't know if I want to get that vaccine just yet? Are you seeing that?
We are seeing that. We're starting to see vaccine numbers slow down, sort of nationwide, but also particularly here in California. And some of that is because we vaccinated a lot of folks, right? 87% of Californians over the age of 65 who have gotten vaccinated. That's a tremendously high number. Now we're seeing folks who are saying, well, I'm young, I don't necessarily think I need the vaccine, I'm hesitant about it. And in fact, interestingly, some folks are hearing the information about the Johnson & Johnson pause and then translating that to Pfizer and Moderna and saying, well, okay, if the Johnson & Johnson vaccine had potential issues, maybe the Pfizer and Moderna do as well. Even though they're completely different vaccines, they use completely different technology. So we're starting to see a slowdown, which is probably about on par with the number of individuals who we thought were going to be hesitant to take vaccines in the first place.
Doctor, at this point, some states are fully reopening, such as New York City on July 1st. When a city like that fully reopens, does social distancing still apply? And if it's the summer and it's hot outside, we want air conditioning. I mean, are there new rules for inside those restaurants, or has that all not been figured out yet?
You know, I think this is something, even as long as we've been in this pandemic, which feels like forever, right? As long as we've been in this pandemic, we're still learning so much every single day. You know, there was actually a report that was just this morning on one of the major cable networks about how changing an indoor airflow and HVAC systems can have a huge impact on how well this virus spreads from an aerosolization standpoint. So yes, there needs to be new rules and new protocols about how we do things indoors. We can't go back to the normal that was there before. That's just how this is. I think we'll continue to learn. I think we have to continue to be driven by the data as well. As we could, you know, sort of open up, if case rates start to climb and we see through contact tracing and other means that those case rates are from indoor activities, we got to slow down on the indoor activities and take everything back outside. We're lucky it's summer and we can start to do that now. But I also think the vaccination rates here, as well as herd immunity, I really do think that that proverbial light at the end of the tunnel that we've been looking at is getting bigger and bigger. And I think as long as people keep following these protocols, we won't go backwards.
Well, we hope so. I'm with you on that, Doctor. But what's the reopening plan there in California? And I think, the fear is, while it is in many ways a very different situation, the U.S. and what's happening in India right now, the fear is that we open up still too quickly and that we have the virus rage here once again. So what's the plan like there in your state?
So we've been on a tiered system. A lot of states have been this way, this particular tiered system. And in fact, here in Los Angeles County, where I am now, we are poised to go into the lowest tier, starting even as early as next week, which is the yellow tier, which is essentially almost a full reopening. There's some capacity restrictions on indoor things like in gyms. You can still only be at, I believe it's 50 to 75% capacity at that time. So I think this slow, measured approach is the right way to go, because what's really important to remember is that this is a global pandemic. And we are in, we could talk about the financial implications of being in of globalization, right? Well, we know that that's how this pandemic touched every single country in the world. And we also are learning from the really, really tough, unfortunate circumstances going on in India right now, what getting too lax about reopening and reopening too quickly can do. So we need to be careful. This does need to be slow and measured. But I think that the Biden administration in particular around this have done a fantastic job of sort of targeting July 4th as being that date where a lot of the country can reopen and we can get back to whatever life 2.0 is actually going to look like.
Agreed, Doctor. Let's keep this slow and measured. Dr. James Simmons, thanks so much. And coming up, the CEO of Restaurant Brands International, the parent company of Burger King, joins us to talk about how he beat expectations in the first quarter.
The parent company of Burger King, Internet Restaurant Brands, beat Wall Street estimates for earnings and revenue. Sales even topped 2019 levels, but its Tim Hortons brand continues to struggle. Earlier today, Yahoo Finance had a chance to catch up with Restaurant Brands CEO Jose Sill, and here's that interview.
we're excited about the progress we made in Q1. We saw mobility improve in the U.S. Over the quarter. Our plans were solid for Burger King, for Popeyes, for Tim Hortons in Canada as well, and we saw good progress for all three brands during the quarter. Obviously, the mobility changes have an impact on people being out in the streets and their visitation to restaurants. The vaccine rollout in the U.S. has been a positive movement for the economy and for our business as well. But for us, it goes beyond the macro events. I think the plans that we put in place with Burger King, with value being a key part of it, as well as continued innovation on some of our core items, as well as our premium items, with hand-breaded chicken sandwich being a very important innovation for the back half of the year. We're really excited about Burger King in the U.S. and the progress we're making. Still have a lot of work to do. And with Popeyes, obviously, the chicken sandwich continues to be a driver of business. Our overall platform for Popeyes is growing. We introduced the Cajun Flounder during the quarter, and that was a big hit for the Lent season. And our digital business for Popeyes and for Burger King continues to grow. And then the final piece would be the progress we made with Tim's in Canada. We launched fresh cracked eggs. Our digital Roll Up to Win program was really successful in the quarter, and in particular towards the end of the quarter, we saw really good progress. We had 2+ million downloads of the app and had tremendous digital sales over 30% during the quarter, which is a really strong performance. Our headlines for the first quarter give us confidence that we're on the right path. Positive 2-year system-wide sales growth, development, one of our best first quarters ever, and certainly in the last 5 years. And Tim's digital showing the work we can do from a digital standpoint to engage with our customers and drive incremental sales and visits.
So sales coming back, that's good, Jose. Are you able to find the labor you need to service demand? We've heard from a lot of restaurants this week. There's a pretty serious labor shortage right now.
Finding great talent has always been a priority for the restaurant business. I've been in this for over 20 years, and I used to run our company restaurants at Burger King years ago, and that was number one priority. I talked to franchisees and owners around the world, here in the U.S., in Canada, and elsewhere as well. That's a number one priority all the time. Certainly, there are moments in time when it becomes a little more complicated and challenging. I think we may be in one of those moments, but our teams are doing a great job. Our franchisees do a fantastic job of creating hiring events and hiring parties and creating excitement and awareness for the need for talent in the restaurants, but more importantly, the type of culture and the type of exciting opportunities that exist in the restaurant business. Folks that start as hourly employees in restaurants, many of them have made it all the way to the top in different brands, including in our businesses as well. So there's a focus on hiring. There's a focus on creating a great environment in the restaurants so that we retain talent and we retain our folks to be able to serve guests in the restaurants. It's a continuous and ongoing responsibility and obligation, and we're focused intently on it, and our franchisees are as well.
Jose, I know you got a number of questions about it on the call, but I want to ask a little bit more about what's happening at the Tim Hortons business and how different the dynamics have been in Canada relative to the U.S. And I guess for the Tim's story specifically, how much of it is the COVID impact, and then how much of it is you guys continuing to try to move forward with that brand after I think a couple of years that might have been disappointing to you guys ahead of the pandemic.
Hey, Miles, how you doing? Yeah, Tim's is obviously a big part of our business, and we've been sharing broadly over the last probably 4 quarters or so our Back to Basics plan in Canada, something that we've aligned with our franchise owners in Canada, and there's a lot of excitement around it. The focus of that plan is around quality food to match our quality beverages, and one of the key elements of that was the launch of, you just showed the reel of it, the launch of fresh cracked eggs for breakfast, and we saw really good progress and momentum in Canada during the first quarter. In particular, when we launched it in February, we saw our breakfast food sales as a category grow year over year and on a 2-year basis, as well as our morning day part starting to show signs of positive growth even in the face of a very difficult environment, where Canada is quite different from the U.S. What we're accustomed to here in the U.S. is a little bit further behind in Canada today. They're still in lockdowns. Ontario, which is where almost 40% of the population resides and about 50% of our restaurants exist, is in strict lockdowns through May 20th, and that has an impact on mobility, which obviously impacts our business. That said, we're investing in the business in Canada. We've committed to an 80 million Canadian dollar investment in the advertising fund, and franchisees are also supporting that with an increase in their advertising contributions. We believe in the plan, we believe in the team, we believe in the work that our franchise owners are doing, and we're investing and committing behind that. Once things open up, we think we're going to be really well positioned to capture growth and continue to see growth in the business for the long term.
And Jose, the last time we talked to you was around the time of the Burger King $1 menu launch. What have you seen in that business? Any indications you are taking the fight to the McDonald's dollar menu?
Well, our focus has always been on balance and having a balanced offer, and I think we've kind of misstepped over, maybe over the last year or so. We haven't had that balance consistently, and the launch of the value menu was really important. We launched it at the end of December of 2020, so it's been in place throughout the quarter, and it helped us drive year-over-year improvement in traffic gains as well as versus the industry. So we're encouraged. It's early days. We have one of the most compelling value offers now. There's no one out there with a cheeseburger with bacon like we have for $1, and it's bringing customers back more frequently, and we're excited about it. We think it's an early part of the journey, and we're going to continue to invest behind it, both in terms of communication to create awareness, but also investing in innovation to bring new news to the platform. Balance will always be a key part of our approach with Burger King, and we have a long-term view on building an awesome core menu with high quality ingredients. Our premium products, including the hand breaded chicken sandwich, which is coming soon, and obviously a balanced approach on value will be a key part of it. And in addition to that, we're working on breakfast, which we think will be a big part of our growth story for Burger King in the U.S. for years to come.
And you just heard from Jose Sill, CEO of Restaurant Brands International. Coming up next, what can we expect from Warren Buffett, the Oracle of Omaha, at this weekend's annual Berkshire Hathaway meeting? We've got a preview for you with our editor-in-chief, Andy Serwer, right after this.
Welcome back to Yahoo Finance Live. The Berkshire Hathaway annual shareholders meeting is taking place in LA this year, and it will be streamed live exclusively on Yahoo Finance. In fact, Yahoo Finance's editor-in-chief, Andy Serwer, is already there on the grounds. Now, Andy, tell me, how different is this year's meeting going to be compared to the ones prior to the pandemic, and also compared to the one last year in the middle of the pandemic?
Yeah, that's right, Sabine. This is very much of a singular Berkshire Hathaway event this year. And you're right, last year was too. Last year was in Omaha. There are no shareholders. And as you say, it is in LA this year. In fact, they're setting up for it right now. Behind me, you can see over my shoulder here in downtown Los Angeles. But there won't be any shareholders this year as well, of course, because of the pandemic. And the interesting thing about the location in Los Angeles is because Warren Buffett very much wanted to be with his partner, Charlie Munger, and Charlie Munger lives in Los Angeles. So Warren Buffett is essentially bringing the annual meeting to his partner. And, you know, the two of them together are kind of the magic of the annual meeting, the banter between the two of them, the wisdom. That's why people want to hear what these two have to say. They really feed off of each other. So for Berkshire Hathaway shareholders, having them both together on this stage behind me in about, 27 hours from now is a very, very special thing. We'll begin streaming tomorrow at 12:30 p.m. Eastern. We'll have an hour pregame show, and they will come on about an hour after that at 1:30 p.m. Eastern.
Very exciting stuff, Andy. So tell me how our coverage may be different this year. How might our live stream of the annual shareholder meeting be a little different?
Yeah, Alexis, we've got some really interesting new features, some really great ways for people to access the annual meeting. Of course, we're going to be streaming globally live, which is really, really great for people around the world. Shareholders obviously having a hard time traveling, so they'll be able to see it this way. We're going to have closed captioning for the first time ever this year, so people can access the stream that way. And then we have a bunch of other exciting features, including something called Watch Together, which is a free private video chat room for you and up to 12 guests. You log in and you get to sort of communicate with your friends while you're watching the live stream. There'll be a widget there that will allow you to sort of dive deep into stock charts and other data that on companies that Warren and Charlie are mentioning during the live stream. And then we also have the chance to win prizes in a Berkshire Hathaway Trivia Challenge. And I bet you and Sabine and Alexis are going to ace that.
You bet, you bet. But Andy, tell us about traveling to LA. I mean, what does that say about the economy and also the value of Berkshire's stock and holdings?
Yeah, traveling this year was very different from last year. Last year, I traveled to Omaha from the East Coast, and the airports and the planes were completely empty, you guys, 12 months ago. Yesterday, flying out to LA from New York, very, very different. The airports and the planes were packed. Everyone wearing masks, of course, but you know, it's a little bit crazy getting around because you can't hear what the TSA people are saying and they can't hear you. So if you're going to the airports, you guys, you got to be patient, take a little bit of extra time. And, you know, I think it speaks to the economy reopening, Sabine. And, you know, if you take that one step further, those value cyclical stocks, for the most part, are what Berkshire is invested in. So it's kind of interesting. You see the economy getting back on its feet, and these are the kinds of companies that Warren Buffett and Charlie Munger historically have invested in.
Hey, Andy, in terms of what we might hear from Warren and Charlie, I mean, you got Warren Buffett 90 years young, Charlie Munger 97. Do you think he's going to really spend some time on the succession plan at Berkshire Hathaway?
The succession question, Alexis. You had to bring that up. And of course, people will. People have been bringing up the succession question for decades. I was talking to Buffett not long ago, and he told me that people were asking him when he was going to retire in the 1980s. Can you imagine? So that was quite some time ago. And but you know, they've been making incremental steps in terms of succession. Of course, this is not lost on them, and for sure people will be asking them questions. There may be some announcements tomorrow. There may not be, which is exactly why you have to tune in and listen to find out.
We'll definitely be tuned in, Andy. Thanks so much. And be sure to tune into Berkshire Hathaway's annual shareholder meeting hosted by Warren Buffett on May 1st, exclusively on Yahoo Finance. That's tomorrow. Our coverage starts at 12:30 p.m. Eastern Time. Moomoo is Yahoo Finance's title sponsor. And coming up, we'll look into UBS's new investor sentiment survey on President Biden's first 100 days. $200 million vaccine shots, hot markets, big spending, and taxing the rich. It is all part of President Biden's first 100 days in office. And the major stock market indexes have soared, as you can see, during that time, with the S&P and Dow each up better than 10%. The NASDAQ up about 7%. It's actually the best showing for the Dow since FDR and the 1930s. Here to talk about it is David Lefkowitz. He is UBS Global Wealth Management Head of Equities for the Americas. David, good to see you. So I'm going to start with this. You know, Biden doesn't talk about it nearly as much as his predecessor, Donald Trump, did. But should Biden get the credit for the gains, the big gains we've seen in the stock market over the past 3 months?
I think I'm having some problems with my connection.
Oh, no, we hear you now.
Can you hear me? Okay. Yeah. So, yeah, in terms of, look, I think the largest driver of the market gains, that we've seen over the last year and on a year-to-date basis has really been the recovery from the pandemic. And, that was probably going to happen regardless of who is president. Now, that being said, the President Biden has put in place some additional spending and stimulus programs that has definitely boosted the outlook a bit. So that's probably helped a little bit, but I still think the biggest driver here has been the fact that the pandemic is beginning to wind down.
And David, I wanted to talk about some of the findings from your survey. So 50% of investors think Biden will have a positive impact on global markets. Do you seeing that maybe polarization is kind of dwindling a little bit now that we have a president who's doing his job, we're in the economic recovery, and everybody's just hoping that he does the best job for all of us?
Yeah, I mean, we have seen a little bit of a reduction in the polarization, but I mean, I do think it's pretty entrenched in American society. So I think it's going to take a little bit more than just what we've seen over the last 100 days or so to really kind of stitch the country back together. But it is a little bit encouraging that we are seeing some of the net approval ratings for President Biden have been some of the highest we've seen, really since sort of pre-Obama type of times.
Yeah, you mentioned that the Gallup data coming out, Biden's approval rating sitting at 57% after his 100 days. That is certainly pretty good. I know over at UBS, you did your investor sentiment survey, and I'm curious what some of the big takeaways are there in terms of how investors feel, which could be very different than how the rest of the general population feels, how investors feel about Biden and his policies and their impact on the stock market.
Yeah. So what we're hearing from our investors, and what we do is we're the largest wealth management company in the world. So we think it's really important that we understand what our clients are thinking, what our investors more broadly thinking about the markets and the economy. And we are registering a bit more optimism, both about the economy as well as the financial markets. Now, to be fair, it's hard to sometimes disentangle how much is related to who's sitting in the White House versus what's going on with the pandemic and things like that. But we also are seeing that more of our clients and the investors that we survey do think that President Biden will be a tailwind for global markets. Again, hard to disentangle exactly why.
All right, guys, I'm so sorry. We actually seem to have lost David Lefkowitz, but we are going to try to get him back. We're going to take a quick break, and we'll be back right after this.
The Fed is holding tight to their position of keeping interest rates unchanged. That's in spite of the fact that their preferred measure of inflation shows that prices rose 1.8% year over year, a record since the start of the pandemic. To break this all down, I want to bring in Yahoo Finance's Brian Chung. Brian?
Well, Sabeel, we got new data from the Bureau of Economic Analysis this morning showing that inflation increased by 0.4% in March. That's when you exclude those more volatile pricing components like food and energy, which means that on a year-over-year basis, as you mentioned, prices increased by 1.8%. That is a pandemic high, again, as you just said. But what's interesting about that BEA report this morning are the underlying components that say inflation could rise even faster in the coming months when you consider personal income up 21%, disposable personal income up almost 24%. And the savings rate among consumers was about 27.6%. So you have income going up, savings also going up, which means that as people get bigger wallets and as the economy reopens, vaccines get into more arms, people might be spending even more. And that's the reason why we've heard from the likes of Morgan Stanley saying in a note this morning, they say core personal consumption expenditures could rise as high as 2.6% in April and May. For the Federal Reserve's part, we heard from Fed Chairman Jay Powell earlier this week. On Wednesday, he said that these are likely due to transitory factors like the way that you're measuring year-over-year changes in addition to temporary supply chain issues. So the Fed Chairman saying, don't let these things scare you. Fed's going to continue to keep rates low and steady through, at least for right now.
Okay, Brian, I don't know how much the market is believing Fed Chair Powell. If inflation were to surpass their 2% mark, how, has Powell indicated how hot inflation would need to run, even if it is transitory, for them to move on interest rates?
Yeah, and that was a question that was directly asked to the Fed chairman in the press conference on Wednesday. But the Fed chairman said, we're not going to put a number on how high that core PCE reading will have to be for us to all of a sudden start raising rates. So it's not like it needs to hit a certain bright line test, be that 2.8 or 2.9%. The Fed just says it's going to measure the broad-based measures of inflation expectations, in addition to obviously the current lagging inflation readings like not just PCE, but also CPI to see whether or not those types of prices are going up. But again, the Fed chairman saying that for right now, the priority is not necessarily inflation. Over the last 10 years, we haven't seen those pressures really rise all that much. The key is really getting that over 8 million figure of people who have lost their jobs compared to pre-pandemic levels back into the labor market.
And Brian, we saw personal income soar to record high levels. What's your feelings on consumer sentiment right now?
Yeah, well, consumer sentiment is very interesting because in addition to the personal income measurements that you just mentioned, we also did get a reading of consumer sentiment from the University of Michigan. Their final reading was actually 88.3. That's up from the first reading that they had, which covered that month of April. And it is also higher than the March reading. And in fact, that's actually the highest reading since the depths of the pandemic. Now, of course, we're still climbing back up to the near 100 levels on that index that we saw pre-pandemic, but it all goes to show people are getting more income, partially because of that stimulus check, the third round that we got at the beginning of this year, in addition to the other fiscal stimulus that's been delivered since that period of time. People have larger wallets, which means that as more restaurants and businesses open up, maybe people are willing to travel again, those prices could continue to go up as these businesses say, hey, people are willing to buy our stuff, so let's increase the prices a little bit.
So, Brian, do you think, though, that, we haven't seen inflation now for about a decade in a meaningful way. We're seeing people's incomes rise. We're seeing them save more. Do you think consumers be able to sort of take that impact of higher prices and have it not trip up the economic recovery?
Well, that's the big question that the Federal Reserve is trying to figure out right now. Let's say, for example, people and the demand for things goes up to a point where you do start to see runaway inflation, not necessarily 1970s level, but what would happen if core personal consumption goes up to 3.5% because of the surge of people going out and spending? Well, if that is the case, the Federal Reserve needs to say, okay, is that a temporary cause or effect that's a result of maybe all the stimulus checks that have been going in people's pockets? Or is this, again, part of the one-time changes that we're seeing right now as lumber prices are temporarily going up. Everyone kind of says that should be relieved in terms of pressure again sometime soon. Or even just things like the Suez Canal. You remember the boat that was stuck there not so long ago? Obviously, that type of issue could result in producers and sellers wanting to raise their prices again as well. So I think those types of things, trying to parse out what is temporary or transitory, as the Federal Reserve has used the language, is going to be very difficult for the Fed to do, not only because there's just so much going on and it's happening at such a rapid pace, but also because of the measurement issues. Again, I talk about those base effects. The reason why you might see a 1.8% figure as kind of large compared to previous months is because when you look at the March versus March measurement, of course, it's going to be very low because you're comparing against a very deep March 2020. So that could be the reason behind that, but worth watching as the Fed does continue to engineer its policy over the coming weeks.
Definitely worth watching. Brian Chung, thanks so much. And coming up, Alexis and I will take you through the next hour of trading and also look into how President Biden's first 100 days, what that means for your wallet.
Hello and welcome to Yahoo Finance Live and the 2 o'clock hour here. I'm Alexis Christophers, along with my co-host Bill Marcellus, who's in for Kristen Myers. And here's what's happening at this hour. Those federal stimulus checks, well, they helped to fuel a record 21% surge in household incomes in the month of March. We also saw spending climb more than 4%. People also socking away more money as we saw the savings rate climb to 27%. We're going to dig into what all that means for the economic recovery, for inflation, and of course, for the stock market. The Warren Buffett faithful are going to gather virtually this weekend for Berkshire Hathaway's annual shareholder meeting. This year's taken place in Los Angeles instead of Omaha, Nebraska. Once again, Yahoo Finance is the exclusive online host. We will talk with the market experts about what we can expect from the Oracle of Omaha. And states are coming up with some creative ways to get residents vaccinated against COVID-19. We'll speak with West Virginia's Governor Jim Justice about his unique approach. We'll also get his take on President Biden's first 100 days in office. But first, to the markets, where things aren't looking too great here on this Friday afternoon. We have got stocks retreating from record highs, and in fact, they're now at their lows of the session. Taking a look, we've got the Dow Industrials down 218 points, the S&P 500 giving back 32 or 3/4 of a percentage point. And on a percentage basis, the NASDAQ is the big loser, down nearly 1% or 118 points. Jared, let's stick with tech and talk about Twitter, which isn't helping things at all. I guess the results there, first quarter results showing a slow start to the year for the social media giant.
That's right. And is it a tech company? Not trading with the multiple it once had. It had a pretty high-flying time during the pandemic, but definitely cooled off. And let's take a look at some of the numbers, then I'll get into some analyst commentary. The stock is down 13% or so. As you see on your screen, that's the worst day in just about forever. And by the way, here's a year-to-date chart, and you can see it's been kind of rocky this year. And then here's a 1 year where you can see it's still nearly doubled in price, but expectations not riding high after this. And that's because the beats were just modest. They were beats. So revenue coming in at 1.04 billion. Yeah, that's up 28% year over year. But the estimate was for just a tiny bit lower, 1.03 billion. So not a big beat there. And then the key metric of average monetizable daily average users, that was up 20% year over year at 199 million. But the estimate was just short of that, was just a little bit lower than that, 198.8 million. So Piper Sandler, which has a neutral rating, they have a price target that they cut to $66 from $71. You can see the price is $56 right there. They're saying we came away from the first quarter less enthused, adding that a more decisive beat on user growth would have instilled confidence. Barclays, which has an underweight, and they cut the price target to $48 from $52. They're saying they're raising their revenue estimate by 2%, but that reduces EBITDA 6% for 2021. So there's still time for the situation to improve. So a little bit more hope in Barclays analysis. Also saying US ad revenue growth of 22% is concerning, given the 50% hyper growth of mobile application products from crypto trading platforms. So yeah, we were talking about this with Miles Udland this morning. He said, nobody's going to see an ad for a shirt on Twitter and go buy it because they wanted to see what I was up to. They have a tough road ahead of them in terms of monetizing, and they haven't done the best task so far. And we know that there's Elliott Management is an activist investor, the board trying to push for changes. So they got the work cut out. Excuse me, Jack Dorsey has his work cut out for him, at least with this particular company.
And Jared, we saw Apple report blowout earnings this week, but suppliers of Apple, their stocks are currently in the red. What's behind that?
Yeah, well, there was a different take on Apple when the numbers first came out. I broke those numbers earlier in the week, and the stock shot up. And in fact, it gapped up the next day, but then it came back down to earth. That's because people are focusing more on the longer term picture. And Apple said that they have potential problems with their supply chain. Parts are getting more expensive. Sometimes they're hard to come by. And two of their suppliers, all these guys are Apple suppliers on your screen. A lot of them you probably haven't heard of, but one is Neophotonics. And this is a stock that is tied, I think 50% of the revenues, yes, 50% come from Apple. And their gross margin guidance was seen as light, given the higher input costs. So that means that they're probably going to pass that on to Apple. Apple's not going to make as much money, potentially, if they're paying for higher prices. How much can they pass that on to the consumer? We'll just have to see. But people have been spending their stimulus checks in droves on these fancy phones. Are they going to be able to do that at the end of the year? Here's another one, Cirrus. Cirrus is down 16% or so. At least it had been earlier. And they are tied to Apple's revenue, or they're tied to Apple through 90% of their revenue stream. So the bottom line is a lot of these companies, these smaller companies, are bellwethers for what's going to happen with Apple in the second half of the year. And let's just take a quick look at Apple itself, down 1.3% today, but still up 80% over the last year.
Yeah, not too bad. You mentioned crypto a moment ago. I know that the owner of the New York Stock Exchange, Intercontinental Exchange, recently sold its stake in Coinbase for a pretty hefty sum.
Yeah, $900 million. Just checking my notes here. This is a CFO. By the way, they just reported earnings. So the CFO was on the call, Scott Hill, He said that they're using the proceeds to pay down debt. But this is pretty interesting. I'm going to pull up my exchange heat map here. Coinbase just listed this month. In fact, they don't even have a month trading history behind them. But let's just take a look at year to date. This will include the first day trading price of Coinbase. You can see the NASDAQ here in the upper left. That is an exchange which has been hitting record highs recently. CME close to record highs. Some of the other ones, though, let's check out ICE here. You can see nice one-year performance. A lot of the exchanges performed well because of the GameStop and Reddit phenomenon that we saw in the first quarter. But ICE is big on crypto. They have their own crypto futures. They spun off Bakkt. That's Kelly Loeffler's firm. They have a crypto app that is going live that is going to allow you, and it's in beta mode right now, it's going to allow you to buy Starbucks coffee in Bitcoin. Now, I don't know what the exchange fees are going to be. I think that's a little bit of a sticking point, but just kind of gives you an idea of what we're dealing with. And then I got to get to the price of Bitcoin here because it has been kind of recovering here. Here's over the last year, still up over 550%. But lately, we had that false break to the upside, and we came back down, and we're still kind of in the middle trading area of this range, and this is exactly where shorts may get reinterested. So we got to clear the current levels, probably get up to 57, 58,000. Clear that hurdle, got a better chance of recovering those record highs.
And Jared, take us through April's winners and losers. Mega caps are back. Energy and staples, not so much.
Yeah, let's take a look at the Wi-Fi Interactive, and I'll pull up a month-to-date chart. That's 21 days in April. So we'll get that up, and we can see that real estate is actually the biggest outperformer here. It's up 7.8%. And why is that? It's because the real estate sector has been benefiting from the reopening trade. Not just people building new homes and buying existing ones, and we know those prices are skyrocketing right now, but also the commercial space is beginning to recover as we have the reopening. And you can see in the upper left here, after real estate, we got financials, that's XLF, then XLC is communication services. That houses Facebook and Alphabet, which have been hitting record highs most of the month. Then you got consumer discretionary, and that, of course, houses Amazon, which is hitting a record high today. And then materials. Materials is one of those value cyclical sectors that does well with the reopening. So you put it all in context, it's a very constructive, nice mix, nice breadth mix for the month. I would like to have seen some of the tech darlings, especially in the chip space, do a little bit better, and the software space as well. But I think the lesson is, as you said, Sabeel, the mega caps are back. And before I head on, I just want to take a look at the NASDAQ 100 performance month to date, because you can really see what these winners are doing. Apple up nearly 8%, Alphabet just knocking out of the park, up 14%, Facebook up 10%, Amazon 12%, Microsoft up nearly 7%, guys.
Big tech is back. Jared Blickery, thanks so much. Well, after saying that the state had hit a wall when it comes to COVID-19 vaccinations, West Virginia Governor Jim Justice found a pretty creative way to entice people to get the shot. A $100 savings bond for anyone 16 to 35, and it even applies to anyone who's already gotten the shot. Joining us now is the governor of West Virginia, Jim Justice. Governor, thanks so much for being with us. I want folks to know the money here would be coming from that federal pandemic fund that your state was given some of. I understand you did some back of the envelope calculations here and realized this made good fiscal sense. How so?
Well, Alexis, thank you so much for having me, and I appreciate y'all more than you'll know. But the bottom line of the whole thing is just this: is West Virginia, you know, to be perfectly honest, we led the way all along with vaccination, you know, and getting shots in arms. And we were out in front and everything, and then at just as we would have expected, we hit a wall and everything. And the wall is people that are reluctant to take the vaccines. When the Johnson & Johnson people did, you know, what happened with Johnson & Johnson there, surely slowed things down. But we basically hit a wall. And the reason we hit a wall is you've got 16 to 35-year-olds that are reluctant. You got the Johnson & Johnson situation, and then you've got some, to be perfectly honest, just hard-headed people that are never going to change. And so any state that raced ahead in the beginning is at some point in time, as all states will, they will develop resistance. And so what we're trying to do now is get across the steepest part of the mountain, which is always near the top. And in order to be able to do so, we've got 53% of our population that have first doses now, 42% that have second doses that are fully vaccinated. But really and truly, to be able to shut this thing down, we know we really need to get at 70%. And so basically what I did, is I was sitting in the briefing and we were working on all this, and there was one of the media people that said, well, what if 40% of the population, the eligible people that are in West Virginia to take the vaccination, don't want to do it? And I quickly calculated how many people that would be. That'd be 588,000 people. And then I wrote, beat 588, ... bad. And so in order to be able to really achieve all we wanted to achieve, and then, Alexis, I may not be many things, but I'm a mathematician and I can buzz the math. And so I was writing there, I calculated real quick the number of young people we had from 16 to 35. That's about 380,000. I basically, used a factor of about 72%. I got 275,000 people. If we could get something close to that vaccinated, we would be really close to 70% of our entire population, and that's without vaccinating another single person of age over at 35. And so we know we're going to vaccinate more people over 35, but with all that, that was the math. That's what we did, and so then we came up with kind of a patriotic move and the savings bond idea, because we can all stand a dose of patriotism in this country, and hope to God we can get away from this Democrat-Republican food fight that's going on all the time and get on to doing stuff that's good for our nation.
Exactly. So moving on, trying to get away from that food fight into what's best for all of us. What is your assessment, Governor, of President Biden's first 100 days in terms of putting the U.S. economy on track for this recovery?
Well, to be just straight up honest, I'm really concerned, that as anybody would have to be, as to who's in control of pulling the strings and playing all the shots right now. I don't like bailing out pension plans and doing pet projects and all that kind of stuff. But I really do believe that his speech that he gave the other night, he did a really nice job with that. I've always believed, going big, even if you absolutely overstated, the magnitude of some dollars, to be able to right-size our economy and to get our people, really that have been, the rug just jerked right out from underneath them, and be able to help them to get right side up and everything. It just absolutely, to me, as a business guy, I've never seen a situation where any of us are able to budget exactly what we should be able to get by with. And it seems like instead of just trying to continue to put, a Band-Aid on cancer or whatever, it was better to go big and really try to knock this out of the park and move on. And so I'm going to be always super respectful of the President of the United States. I was great friends with President Trump, thought he did an amazing job in lots and lots of ways, thought he didn't get near enough credit that he should have gotten in many ways, but I am absolutely going to be super respectful to the president we have right now, and I'm a guy that truly doesn't care about the Republican and the Democrat situation or independents. I just want goodness for our country, and we got too much divide right now.
Governor, you talk about going big. Biden certainly wants to go big on infrastructure. We don't know yet what the final bill is going to look like, but I know the White House gave your state a letter grade of D when it comes to infrastructure. Whatever money you do get from that bill, do you have concrete plans for how you're going to spend it in West Virginia?
No question. If you just think about this, and this isn't tooting my horn in any way, but when I got here, our state was in pretty tough shape, and we immediately did something that was 6 times what had ever been done before in a Roads to Prosperity program, and we've put We've put billions of dollars into our roads to prosperity since I've been here, and we're trying to catch up, but we still got a lot to do. And from the standpoint of West Virginia now becoming a diamond in the rough that a lot of people are wanting to come to and everything, we really have to clean up and fix up a lot of our arteries still. And but we're working it. That infrastructure dollars that could come to West Virginia would surely change that label of D significantly up and everything. And of course, we in West Virginia don't think it's a D right now, but we respect, the rating agencies and those people that put that D on West Virginia, and we just got to make sure that we try to keep moving it forward and get it significantly up.
Governor, I want to switch gears for a minute and talk about that controversial bill you signed into law that bans transgender athletes from competing in female sports in schools. The NCAA has threatened to retaliate and perhaps not hold college tournaments in the state. First off, do you think that's a real threat? And if so, what would the impact be, the economic impact be for West Virginia?
Well, that wouldn't be good. And Alexis, you've got to understand that I sign into law hundreds of bills, and this was not by any stretch of the imagination a priority with me. However, I'm a high school basketball coach too. I have done that forever, and I coach a girls' high school basketball team. I know a lot about this. I know a lot about Title IX and how hard, our ladies have worked to have been able to achieve that. And I know absolutely from the standpoint of we don't want to discriminate. We don't want to do that in any way in West Virginia, and there's not a discriminatory bone in my body. But I do believe that we are not being fair to our female athletes that have worked so hard to achieve what they're doing, to put them on an uneven playing field. And that's basically what we'd be doing. This is not a discriminatory matter. It is just simply just that. I know what I'm talking about this, and I truly support, what our legislature's done, but this wasn't a bill that I prioritized. This wasn't one of my bills. This bill came out of the legislature, but I do support it.
And before we let you go in the 30 seconds I've got, I know it's early on in Biden's presidency, but if Donald Trump were to run again in 2024, do you see yourself throwing your support behind him? Or it's somebody like Senator Tim Scott of South Carolina. A lot of folks liked what he did with his rebuttal earlier this week, rebutting President Biden's address to Congress. Is that somebody who could emerge as a potential candidate?
Well, it surely could. I mean, Tim Scott, it was an amazing speech. He's an amazing man, and he's had a life that he's battled through and everything and achieved greatness beyond belief. And we all need to recognize that and be super respectful of him. From the standpoint of Donald Trump, and, I absolutely am great friends with the Trump family, been that forever. It would be hard for me not to support Donald if he chooses to go that way and everything. But in all of that, that's way down the trail. We have a president of the United States of America, the highest office in the world, that has been in office for 100 days. Now, like it or not like it, I surely wasn't a President Biden, sponsor, but at the same time, I absolutely know that we have got too many days in front of America, that the wheels could fly off. A lot of bad things could happen. We need to be behind our president and support him now.
All right, we're going to leave it there. Governor Jim Justice, thanks so much for your time today. And by the way, happy belated birthday. I know you turned 70 years young earlier this week.
I know. We don't need to talk about that 70. I can't believe it. But nevertheless, thank you so much. I appreciate you so much.
All the best. All right, coming up here, Warren Buffett faces some impatient investors at tomorrow's Berkshire Hathaway annual shareholder meeting. We'll talk about it after this.
The Berkshire Hathaway annual shareholders meeting is happening in LA, taking place tomorrow, and it'll be live streamed on Yahoo Finance right here. Now, I want to bring in Jonathan Boyer. He's principal and portfolio manager at Boyer Asset Management and host of the World According to Boyer podcast. Now, Jonathan, Warren Buffett is a legend. Can you talk a little bit about his investment strategy when it comes to value investing?
Sure. First, thanks for having me on the show. And yes, I mean, he's a living legend. It's unfortunate that I'm not going to be able to go like everyone else to Omaha this year, and hopefully next year they have it in person. Warren Buffett is what's described as a value investor, but he's so much more than that. I would describe him, as an opportunistic investor. Through the years, his style of investing has changed from buying really cheap companies to buying higher quality companies at a reasonable price. And he's evolved through the times. And that's why his long-term record is so much better than pretty much anyone.
What about some of his individual stock picks? I mean, he's been a long holder of Coca-Cola, but he himself admits the Wells Fargo bet wasn't a great one. The airline bet wasn't a great one. What do you make of how his philosophy has changed? I mean, even you look at big tech, it took him a while to get into Apple. I mean, he's finally in there in a big way now. But what's your big takeaway from how Warren Buffett's trading philosophies have changed over the past even decade?
Well, I mean, he's evolved with the times, but the thing that's most important is he takes a valuation-based approach. And the Coca-Cola example is actually a great one. He has held Coke since the 70s or since the 1980s or so, and his cost basis is negligible. And what's been great for shareholders and what's critically important is he's been able to grow shareholders' capital by holding on to that stake virtually tax-free for all those years. So he loves buying a great company at a reasonable valuation that you can hold on to forever. And that's what I think investors really need to be doing.
Jonathan, buy low, sell high, buy a great company at a reasonable price. This seems like common sense pretty much for investors. But what is it about Warren Buffett's approach that makes him so successful at finding those instances and capitalizing on it?
Yeah, I mean, buy low, sell high is, it does sound simple. It's much, in practice, it's much harder to do, but it's much more than that. The most important thing an investor can do to try and ensure his or her long-term success, it's the price one pays. That's the most important part of investing. So you have to obviously buy low, but not only you have to buy low, but you have to buy low in companies like a Coca-Cola, for example, when Buffett bought it, that can grow and compound nicely over time, so you can have that magic of tax-deferred compounding work for you. So that's the real kind of secret sauce, and one of the reasons why he's so successful. He's not trying to buy a company for it to just double in price. He wants to buy a company and hold on to it for as long as humanly possible.
Yes, we'll definitely be paying close attention tomorrow as we're seeing the Berkshire Hathaway annual shareholders meeting happen live on Yahoo Finance. Jonathan Boyer, thanks so much.
Thanks for having me.
And coming up, we'll take a closer look at President Biden's first 100 days. Did he deliver?
200 million vaccine shots, hot markets, big spending, and taxing the rich. It's all part of President Biden's first 100 days in office. The major stock market indexes have soared during that time. We've got both the S&P and Dow each up better than 10%. The NASDAQ up about 7%. In fact, it was the best showing for the Dow since the 1930s and the FDR days. I want to bring in Ed Mills now to talk about it more. He is Washington policy analyst at Raymond James. So, Ed, we know that Biden doesn't talk about the stock market nearly as much, if at all, the way his predecessor did, Donald Trump. But do you think that Biden should get the credit for a booming stock market here so far in 2021?
So, Alexis, what we told clients heading into the election is that most outcomes were going to be okay for the market. But if there were to be a Democratic sweep, that we would see a significant push for a huge fiscal support bill. And that's what we got. We got $1.9 trillion passed in March. That is starting to kind of flow into the economy. We're seeing consumer spending hitting records. We saw kind of personal income in March hit a record with the kind of stimulus checks that hit bank accounts mid-March. And so what we're seeing in the market is a reflection of a recovery from COVID, an economic comparison year over year that looks good, but also a ton of fiscal support for this market and a pivot towards additional spending later this year as we try to tackle infrastructure. Taxes loom large, but generally speaking, it's a pretty decent backdrop for the equity markets as we sit here today.
But Ed, is there a chance that President Biden's agenda may be too ambitious when it comes to infrastructure? I understand many investors, most investors actually would be in support of more infrastructure planning in the country, but then you have to deal with the Senate.
Yeah, Sabine, you're right. What I told clients here at Raymond James is that what we're seeing from the president is an old axiom here in DC, which is never negotiate with yourself. So our expectation is, does the total dollar amount come down? That's pretty likely. Are the taxes that are being proposed all going to be implemented? Likely not. We're already seeing with the corporate tax rate that the market is anticipating a 25% corporate tax rate, not a 28% tax rate. On capital gains, there's few people in DC that I can find that believe that it's going to go to ordinary income for households with income above $1 million annually. I think the consensus is at 28%. We didn't see a huge increase in payroll taxes, which were a part of the Biden campaign. Instead, we see $700 billion of pay-fors on just collecting the taxes that are already owed to the government. So when I look at what the concern was and what we're most likely to get, we're still going to see a significant increase in spending. It's going to be offset with some taxes, but probably not as onerous as initially feared. And so in my mind, is that a Goldilocks scenario, at least near and medium term for the market? That's what I've been focused on.
Ed, let's talk for a moment about the next 100 days and how might the Biden administration pivot? Are we going to start hearing more about international affairs and more on their plans for trade with China?
Yeah, so first 100 days was 100% COVID. Next 100 days, that's regulation. That is a pivot towards international affairs. The Biden team is largely in place. They are very well educated and educated in terms of the way in which Washington works, experienced there. So I'm looking for a lot of regulations in banking and housing and energy and trade. As it relates to China, we do think that the second half of this year, we get a lot more of the Biden strategy on China. I do think the infrastructure bill is his first plank in that strategy, a part of a sprint ahead instead of trying to hold China back. But ultimately, I do think that the fights between the United States and China are more likely than not to return. And I look to what the Senate is doing. There's a bipartisan effort that has already been marked up in the Senate Foreign Relations Committee. There's another bill by Chuck Schumer and Senator Young, a Republican from Indiana, called the Endless Frontiers Act. And so if there's one bipartisan bill that we can do in DC, it's a get tough on China, invest in the United States bill. If you are looking for that bipartisan infrastructure bill, look at the China efforts in Congress.
And Ed, you said that Biden's first 100 days was 100% COVID, the next 100 days, 100% regulation. But many investors still view the pandemic as the biggest risk to the global economy and the US economy. So how important is it for Biden to continue to keep the pandemic as one of the top priorities of his administration moving forward?
Yeah, it's important. I didn't mean to minimize in any way, shape, or form kind of the continued efforts that we're going to see from the Biden administration in terms of pushing for vaccinations, kind of controlling any of the potential variants, continuing to invest in education, continuing to invest in the development of vaccines. We saw this week even more awards coming from the money that is available. When we look at the $1.9 trillion package, there is a ton of money that is still going to COVID for the time being. We're not in any way, shape, or form back to normal. And I think the Biden administration is going to be squarely focused on that, but does have a little bit more bandwidth to start working on the other areas of the government that they want to make their mark with.
I want to get back to this idea of higher taxes and the higher capital gains tax. What within the Biden tax proposal do you think really stands a chance of passing Congress?
Yeah, so on the corporate side, I do think that the rate will go up. I don't know exactly how high. I do think the international part of the code will be beefed up to get more money. And there's going to likely be a minimum tax on highly profitable companies above the $2 billion of annual profit a year. On the individual side, I do think the top rate goes up. The corporate or the capital gains and dividend rate goes up. I don't think it goes up to ordinary income. The big fight, I think, is going to be on the estate tax. They are not changing the threshold for when the estate tax goes into effect, but they are ending the step up in basis, which is a colossal change. And it is setting it at $1 million mark, which is much lower than the existing estate tax. Look for a huge fight there, and look for a fight on the SALT tax. We spend so much time looking at the Senate and seeing if you can get Joe Manchin in that 50th or 51st vote in the Senate. What is not appreciated sometimes is how close the margin is in the House. And there are a number of Democrats from the tri-state area, we call them the SALT caucus, who are unwilling to do major tax reforms unless there is more SALT relief. That is going to be a significant hurdle, one of the things that needs to be solved before a deal can get struck.
All right, we're going to have to leave it there. Much more, though, to be continued. Ed Mills, Washington policy analyst at Raymond James. Thanks so much. And coming up next, we'll talk more about this weekend's Berkshire Hathaway annual shareholder meeting right after this.
The Berkshire Hathaway annual shareholders meeting is taking place in LA this year, and it will be streamed exclusively here on Yahoo Finance tomorrow. I want to bring in Krish Sankar, Managing Director and Cohen Senior Research Analyst. Now, Apple is one of the biggest holdings in the Berkshire Hathaway portfolio. What's your take on Apple's blowout earnings and what that means for Berkshire?
Sure, thanks for having me. Clearly, the numbers from Apple were way beyond impressive. The expectations were actually relatively low, and Apple really blew past all the numbers across all the metrics, whether it was iPhone, iPad, Macs, and services. So it's definitely a very impressive quarter, and clearly the margins have also improved pretty nicely. That kind of speaks to both Apple's scale and also execution. And I think the other thing that has also been a point of concern has been the sustainability of this, which has been the number one question for many investors. But if you roll it all together, Apple is executing way above, and the numbers are extremely impressive, talks to the ecosystem, talks to the loyal install base, and I would probably say in the long run, it's definitely very positive for the stock and for the shareholders.
Krish, I want to ask you about semiconductor stocks, which I know you also follow very closely. We've seen this pattern where companies are beating, they're guiding higher, yet their stocks are not being rewarded. We saw this with AMD, with Texas Instruments, NVIDIA. Why is that happening? Why are they just not impressing investors?
Yeah, I think it's a very good question. And if you look at some of the names in the what I would characterized as the semi-cap ecosystem, calendar Q1 was a strong quarter for many of these things. You saw the numbers move higher. You saw some of the stocks do really very well. And what you've seen is a lot of the investor views, many of the positive news for this year is actually discounted in some of these names. And that's why you're seeing some profit taking on a beat and raise. And the flip side is that you're seeing some of the small and mid-cap names that actually had what I would characterize as inline numbers or even a modest miss has been punished a lot. Like some of these names are down 10 to 20% the next day. So I think a beat and raise is not being rewarded because most investors are baking in a very strong 2021. So the question happens, what happens in the second half of this year when you get visibility into calendar 2022? And also keep in mind, some of it is also like positioning from fund managers, moving from like cyclical to maybe looking at like low multiple names, and also looking at maybe like, some of the growthy names heading back into the back half. So I would say it's a combination of positioning from fund managers, along with the fact that a lot of the good news for this year seems to be discounted by investors.
Well, Krish Sankar, thanks so much. And be sure to tune in to Berkshire Hathaway annual shareholders meeting hosted by Warren Buffett tomorrow, May 1st, exclusively on Yahoo Finance. Our coverage starts at 12:30 p.m. Eastern Time. Moo is Yahoo Finance's title sponsor. And coming up, we'll talk about the sectors hurt most by the pandemic and how they're doing now.
Welcome back to Yahoo Finance Live. Just want to bring your attention to something that just crossed the wires. The Biden administration says it will restrict travel from India beginning May 4th because of the extraordinarily high COVID-19 caseloads we see coming out of India right now. Here on your screen, you see the latest on the markets. We're off our lows of the day, but still not looking too pretty. The Dow is off more than 180 points. The NASDAQ down more than 100, and the S&P off 27. Let's bring in Michelle Connell now, CFA and owner of Portia Capital Management. Michelle, good to see you here. So are you still believing in the reopening trade? I mean, now that we see more of our economy reopening here in New York City, the mayor saying we're going to reopen on July 1. Is that trade still happening, or has it already peaked?
I think it depends on what areas of the economy you're talking about, and also specific names or stocks, to be honest with you. So to a degree, we've had this great inflow of people, institutions and retail buying stocks, but a lot of what has been bought is the lower quality, low cash flow names and less emphasis on the quality names.
Well, let's elaborate on that. So what sectors are you most concerned about?
I'm concerned by the sectors that have any dependency on semiconductors or chips. You spoke with your last guest about that. You're seeing names like Ford and BMW that are being affected. I believe Caterpillar came out and said the same thing when their earnings were reported. And you probably are going to see some areas of hardware that are affected by the shortages of semiconductors. You also will have some areas, sectors that are affected by the cost of labor as they're going up, because people, as we know, or small businesses are having trouble finding workers at this point. So they're having to go up and bid up their wages. So I think there's going to be some pressure there as well.
What about in terms of some of the overlooked or unloved sectors of this economy? I'm thinking maybe the small caps. Are you showing that sector any love right now, Michelle?
You know, I kind of like SMID, which is a combination of small and mid-cap stocks. A lot of small cap stocks have been bought up. Again, more emphasis has been placed on those that are lower quality and lower cash flow. So I'd be looking at the names in the Russell 2000 that have strong cash flow and are quality names. And I would even go a little bit higher in the cap structure and look at mid cap, because your average multiple there is lower than it is for the Russell 2000 names.
And what would you say in terms of investors who are worried that we're in a bubble right now? What do you tell clients in terms of navigating this kind of an environment?
You know, everybody's talking about sell in May and go away. And I'm saying, I'm kind of caveating that with sell a bit in May and go away. So look at the names that have run a lot in your portfolio and may be a little bit frothy here, a term that even Chairman Powell used a few days ago. Take some money off the table. Look at some names and sectors that are a little bit more enticing here, especially on the long-term basis. There still are names in technology and healthcare that look really attractive here.
What are you doing with the bond market? I mean, we saw yields sort of move up really, really fast at the beginning of the year. Then things started to stabilize. What's your outlook for the 10-year Treasury yield, and how much exposure do you have to Treasuries at the moment?
I frankly don't have a lot of exposure to treasuries here. What I've been doing is a barbell. So I either have things in a money market or I'm using a hybrid private credit, some of the interval funds that are attached to floating rate securities. So you're able to get a better yield. And at the same time, you don't have to worry about the interest rate or credit risk, especially if you're looking at some strong credits within those funds.
And what individual stocks do you like right now? I know Amazon is one of them, but give us a couple more.
Yes, I do like Amazon. I think we're probably going to be looking at a split here, fingers crossed. I also like MedPlace, which is in the healthcare arena. I like Vino, which is a software company, cloud-based. And I also like Repligen, which focuses on efficacy or creating technologies that help efficacy be for the biotechs and for the pharma companies.
All right, we're going to leave it there. Michelle Connell, CFA and owner of Portia Capital Management. Thanks so much for your insights today. And we'll be back with a last check of the markets to wrap up this hour on Yahoo Finance Live right after this.
Welcome back to Yahoo Finance Live. Let's check on what's going on in the markets. And we're seeing all red for all three major indices. We're seeing a sell-off here. Now, the Dow is down more than 100 points, down 183 points. Looking at the S&P, that's down 27 points. And the NASDAQ also down more than 100 points. And that's despite the fact that Amazon had blowout earnings. The Seattle firm said profits more than tripled to $8.1 billion, and sales from January to March soared 44% to $108 billion. But we're looking at the stock right now. It is in the green, but it's only up 16 points. And before we let you go, where Shauna and Adam will take you through the next hour of trading, I just want to preview we're going to have Jim Weber on, Brooks Running CEO, to talk about the Berkshire annual shareholders meeting happening tomorrow, exclusively streamed on Yahoo Finance. We'll be right back.
Household income surging by a record 21% in the month of March as more vaccinations and stimulus checks help fuel the economic recovery. More on what this tells us about the pace of the rebound. Amazon hitting an all-time high after sales soared 44%, revenue once again above $100 billion. And they expect that momentum to continue. Mark Mahaney of Evercore, he raised his price target to $4,500 on the stock. He's going to join us later this hour. And Buffett-owned Brooks Running benefiting from a surging interest in exercising here during the pandemic. Revenue up year over year as digital sales soared. CEO Jim Weber will join us just ahead of Berkshire Hathaway's annual shareholder meeting tomorrow. We've got an hour to go until we wrap up the trading week. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Jared Blickery, and let's just dive straight into the markets here. The Wi-Fi Interactive showing an ignominious end to the week and also to the month of April, and we'll check out some of those charts throughout the show today. So let's take a look at the NASDAQ 100 because there's a little stock called Amazon I want to talk about. Blowout earnings. What can you say that's anything negative about it? Well, Morgan Stanley ranking overweight loves it, raising their price target to 4,500 from 4,200. Barclays raising it to 4,300 from 3,860. But all is not well when you look at the social media sector. Twitter, that dark square down there, that's down 13%. The worst day since they missed on earnings 2 quarters ago. Now, they didn't miss on earnings this time. They just managed to eke out a very small beat. And guess what? Wall Street likes big beats. They weren't able to get it. We also got to talk about energy earnings here because we had Exxon and Chevron reporting. Now, Exxon, it looks like they've turned the corner here. That's something that Darren Woods is seeing the economic recovery happening a little bit quicker than expected. Now, Chevron, for its part, which you can see is down 3%, Exxon's only down 2%. They had a little bit tougher time. They have more exposure to the West Coast. And guess what? If everything weren't enough, remember we had that polar vortex to deal with as well. So that hurt earnings in the quarter. But it looks like energy sector starting to come back here. And guess what? This is not looking like the best day. Here's the month to date. So we're starting to see some more green here. Exxon's up 3%, Chevron down 1%. Here's the year to date. And guess what? Energy, I think it's the best performing sector of the year, if not its financials, but these guys have been running neck and neck so far this month. Guys?
Hey, Jared, how do you think the market, though, is looking at this better than expected economic report that we got? Because we're going to be talking to Brian Chung here in just a few minutes on exactly what we got. But the massive jump in personal income here, the rise that we got in spending paints a picture of a stronger consumer, yet we're not really seeing that reflected in the markets today.
Well, it could be a case of a little bit could be a little bit of a little bit too much good news is bad news. So, you look at that 21%. And by the way, we got personal savings also at 21%. So people are making and saving enough money. They're also spending a lot. I think the spending rate was 4.2% for the last month. So that's a very healthy spend rate, but it's not too obnoxious. But what I was really focusing on today was some of the inflation data. The PCE core index that came in at 1.8%. The headline number, which includes food and energy, more volatile, that's at 2.3%. So, the Fed is starting to perk up as they see these numbers perk up. We also got University of Michigan consumer sentiment, and there's an inflation component of that where consumers expect the next year's inflation to be 3.4%. You put it all together, people are expecting to spend more money, and also we have rising prices as a backdrop.
All right, Jared. Well, let's talk about what this all means here for the market going forward here, because we had that econ data. We had the stronger than expected earnings from many of the tech giants over the last several trading days. We want to bring in Alan Boomer. He's Momentum Advisors Chief Investment Officer. And Alan, there's a lot of chew on here that we got out this week. Let's just start with earnings because we got the better than expected numbers from Amazon after the bell yesterday. Apple and Facebook were both out earlier this week. When you see that type of momentum into some of these names that have been winners over the past year, can that continue?
Yeah, it's a great question. And first of all, thanks for having me. When you think about what's happened in stocks this year, we've seen a little bit of a reversal. A lot of the companies that did really well last year started to give back some gains this year. There was this expectation of the reopening trade, which would mean that all of these tech stocks that were really the darlings of 2020 would fall back. Well, now what you're seeing is a little different story, because the earnings of these companies is very, very strong. I think what's emerging today is sort of a new post-COVID economy where you can have a coexistence of some traditional value stocks right alongside some growth stocks.
Well, I want to get your take then on what could happen in the second half of the year, because we saw a lot of these companies admit that a lot of demand was pulled forward. Facebook said that they expect growth to strongly decelerate in the third and fourth quarters. So everything's looking pretty good for the first half. What about the back half of the year?
Another great question. I think the market is priced almost to perfection, right? Like we've priced in a good vaccine rollout. We've priced in a strong reopening to the economy. I'm a little concerned about the second half of the year. I think it's possible that in the short term, earnings have basically peaked and things will, this is a great quarter, but I don't know that the rest of the year will be quite as strong. One of the things that I think you'll start to see is that we've got a labor shortage in the United States. We talk about the jobs that were lost during. We don't really talk about the fact that there's a lot of companies that have a lot of vacancies that are outstanding. And it's because of a number of reasons, right? There's a number of people who are caring for sick folks at home. There are people who are, afraid to go back to work for fear of getting sick. You have folks that are getting some nice benefits from unemployment and from the stimulus package. And also folks that just don't need to make as much money because they've been able to cut their expenses by not going out so much, right? So I think you'll start to see in the second half, particularly companies that rely on labor, you'll start to see some issues around a labor shortage for sure.
So, Alan, are you saying that we could potentially see a pullback here in the second half of the year? And I guess how big of a pullback could that be?
Yeah, I don't know that we'll get a pullback. I just don't think earnings will be as strong. The reason I don't think there'll be as big of a pullback, think about the macro factors. You have really low interest rates, which means that if I were to go and look for some other alternative like bonds, I'm not really getting paid very much. We also have a tremendous amount of fiscal stimulus that's still in the market, right? Like we looked at the fiscal stimulus from the last COVID package to this COVID package. It adds up to over $4 trillion on a per capita basis. That's about $12,000 per person. So you've got a tremendous amount of fiscal stimulus. These dollars are in the economy. Folks are saving more money than they've ever saved. I think there's a lot of other factors that'll keep the market going strong in the second half of the year.
Alan Boomer, always great to speak with you. Momentum Advisors Chief Investment Officer. Let's talk more about the econ data that we got out this morning. First of all, we had that personal income soaring to a record 21% in March. Spending ticking up once again. We want to bring in Yahoo Finance's Brian Chung for a little bit more on this. And Brian, when you take a look at these numbers that we got out this morning, I guess how much of it has to do with the stimulus checks that were set out from the Biden administration?
Well, likely a lot of it. I mean, these types of numbers are very interesting to see. Personal income up 21%, disposable personal income up almost 24%. The savings rate was 27.6%. And that's because of the stimulus checks, as you mentioned, in addition to other stimulus supports like unemployment insurance. That's the only other reason why you would expect to see income go up alongside savings. But that shows that there could be almost a coil effect in this economy with people have more money coming in and they're also saving more money at the same time. That means that they could be set up for a lot more spending in the future. So when we talk about the headline inflation number, Jared laid out that the core personal consumption expenditures clocked in at 1.8% year over year. But take a look at the likes of Morgan Stanley, their economics team messaging that core PCE could peak as high as 2.6% in April and May, again, because of some of the leading indicators that we've seen on income and savings rates. So very interesting to watch. And it does present a little bit of an interesting challenge for the Federal Reserve, which we know has an inflation target of 2%, guys.
Yes, they do, Brian. And I was so impressed Wednesday when you got Jay Powell to say the word frothy and markets sold off. So is there, in fact, a little bit too much froth here that we're seeing in the economic data? Anything else on your radar that would indicate that maybe things are looking a little bubblicious?
Yeah, when we talk about froth and bubbleliciousness, I guess, if you will, the question is whether or not that's already baked into the market. So at least as of Wednesday, the Federal Reserve Chairman said broad asset prices. I had asked him about Dogecoin and GameStop stock, but he didn't say those things specifically. But that broadly things are appearing frothy. But he said a reason for that is because of investors factoring in optimism over the economy reopening. We also need to consider that consumer sentiment numbers came out this morning from the University of Michigan. Those numbers appearing to be the highest since the depths of the pandemic. So that shows that there could be more froth if people continue to go into the economy and try to buy things or go on cruises or fly around the country again or internationally. Those types of things are going to be interesting to see with regards to whether or not they're already being factored into the pulling forward prices of stocks or whatever asset you're looking at right now. And I think that's what the Federal Reserve will be watching for in the coming months.
All right, Brian Chung, thanks so much. We are going to take a quick break, but when we come back, the White House restricting travel from India starting next week, and this coming on the heels of the fact that cases have soared over there, over 380,000 yesterday. More on that when we come back.
COVID conditions continue to deteriorate in not only India, but also South America and parts of the EU. I want to bring in Yahoo Finance's Anjali Kamlani now for the latest. Anjali, we also have rising vaccine supplies in the U.S. How is this all balancing out?
All right. Well, Jared, we know that there's a lot going on. So let's start off with the news about the global cases. We know that the Biden administration is set to announce a restriction on travel inbound from India starting on Tuesday. That's a report from Reuters about that. And this comes just days after the administration called for citizens in India to come back home. Dr. Peter Hotez from Baylor College of Medicine yesterday told us that travel bans tend to be somewhat counterproductive. Listen to what he had to say about that.
I feel more often than not they can be counterproductive. So one would have to be really strategic about how you use a travel ban, since it can be very isolating and may make public health control even more problematic.
Public health control, of course, being the key issue, as we know that India did announce more than 386,000 cases in a single day, setting yet another global record. It also reported nearly 3,500 deaths on Thursday. And the U.S. is joining about a dozen other countries that have already taken action on travel to and from India, in some cases extending quarantines from the country. Meanwhile, we know that there are other countries that are also seeing surges in cases, and that also is putting strain on the pace of vaccinations here in the U.S. We have continued to move forward, though the experts do anticipate that the rate that we've seen so far, so while we've hit really high numbers like 4 million in a day, that rate is likely to drop, as we've seen most of the people, that first wave of people who are going to want to get vaccinated or have a quick access to vaccine sites have done so. And meanwhile, the administration is now focusing on the rest of the population. While we have already had about 100 million adults fully vaccinated, we're now looking at the rest of the population. And administration officials also said that because of the current rate, we have all those doses that have already been distributed, almost 300 million of the total that's supposed to come in, which is about 600 million. Back to you guys.
Yep. That's right. And we've seen a lot of these vaccination sites become a lot more easy to get into and out of here in New York City. Thank you for that, Anjali. All right, I want to get a little bit more color now. So I'm going to bring in Dr. Michael Gonzalez. He's the emergency medicine physician and assistant professor at Baylor College. Well, we've seen these, thank you for coming, by the way. Thank you for joining us. We've seen these reopenings take different courses in various parts of the United States. How is it going in Texas right now?
Thanks, Adam. Thanks for having me. Yes, there's certainly a lot of confusion and some mixed signals around how we're doing this. Texas, in particular, has been very aggressive from a state leadership position in terms of opening up both public venues, much to the concern of a lot of healthcare experts like myself. We've been very fortunate in the most recent data that we haven't seen a significant spike, partly due to this increased and really reliable effort, heroic effort to get vaccines pushed out there to everyone, every single person who wants it.
Doctor, what do you think of Michigan's plan? They unveiled a plan earlier this week tying the reopening strategy to the number of vaccinations in the state. Does that type of strategy make sense to you?
I think that there's a lot of potential benefits to that. I think that really we have identified that this particular virus is a very difficult challenge that is unprecedented in the world. And so strategies that really emphasize getting the vaccine, which is single-handedly our best effort to prevent mass infections like what is occurring in India and some other countries. I think that that's a really smart way to approach this. The data is still out, right? This is all experimentation, and really we're going to have to watch this data carefully. But I do think having a metric-based or milestone-based approach is the way to approach this.
Well, let me ask you, we were just talking to Anjali Kamlani about the vaccine supply and demand picture. I just want to get your take on it on the ground there at Baylor.
Yeah, so I think that this remains the biggest challenge in the United States. We have a significant percentage of our communities, both here in Texas as well as other parts of our nation, that are hesitant, right, to get that vaccine. And I think that as this represents the number one missile, really the number one weapon that we have against this virus, we're going to have to reach out in different ways. And I think that means making the vaccine even more available than it is. I think a lot of the mass vaccination sites that have been launched all over the country are really kind of reaching their maximum point. And I think there is some opportunity to continue to push the vaccine out in non-traditional areas, our drugstores and community centers and various efforts that go all the way out into the communities, particularly those communities that we know are hardest struck by this virus.
Doctor, we have the White House restricting travel from India starting next week, another record day of cases in the country, more than 380,000. What more can the U.S. do to better assist and better help India at this time?
Yeah, I think this is a challenge that, as I said, we've never seen anything like this. And 380,000 cases or more in a single day, and it's probably an undercount in India, should be a cause for global concern. And so among the healthcare community, I think there's a real concern and desire for there to be a more concerted worldwide effort, something akin to what could only be compared to like a Berlin airlift model, where the entire world literally steps forward and tries to assist. Because a small fire, and not to minimize the impact of this, but a fire, to use an analogy, a fire in India is putting out a fire in one part of the world that is this large, though, is a little bit like putting out the fire in your front yard when your house is on fire. And so we really need to focus, as some of the more medically advanced areas of the world, we really need to focus our resources. And so I know the Biden administration has been talking in direct contact with that part of the world to really increase our efforts. I think vaccine distribution, potentially considering increasing manufacture of both raw products, as well as some of the discussion behind those vaccine patents, needs to move forward.
We got just about a minute here, 30 seconds. Are things returning to normal? Are people coming in for regular scheduled medical procedures now, finally?
Thanks for that question. That is absolutely what we are seeing. I worked last night. I apologize for maybe being a little sleepy this morning, but we are absolutely seeing a return to near normal pre-pandemic volumes in our emergency department. And we're seeing a mix of both still COVID presentations. It is very much still a real concern in our community, as well as a variety of the things that we handle each and every day in our emergency departments. Heart attacks, strokes, those different concerns are absolutely at their baseline. And I think that's being seen throughout the United States.
Well, thank you, Dr. Michael Gonzalez, emergency medicine physician and assistant professor at Baylor College. Coming up next after the jump, we're going to talk Crocs with our own Reggie Wade and also a UBS analyst.
Record earnings from Crocs pushing shares to an all-time high earlier this week. Some people calling Crocs the shoe of the pandemic. So we want to talk a little bit more about this. And for that, we want to bring in Jay Soul. He's UBS's footwear analyst. And we're also joined by Yahoo Finance reporter Reggie Wade. So Jay, very, very strong results that we got from Crocs earlier this week. I know you raised your price target on the stock to $115, but you maintained your neutral rating. Why aren't you more bullish on this name following that blowout quarter?
I think the big reason is that, Crocs has had a tremendous run over the last 2 years. They've had really great success making the brand more relevant with consumers. They've also benefited from fashion trends. And really the whole stay-at-home phenomenon during the pandemic has probably helped sales as well. We're just not sure what sales look like in 2021, if they'll be able to be strong enough to make the stock continue to go higher from here. And that's the basic reason our rating is neutral.
Jay, I think it's safe to say that Crocs are one of the more polarizing footwear options out there. So many people either love them or hate them. But with the recent success, do you think that comes at the expense of the athleisure boom?
Reggie, I don't think so. I think it's part of it. I think people want to dress more comfortably. They want to dress more casually. I think that's something that's been, affected by the pandemic in a positive way. It's increased that trend. And Crocs is a great shoe if you want to be more comfortable or casual around the house or just out and about with your friends. So I think Crocs has been helped by that trend.
I want to ask you about the global footwear industry. Do you think it has more room to grow, and what role do you think stylings like Crocs will play in it?
Reggie, I absolutely think there's a lot more room for the footwear industry to grow. We predict 5% global growth for footwear going forward, and we think that the athletic and casual side of the footwear industry, as opposed to, say, the dress footwear side of the industry, is going to have above average growth. And we think Crocs can participate in that because it is a comfortable shoe. It's fun, it's cool, and it's not expensive. You only have to pay $49 or $54 for a pair of Crocs. That works in this environment where consumers still want great value.
Well, I want to ask you about those higher price points because I walk around Wall Street and I see a lot of people kind of back in their formal attire, but most people aren't. And do you expect these trends ever to revert, or this more of a permanent norm that we have here, a new norm?
Well, really, the trend toward casual dress isn't just a one-year phenomenon that's been a result of the pandemic. It's been going on for decades, really about 4 decades. And we've seen it really only move in one direction over that time. So as much as, you're seeing some people on Wall Street, put their wingtips back on, we're really probably going to see more people wearing Crocs, believe it or not, and other sneakers like Nike sneakers or Skechers sneakers than we've seen in the past, because I think that's just the trend in fashion that's playing out.
And Jay, speaking of that 5% global growth that you're expecting going forward, yes, Crocs is going to benefit from that. But what are some of the other names that you think are best positioned when you talk about athletic footwear there leading the way?
Well, some of the names, like I mentioned Skechers. Skechers is stock we have a buy rating on. Skechers is the 3rd largest footwear company in the world. They've delivered double-digit top-line growth for over 20 years. We think that will continue. We really like Deckers. Deckers is the owner of the UGG brand and another brand called Hoka Ane Ane. We think that has tremendous growth potential. So Skechers and Deckers, along with Nike, of course, are 3 of the companies that we think will benefit from the trend, as well as Crocs.
Jay, I have to ask you, a lot of people have been reporting about the Roger Federer-backed tennis shoe offering on AG. What kind of noise do you think they could make in the space, especially coming out with an IPO later this year?
Well, I'll just say this, a new brand like On Running has, what we've seen in the run specialty channels, though, not a lot of new brands have emerged. Hoka is one of those brands, and they've really taken the place of brands like Asics, which has traditionally been a strong running shoe brand. But there's a lot of interest in performance running in general right now, where Brooks and even a New Balance and a Hoka, all of these shoes and these brands have been benefiting because consumers want to get out and they want to exercise. Another trend that's been amplified by the pandemic is the trend toward health and wellness, which is something that, people want to live more healthy lives. And to do that, part of that is exercise. And so they need running shoes to do that. So a lot of these running shoe brands have really benefited over the last 12 months.
Jay, before we let you go, I wanted to talk a little bit about the Chinese shoe market. We have brands like Anta and Li Ning. What do you expect from them? They've had strong growth. Do you think they can continue that?
Well, Reggie, one of the benefits of having such a strong tailwind behind the industry and having, mid-single digit type of growth potential and bigger growth potential really in Asia is that some of these brands like Anta and Li Ning are going to continue to benefit from the trend as well. The market is big enough that, a lot of brands can participate in the growth. So we can talk about Nike, we can talk about Skechers having great growth, but also at the same time, there's plenty of room for the Chinese brands to grow strongly as well.
Jay Soul, great to have you. UBS's senior analyst, and of course, our thanks to Reggie Wade for hopping on here as well. We're going to take a quick break, but when we come back, more people have started running since the start of the pandemic, and that, of course, has boosted Brooks Running's business. We're going to talk to CEO Jim Weber right after the break.
Welcome back to Yahoo Finance. I'm Derek Wickery. Now we have all the major markets in the red, but I want to get to a couple of stocks that are on my mind here. First is General Motors. They are announcing another plant closure because of the chip shortage. This time it is in Ontario, and it's going to be closed for at least 2 months. And the news there, this comes from a GM spokeswoman. CAMI employees were notified this morning they will remain down through at least the week of June 28th. We know the chip shortage has been hurting all the major automakers and the minor ones as well, and leaking into everyday appliances. Can't even buy a toaster without a chip in it anymore. And by the way, GM reports earnings next Wednesday, May 5th. Now, Peloton is another stock I'm watching. They just had a kind of a investor event. It's actually calling it their Peloton Homecoming event. CEO John Foley was revealing some new features for the Peloton bike and also the treadmill in the universe there. It's called Programs 2.0. Providing structured routines and recommended schedule. It lets them select their favorite routines. These are users with their preferred instructor. They're also going to let users pause in the future. I don't use Peloton. I thought that would have already been in the mix, but no. Here are a bunch of other features they're releasing. Strive Score, target metrics for Tread and Tread Plus, Scenic relaunch, new motivating music, guided classes, distance-based classes, time-based classes, and all of this is being rolled out today. It's going to be available to everybody in a few days, and they're going to be reporting, Peloton's going to be reporting earnings on May 6th. What are you watching, Shauna?
Well, Jared, I was going to say I am a Peloton user, and I'm very excited about some of those additions. All right, I am taking a look at Twitter. It's one of the worst performers in the S&P today. You can see shares off just over 14%. They missed on their user growth. They also issued weak guidance. Investors taking issue with both of those things. Revenue for Twitter coming in just above $1 billion. That was up 28% year over year. But their monetizable daily users grew by 7 million to 199 million. The street was looking for 200 million, so a slight miss there. One one of the reasons that the stock is under pressure today. Flipping over to Chevron, another name in the red. Now, they actually matched earnings forecast, coming in at 90 cents for EPS. That's actually, though, down 29% from a year ago. Revenue of $32 billion, slightly ahead of expectations. CEO Mike Wirth is saying in the statement that earnings strengthened primarily due to higher oil prices as the economy recovers. Taking a look at where crude closed today, it was off a little bit, but still holding above $63 a barrel. Chevron, on the other hand, shares up just around 21% since the start of the year. Jared?
Yeah, crude oil looking strong, but it's time to jog into the future. We got Berkshire Hathaway's live streaming event tomorrow, which we are the exclusive carriers for the 5th year in a row. And a Berkshire company that's going to be featured is Brooks Running. And we got the CEO, Jim Weber, on right now with us. So we were just talking about Crocs, and I think you have a different line of shoes here. I say that tongue in cheek. People's habits have changed. What have you noticed over the last year? And how is that being reflected in your company's results?
Well, it's been incredibly dynamic. I would say almost like a roller coaster. We were, like everyone, frozen about a year ago in the April-May period, but then we saw people starting to run and sales quickly followed. So we're in the middle of a running boom. It's just been amazing. We think we added nearly 2 million new runners to our brand last year. And now with the sport opening up in 2021, we think we're going to see that growth accelerate. So it's been a good time to invest in yourself, health, wellness, get some fresh air, take some time away from the screen. And running has just been a huge part of that. So we were up 27% last year, a record year for Brooks.
Jim, when you take a look at some of the growth potential here for your stock, more people running, yes, that's good for your business. Specifically, the drilling down into your various categories, what are you most optimistic about?
You know, it's interesting. I think, you know, when we think about the runner, you know, there's race day, there's people that are just starting to run, there's people that know they need the right shoe and are doing high mileage. They're putting in 20, 30, 40, 50 miles a week. And so they're going to go through several pairs a year. So we try to build gear for everyone from head to toe. And it's very much based on your own unique human biomechanics. And that includes from jackets through run bras, obviously all the way to shoes. So, you know, because it's all we do, we're really trying to create a full line of products that are going to work for any runner, whether they're just starting out and putting their first mile in, or they're doing literally their 20th marathon. But I think the core of the market is everyday trainers. And that's where we're really trying to build product that mile after mile, runners are going to come back to our shoes because they're working for them.
Well, Jim, I want to ask you about the Berkshire Hathaway annual shareholder meeting that I was just mentioning a couple minutes ago. It's drastically changed, not only this year, but last year. Are you sponsoring any events? And just in general, how have you seen COVID really affect the way that you guys kind of put this presentation together?
Well, it's very different. Like last year, we're going to be virtual, as you know, and we actually put together a 5K race, an Invest in Yourself 5K for the Berkshire weekend that always happens Sunday morning, and we're not going to be doing that because everyone's virtual. So we'll be watching the meeting along with everyone else and taking in the business story of Berkshire that's happened through this past year. And always anxious to hear from Charlie and Warren. So just like everyone else, we'll be doing that. But, you know, the virtual racing continues. And, you know, I think the mileage is as high as it's ever been. We're just not all there running together.
Jim, you mentioned the fact that this past year has been a roller coaster for you. I'm curious just if you can give us some insight, what it's been like leading a team through this very, very challenging time.
It's been hard. You know, we're still virtual here, I think 14 months after the initial work from home orders in this area of the world. And that's true in Europe, where the work from home has been cycling through the offices over there still at this time this year. So that's been challenging, and the supply chain has been interesting. So I think it's just really forced us to be agile, to be very customer focused. You know, when all of our signals went dark because retail stores were closed, we started to create runner-driven signals. And because of that, I think we've been responsive in terms of delivering to the customers, delivering to our retail partners. Inventory and you know, footwear and apparel is a huge part of the puzzle, and managing that well season to season is key. And by staying customer focused, we've been able to be responsive to demand.
Well, I want to ask you about that digital strategy then. Personally, when I go into a shoe store, and I still go in personally because I got to get the right fit. I got kind of an odd size, narrow, but if you're doing that digitally, are you facing more returns? And how do you deal with the shifting landscape here?
It's interesting. I think the runner is still shopping everywhere, and almost always it starts digitally. So we've got digital tools. We've got a shoe finder and a bra finder, digital tools, but people still shop and buy everywhere. And the in-store experience is the best. If you're looking for just the right product for you, especially Run Store, and it's just a great place to go because you're going to see all the best products in the industry, and it is about getting the right product for you. So that continues. I think many of the stores went to virtual fittings during the store closures, but now many of them are back open with all the protocols in place. So the store experience has returned. What's interesting is it actually went our business almost to 75% plus digital through an online sale in the heat of the store closures. Now it's back to almost 30, 35, 40%, almost to where it was in 2019. So people are back in the stores. That's what we're seeing.
Yeah, I got to tell you, I love those discount sales, and I don't see too many of those anymore. Jim Weber, Brooks Running CEO, thank you so much. All right, be sure to tune in to Berkshire Hathaway Annual Shareholders Meeting, hosted by Warren Buffett on May 1st. That will be tomorrow, exclusively here on Yahoo Finance. Our coverage starts at 12:30 p.m. Eastern, and Moomoo is Yahoo Finance's title sponsor.
Big blowout numbers from a number of tech and consumer giants this week. Amazon was one of those names that reported Apple and Facebook we got earlier this week. But let's talk about Amazon because shares hitting an all-time high today. They reported sales soaring 44% during their latest quarter. So we want to bring in Mark Mahaney. He's Evercore's Senior Managing Director and Head of Internet Research. Mark, it's great to have you back on Yahoo Finance. I know you raised your price target this morning to $4,500 on the stock, up from $4,000. What's going to keep this momentum in Amazon going?
Well, if they can continue to show fundamentals like this, I think the most interesting thing really wasn't the March quarter. We've had so many positive earnings releases from, you mentioned them, Facebook, Google, even eBay and Shopify. You knew that the March quarter was going to be strong for Amazon. The question was the June quarter guide. The comps are now starting to get tough. And can Amazon sustain premium revenue growth rates, call it 20% plus off of those comps? Their guidance indicated that they could, and so we're going to track that for the next couple of quarters. But if this company can sustain and convince people that they can sustain premium revenue growth despite those tough comps, that's what takes the stock higher.
Yeah, and those earnings reports were simply astounding. But you know what I want to talk about is that possible split. Now, there was a rumor a couple days ago that they might be executing a split, and then memories of Apple swirl around. And are they going to join the Dow? Probably have to be a 10 for 1 or 1 for 10, something like that. What could that mean for the company?
I don't think it means that much, these stock splits. I know Amazon's done it in the past. I can't remember. It's been a while since they split their stock before. And maybe you remember, Jared, off the top of your head. I'm sorry, I just don't. And as a fundamental analyst, I just don't think it really matters that much if the companies split their stock. I get that sometimes it's a trading catalyst, but it doesn't impact fundamentals. I think there's a lot of other things going on around the company. They're moving more and more into international markets. Their ad revenue growth is explosive. AWS growth in terms of dollars grew materially faster than Azure and Google Cloud. And I think there's been some concerns that AWS could be losing market share. They kind of rebuffed that pretty clearly in the quarter. So I think there's a lot of kind of very interesting things that are going on around the company right now, and they have been. And they, the advantage for Amazon shareholders is, for good or for bad, they've been beneficiaries of the COVID crisis.
Mark, another thing that investors have been focused on is Prime Day and also Prime membership. So Amazon saying that they were shifting their Prime Day to the current quarter. I'm curious, one, just to get your thoughts on the timing of that. And then two, what do you see as a growth trajectory? What does that look like for Amazon Prime?
Well, Amazon Prime is maybe the single best customer retention loyalty program ever created. I'm exaggerating a little bit, but probably not by much. They now have over 200 million Amazon Prime customers globally, probably 85 million in the US. And our guess is that that number can probably double over the next 10 years. They can get to 400 million Amazon Prime customers. And what we know from extensive surveying is that those customers shop more frequently with Amazon. They purchase more. They have higher spend intentions. They're just, as you would expect, more loyal, bigger spenders. And it's kind of a great acquisition and retention tool for Amazon. And they also have pricing power. I think they've raised price on Prime twice. I would imagine every 5 years or so, you should expect Prime pricing to go up. They moved Prime Day, you're right, into the June quarter last year. They had to push it all the way back into the December quarter. It does add, $4 to $5 billion in revenue for the company. So it does help. It did help them with their June quarter outlook, and it'll set up tougher comps for the September quarter outlook. It's a key event that I think they only introduced 4 or 5 years ago, and it's been a big selling event for them. So it definitely will help them in the June quarter.
I got to tell you, I had to look up that stock split question, and the last time Amazon stock split was 1999. They did a bunch, 3 almost in a row there. But I'm not going to make you answer another question about that. I want to talk about AWS. That has just been an absolute powerhouse over the years, funding basically the entire operation for such a long time. Now that we have Andy Jassy, pretty much the chosen successor of Jeff Bezos, what does that picture look like going forward for that segment?
Oh, for that. So one, let me hit on 2 things. One is, I don't think we're going to see a major change in the way that Amazon is run. There were 2 logical candidates to replace Bezos as the CEO, Jeff Wilke or Andy Jassy, the head of the retail business or the head of AWS. And Jassy's been with that company for, I think, 18, 19 years now. And so I would imagine that you'll see no change. In terms of AWS and how it's operated, that maybe is a little bit more of a wild card. I think that just has so much momentum now that I don't see why somebody would come in, and I don't think that there's a need for a strategy or an operational overhaul at AWS. So my guess is that we're not going to see much of a change there. We've had this revenue growth acceleration this quarter, and my guess is that that's sustainable, because I think there are a couple of permanent pull forwards from COVID, and one of them is cloud computing. You just had a lot of enterprises that decided there's no longer a need to wait. We need to adopt cloud computing now. And I think Amazon benefits from that. But by the way, so does Microsoft Azure and so does Google Cloud.
Mark Mahaney, always great to have you on here. Yahoo Finance, Evercore's Senior Managing Director and Head of Internet Research. We look forward to having you back soon. Coming up next, Berkshire Hathaway's annual shareholder meeting gets underway tomorrow. Our editor-in-chief, Andy Serwer, he is on the ground out in LA. He will join us live right after the break.
The Berkshire Hathaway annual shareholders meeting kicks off tomorrow at 12:30 p.m. Eastern, and Yahoo Finance is the exclusive live streaming option for you if you want to see it. We have our own editor-in-chief here, Andy Serwer. You got boots on the ground there. I heard the weather's nice in LA, but what's different about it this time than it was in prior years, especially considering the fact that it's never been in LA before?
Yeah, that's right, Jared. We are here in Los Angeles, and just about 24 hours from now, we'll begin broadcasting the live stream, our pregame show. Warren Buffett and Charlie Munger will be reunited and appearing on the stage behind me at about 1:30 p.m. Eastern tomorrow. And that, in fact, is really the big story, Jared. The fact that Warren Buffett and Charlie Munger, I like to call them the biggest buddy act in the history of American business, will be back together, because last year the meeting was in Omaha and Mr. Munger was unable to attend because of the COVID pandemic. So this year, essentially, Warren Buffett has brought the annual meeting to Charlie, to his partner here in Los Angeles. And so I know both of them are thrilled to be back together on the stage, along with Ajit Jain and Greg Abel, two vice chairmen here at Berkshire. So it'll be interesting to see. This is a one-off, though. Again, you're right, Jared, because last year, no shareholders in attendance in Omaha. This year, no shareholders in attendance in Los Angeles either.
Andy, what was it like flying out there, out to LA? I mean, just give us a picture of the airports where they crowded again. And I guess, what does that tell us just about where we stand in this economic recovery?
Yeah, Shauna, it's interesting. Last year I flew out and the airports were completely empty. The airplanes were completely empty. It was just like a ghost town. Now I was Newark Airport at Newark, and it was very crowded. Everyone wearing masks. People had a hard time understanding each other, had a hard time understanding what the TSA people were saying. So, you need a lot of patience if you're flying right now. Absolutely. And, it's sort of interesting to me also in that it made me think about airlines and the recovery. Of course, Warren Buffett famously bailed out of airlines last year, sold out of those stocks, and they're recovering right now. But, we still have a ways to go. And it is those cyclical stocks, those economically sensitive stocks that Warren Buffett and Berkshire Hathaway typically invest in. And they're, of course, getting this big zoom right now because of the switch over from growth stocks to these so-called value stocks. So it's all interesting when you think of it kind of a piece and holistically.
Andy, thank you for that. And if you want to watch at home, be sure to tune in to Berkshire Hathaway annual shareholders meeting hosted by Warren Buffett. That's tomorrow, May 1st, exclusively here on Yahoo Finance. Our coverage starts at 12:30 p.m. Eastern, and Mumu is Yahoo Finance's title sponsor. Now stay tuned because after the jump, we got today's closing bell, the final one of the week and the month.
Got just under 2 minutes to go until the closing bell, and you're looking at losses across the board. The Dow now off over 200 points. We have Brad McMillan, Commonwealth Financial Network's Chief Investment Officer. Also, Michael Sheldon, Chief Investment Officer at RDM Financial Group at Hightower. First, though, let's get over to Jared Blickery. And Jared, what's catching your eye here into the close?
Well, we're seeing a sell-off into the close with the majors and the Russell 2000 at session lows. Just want to highlight a couple of charts here. You can see Dow is hanging in the lower end of its range. S&P 500 down 0.75%, hit session lows just a few minutes ago, and the Nasdaq NASDAQ down 0.9%, hitting session lows recently as well. So you open up the NASDAQ 100, look under the hood. Tesla stands out there at the bottom, up nearly 5%. But guess what? Even Amazon in the red now, and that's after it hit a record intraday high after the open, but looks like it's not going to claim that closing high, that record closing high that a lot of people were expecting. Elsewhere in the mega caps, we got Apple, Alphabet, and Facebook, each down more than 1%. A lot of red here in the boat. It looks like a lot of risk being taken out of the market right now. Looking at the sectors for today, kind of a defensive setup. We got utilities, real estate, discretionary, and staples in the green, but discretionary was really about Amazon, wasn't it? Or so we thought. Energy is the biggest laggard to the downside. That's off more than 2%, followed by tech, communication services, and materials. And just a quick look at that energy sector before you hit the final trading bell of the week and the month. Guess what? After reporting earnings today, Exxon and Chevron each down more than 3%.
That does it for the trading day, the trading week, and the trading month here. As we wrap things up, let's take a look at where things closed. The Dow off 181 points, so off its lows of the day, although not by much. S&P off just around 0.7%. The NASDAQ here, the NASDAQ, the big loser today, off just around 0.8%. Jared was just noting some of the pressure that we're seeing in big tech stocks today. Well, we want to bring in Brad McMillan and Michael Sheldon to help us better understand what is going on and also what we could expect going forward. So, Brad, just taking a look at the losses today, some of that selling action into the close. Yet we got very strong earnings reports. We got that pretty strong econ data out this morning, consumer spending, and also the household income number. Why are we seeing this pullback then in the broader markets?
What we've seen over the past couple of weeks is we've seen one worry after another just start to disappear. The Fed said, no, we're still on board. The economy is still expanding and expanding more rapidly. And I think it's natural at the end of a very successful run to say, okay, there's a lot of good news out there. Maybe we want to take a step back. And I think that's what we're seeing. This is a natural reaction to the success and nothing worse.
Well, Michael, I want to ask you then about the picture going forward. We got economic reports really heating up as we've been talking about. Is it a little bit too much, too fast? And what's your outlook for inflation and how that ties in?
Well, I would agree. I think this is just sort of a breather for the markets. We've come a long way over the past year or so. I think if you look at things like credit spreads, if you look at the performance of copper prices, consumer discretionary stocks versus consumer staple stocks, those remain all pretty healthy right now. So I think what we're seeing is a little bit of a pause, a breather maybe in the markets. We remain constructive looking ahead. Markets probably won't advance as quickly as they have over the past year or so. In terms of your question on inflation, for now, we're in the Powell camp where we see there's definitely going to be a rise in inflation, and we're already seeing that, whether you look at copper prices, lumber prices, et cetera. But we think it'll likely be transitory, which is the word of the year, and will likely start to fade as we get into next year and some of the bottlenecks start to unwind and capacity comes back on stream.
Certainly is turning into the word of the year, transitory. Brad, from your perspective, we heard from the Fed earlier this week. No changes in rates, no changes in Fed policy, yet we continue to get these stronger than expected economic reports. Any risk that the Fed looks like it's a little bit too behind the eight ball at this point, just in terms of what it should be doing with an economy that's recovering so quickly?
Well, I think when you look at what's actually going on right now, Shauna, we're seeing rates go back up to where they were in, say, 2019 before the pandemic. We're seeing inflation doing the same thing. And even though we'll likely see a short-term bump, that's more related to capacity constraints than anything else. And those will be worked out over the next couple of months. So this whole sense that everything is starting to go crazy, I don't see it yet. We're starting to go normal. And normal doesn't require the Fed to do anything. And I think that's exactly what they're seeing. Could it happen? Absolutely. Do we see signs of that yet? No, we don't.
Well, Michael, I want to get your take on what investment opportunities you're seeing right now, any particular sectors or markets around the world, emerging markets. What jumps out at you right now?
Sure. I think over the past several years, the story was really the markets were led by technology. And what we're seeing right now is a more broad-based advance in the markets. It's not just technology, it's other parts of the market that are likely to benefit from an economic recovery. So that's point number one. I think you want to be a little more balanced looking at U.S. sectors than you have been over the past several years. And the second point is that for the first time in several years, it looks like we're starting to see a little better performance in foreign markets. So many investors have been heavily overweight the US the past several years, and that was the appropriate course to take. But I think as you look ahead, Europe is a little bit behind the US in terms of the vaccine rollout and the recovery, but we should start to see better economic data. We already are starting to see that, and that should probably lead to somewhat better performance overseas. So investors should start to add a little exposure to foreign markets if they don't have some already.
Michael, what about emerging markets? Is that still a little bit too risky given the COVID outbreak at this point in some of those areas?
No, I would say that emerging markets are included in that developed market bucket. If you look at just sort of stepping back, if you look at the world's population, the number of companies around the world, the majority of those reside outside the U.S. Plus, valuation levels are more attractive overseas than they are here in the U.S. So you do want to have some exposure. Over time, emerging markets should grow a little bit faster, but they do come with higher volatility. So you want to have a little bit of a mix between the two.
Well, Brad, I want to get your thoughts on President Biden's tax proposal and any repercussions that could have for the market, because we're seeing a pretty divided camp here, as we expect. That's what always happens. But how do you land on this?
I think when you look at the tax proposal in isolation, and I don't think that's the right way to look at it, but if you look at that, we could see earnings get knocked by maybe 5 to 10%. Okay, so maybe we lose some of the gains over the next year. But we can't look at it in isolation. You have to consider that with the spending plan. And that could generate more growth. That could substantially bump profits. I think as a whole, it actually could end up being net positive.
Michael, what do you think? Do you agree?
A couple of points on that. One is that I think ultimately some of Biden's plans will be scaled back. So rather than having a corporate tax rate of 28% and maybe 25%, instead of having an individual capital gains rate at say 39 or 40%, maybe it's 28 or 30%. It seems likely, it just doesn't seem like all the Democrats are on board, and certainly the Republicans are not. And the other thing I would just say is right now, the economy is growing. We don't see a recession. We continue to see a positive backdrop, but looking down the road, maybe 2 or 3 years or so, a lot of this debt will need to be repaid. So that's something we'll start to think about, but that's in the future.
And Michael, I just want to follow up on something that's really capturing the attention of America, and that's the chip shortage, not only affecting automakers, but makers of everyday appliances. We even have chips in light bulbs now. How are you seeing this demand problem or supply problem playing out in the market?
You're absolutely right. This chip shortage is showing up, for example, in automobiles, and we're hearing about it in consumer product companies. I think it's just going to sort of take some time to work through the system. You heard about the freight ship that was caught outside of Egypt. So there have been a number of problems in the supply chain. And I think as the global economy gets back on its feet, that will sort of work its way out. But it is leading to some problems for individual companies, at least over the next several months.
Well, thank you. Brad McMillan, Commonwealth Financial Network CIO, and also Michael Sheldon, CIO at RDM Financial Group at Hightower. Well, guess what? It's Friday, so it's time to talk Bidenomics. And for that, we're going to bring in Yahoo Finance's Rick Newman. Rick, a lot of data this week. Hey there. Data points, economic data points surprising to the upside. We got a potential travel ban with India on the horizon. What's capturing your attention this week?
I've been paying attention to all of Biden's plans, of course. We got the final big third piece with the American Family Plan. I've put all of this into a spreadsheet. I've got at least 70 line items for different items Biden wants to do. This is actually a ton of spending, and I think the prior guest was right. I don't think Congress is going to pass exactly what Biden's asking for. He might get 1/2 to 2/3 of that. But even if he gets that, if you measure the amount of spending as a percentage of GDP, it will be substantially larger than the New Deal that FDR enacted in the 1930s during the Great Depression. So do we need all this spending? I mean, this is going to be a big debate. It is already, and this is what Congress is going to be talking about. In a technical sense, we do not need all this spending, as we've been talking about. The economy is recovering now without any new spending from Congress. It seems like we will have a pretty robust recovery. But on the other hand, Biden is making a pretty good case for why we do need to do some things to address wealth and income inequality, which have simply been worsening almost to unacceptable levels at this point for the last 30 years. Better ways to compete against China. These are the things he talked about in his first speech to Congress on Wednesday. And the thing that I'm noticing most is that the public likes this. These are generally turning out to be popular ideas. I think Biden has smartly structured some of these plans so that he's going to put money directly into people's pockets through the expanded child tax credit, for example. He wants to help working parents with the cost of child care, health care, and other things. So if he gets some of this passed, he's going to have people getting checks on a monthly basis, literally. And I think there's reason for that to be popular. And I'm just not seeing too much opposition to this. Republicans are squawking. It's a government overreach. But so far, I'm looking at polls and other ways of people are reacting. Voters like what Biden is offering.
As it turns out, Rick, I'm sorry, go ahead, Shauna.
No, go ahead, Jared.
No, go ahead.
I'll go ahead.
Right, I'm going to jump in here then. Because Rick, if Americans like it, then we're talking about how this positions Democrats in 2022. What's going to be the response then from the GOP? Is there any way that they could spin this in order to make this not as favorable, I guess, in the general American's public eye of what Biden is doing right now?
The Republicans think they have a pretty good chance to win back at least one House of Congress. I mean, Democrats have extremely narrow margins, but I think the GOP is in a weaker spot than they seem to think themselves. The one risk to the Democrats is that they somehow screw this up and don't pass the right amount of policies or the wrong mix of policies. So it could, if they would end up passing a lot of wonky stuff that ordinary people don't notice, then I think maybe they kind of blew it. But I also think Democrats are not that dumb. And I think Biden actually is turning out to be pretty shrewd. So what's the Republican counter argument going to be in 22? Is it going to be, hey, if you're getting if you got a new child care tax credit, we want to take that away? That's government overreach. If Biden is able to enact some kind of universal preschool, we want to take that away. That's government overreach. I'm very interested to see how this plays out because, Biden got dinged when he was running for being old and stale and out of it, and he was a forever veteran of the Beltway. However, I think he learned a few things about politics during those 36 years in the Senate because he's looking pretty shrewd.
Yeah, and as it turns out, people like free money. Who would have thought? Although not always free. Rick Newman, thank you for joining us.
There you go.
Coming up after the break, we're going to talk about saving for a rainy day. It is our retirement segment, and we're featuring Ken Morey, Senior Retirement Planner at Retirement Planners of America. Stay tuned.
Time for a retirement segment brought to you by Fidelity Investments. And for that, we want to bring in our next guest. We have Ken Murray, Senior Retirement Planner at Retirement Planners of America. And Ken, great to have you back here on Yahoo Finance. Let's talk about where things stand right now in the economy, because we had the unemployment rate falling to just around 6%, yet millions of Americans remain out of work. And I'm sure there are a number of people who are watching us right now who are over the age of, say, 40 or 50 and are unemployed, but are still trying to figure out the best way to save for retirement. What would your advice to those people be?
Well, the first thing is don't panic. Unfortunately, there is still age discrimination in our country. You know, in 2008, during the credit crisis, the first people that lost their jobs were people over 50. And a year later, after the recovery had started, only 50% of those people had gotten their jobs back. And in this pandemic last year, the first people, once again, that lost their jobs were the people who were over 50, and a lot of them still haven't. So the first thing you have to do is be realistic about what your chances are of reemployment, because a lot of the people that did get their jobs back in the credit crisis, they did not get back at the same pay that they had or the same full-time job that they had. So, I hate to be the bringer of doom and gloom, but you got to plan realistically for what the future holds for you.
Well, hopefully it's less gloom and doom for many. I want to talk to you about Social Security, and specifically, I've heard people give conflicting advice over the years. Most of the people I talk to say take it as late as possible to then give a mathematical presentation. You're leaving this much money on the table if you're using it, if you're taking it sooner, but there have to be exceptions. What do you guide your clients towards?
Yeah, the number one rule is if you need the money, you got to take it. So with Social Security, the earliest that you can start taking it is at age 62 under normal circumstances. And so if you need the money and your income is lower than where it was, or your prospects are not where they used to be, then take Social Security early. Take it at 62. There is a kind of a neat thing you can do with Social Security, and that is that you can take it at 62. Actually, you can take it at any time. And you have essentially 1 year where you can change your mind. So you can start taking it. It's essentially an interest and tax-free loan. So you can take the money, and as long as you pay it all back, which is not easy for everybody, but if you find that you're gainfully employed again, you can pay it back, and then you can put Social Security back on the back burner and take it when you're 66 or 70. But again, if you need the money, you got to play the cards you're dealt. And so if that's a situation, taking it early might be the best thing for you.
Ken, how should you be thinking about your investment strategy? You probably want to take some of that risk off the table. So what should you be favoring?
Yeah, most people are thinking they're long-term investors, but in terms of, I've got 30 years to live or whatever it may be, if you're 60 years old, our view is that how you define whether you're a long-term or a short-term investor is based on how soon you're going to need your money. So if you're 30 years old and you're going to retire in 30 years, then you're a long-term investor. But if you're within 5 years of retirement or you're already retired, then you're a shorter-term investor. And certainly if you've lost your job in the pandemic, now you may need your money today. So you're a very short-term investor. So the amount of risk that is appropriate for you is depending on what that time horizon, that risk horizon is for you. If you need your money now because you've lost your job or your income is lower, then you need to think about how aggressive you should be with your investments. My recommendation would be that you start becoming a more conservative to preserve what you have and get income. And then hopefully if you do get a job or your income goes back up again, then you can go back to being more aggressive, if you will, because you've got a longer term horizon. So you don't want your money to be at risk in a downturn if you're living on it. That's not a good idea.
Yeah, another factor people have to consider is the cost of health care. Now, a lot of furloughed employees got extensions. There were federal laws basically passed in the heat of the moment that mandated this. But even if you're on COBRA, that eventually expires at some point. It's going to roll off. And how does this factor into people's planning?
Yeah, that's healthcare is really a big deal. And, it can be very expensive if things don't turn out well. So, we always recommend that people have 1 year of their cost of living as an emergency fund, and the reason for it is something like that. So you could live on your money or use it for your health care for a year if you needed to, without having to dip into your investments or have to sell things at the wrong time or that kind of thing. So having an emergency fund is very, very important in our view. Now, if you don't have that, COBRA certainly is your option. There are short-term healthcare plans that you can buy that are just for a little short time period. And because the insurance company feels like they're only going to insure you for a short period, they don't have a large risk, those things can be more affordable than full-blown healthcare policies that you might normally think of. And so with clients who are in that situation, we look at finding them that kind of insurance as well.
Ken Moraif, always great to speak with you of Retirement Planners of America. Thanks so much for taking the time to join us today. We are going to take a quick break, but when we come back, it's time for our Small Business Spotlight. The founder and CEO of Byte joins us right after the break.
Welcome back to Yahoo Finance. It is time now for our Small Biz Spotlight. That we have Lindsay McCormick, Byte founder. Now, this is an oral beauty brand, and thank you for joining us. You just appeared on Shark Tank. You turned down Mark Cuban. Everything blew up, and we'll get to your products in a second, but just give the backstory on this.
Yeah, absolutely. So I started Byte in my living room in 2018, and we ended up having a video go just totally viral, and that really launched the company. Before that, I was working as a surf instructor, actually right out here, and I was seeing the plastic pollution and the, washing up on the beaches, washing up on my board, and I wanted to do something about it. So I started Byte. They're toothpaste tablets that come in glass jars with compostable refill pouches, aimed at getting rid of the 1 billion plastic toothpaste tubes that end up in our landfills and our oceans.
Well, I want to talk to you about your teeth whitening system. It's plastic free. I've used these products a few times over the years. It's been onerous. I really don't like doing it. How is your product different?
Yeah, so something that was super important to us is that we wanted to make a product that was better for the planet and better for our bodies, but didn't feel like you were compromising anything. So it had to taste really good, had to be effective, had to be beautiful on your vanity, because you can make the most sustainable product in the world, but if people don't get excited about it, if they don't want to purchase it, it's not going to do a lot of good.
Well, I want to ask how you've done with sales over the pandemic because it changed a lot of businesses. I'm thinking probably not yours as much as others because it's not like you have a brick and mortar presence, but how have you seen sales and your customer trajectories change over time?
You know, for us, we've been incredibly fortunate with the circumstances because we are an online business and we are a small business and made here in the U.S. So, you know, with the new interest of products that are made in the U.S., things that are better for our bodies and kind of understanding the connection between, you know, our actions and the planet, we've been opened up to a whole new customer base just because more people are buying online than ever before, and more people are thinking about what they're putting in their bodies and what their products are doing to the planet than ever before as well.
Well, and I wonder if you have any partnerships with, I was just mentioning brick and mortar stores, but them, how are you marketing your product and getting it into new areas and new international markets if you're even trying to go there?
Yeah, so for us, we're just available in the US and we're available through our website. We are primarily a subscription business. So your first order comes in a glass jar and then compostable refill pouches after that. And it's just really important for us to have that direct dialogue with our customer. It's able, like one of the products that we just came out with, which was the first and only plastic-free whitening system, was a direct response from our customer. And the way that we're able to learn about these things is just having that relationship. So we've kept it really, close to us for now.
Toothpaste for the 21st century. I like that. Well, let me ask you about your background then. You bootstrapped this business with, I think it was $6,000 in savings. What's it like to build a business off the ground like this, and especially coming off of that whole Shark Tank viral episode?
It's been, I feel so lucky and fortunate to be able to bootstrap the way that we have been because it means that we can continue to make, putting the planet and people first and not have to worry about reporting to investors or anything like that. So we've been able to stay very, very true to our mission. And it's been a wild ride. So yeah, it started with, $6,000 in savings in my living room. And since then, we have now 2 warehouses, number of manufacturers, and we've just grown to the point where it feels it's a business now. So it's very humbling and exciting to start from something so small and so big. And something that's now, bigger in the sustainable world. And I think that it's a testament to the amount of people who are looking for more sustainable products and looking for companies that are truly walking the walk with those kind of products.
Lindsay McCormick, Byte founder and CEO, thank you for joining us. And guess what? We're going to take a quick check of the markets here as they settle. The Dow down about 185 points to close the day. S&P 500 off 0.7%. NASDAQ a little bit more, about 85 basis points. Not shown. The Russell 2000 off 1.25%. Well, coming up, we have the final episode of our 4-part series as we mark President Biden's 100th day in the White House. We'll hear from former Education Secretary Margaret Spellings, Maryland Senator Ben Cardin, Admiral James, and more. That's after this short break.
This is a Yahoo Finance special, the Biden presidency, the first 100 days. The new White House moving quickly to reverse Trump policies, Biden signing a slew of executive orders and pushing ambitious plans in Congress. We'll examine the key issues from climate change to taxes. The challenges for the new administration and the country are as urgent as they are great. The top priorities, COVID, jobs, and the economy. Biden and Harris also under pressure to deliver on a long list of election promises, including healthcare, education, immigration, foreign policy, climate change, and police reform. An effective majority in Congress may speed the plow, but the way forward isn't certain. Join us now for this Yahoo Finance special, the Biden presidency, the first 100 days.
Welcome to Yahoo Finance's special presentation of the Biden presidency, the first 100 days. I'm Shauna Smith.
And I'm Julie Hyman. President Biden has now completed 100 days in office, and he has been busy presenting an ambitious, sweeping agenda touching everything from infrastructure and climate change to the U.S. relationship with China. But before we begin, Jessica Smith takes a look back at the major events since Inauguration Day on January 20th.
The first 100 days of Joe Biden's presidency revolved around COVID-19. He set a goal of 100 million shots in 100 days, and the U.S. doubled that target, reaching more than 200 million shots before his 100th day in office.
This is an American achievement, a powerful demonstration of unity and resolve.
During his first few months, he also ended the travel ban on several Muslim countries, stopped construction of the border wall, and halted the Keystone Pipeline. He rejoined the Paris Climate Accord and convened world leaders for a global climate summit.
This is the decade we must make decisions that will avoid the worst consequences of the climate crisis.
But his biggest accomplishment in his first 100 days was the American Rescue Plan, a $1.9 trillion relief package that sent money to American families, small businesses, and state and local governments. The president made good on his promise of relief, but the plan did not get a single Republican vote, and the provision to raise the minimum wage to $15 an hour didn't survive.
Many millions of workers are earning starvation wages, and I underline that, starvation wages in this country.
Now the president is looking at his long-term economic recovery plan. The first proposal, the roughly $2 trillion American Jobs Plan, is focused on infrastructure and clean energy. It calls for a corporate tax hike, which Republicans have already shot down.
And my view is we should do it without damaging the tax reform that gave us the best economy of my lifetime.
Biden's second proposal, the American Families Plan, is focused on human infrastructure like childcare, education, and healthcare, paid for by raising taxes on the wealthy.
I will not impose any tax increase on people making less than $400,000. But it's time for corporate America and the wealthiest 1% of Americans to just begin to pay their fair share.
The president also wants to double the capital gains tax rate for less than half of 1% of Americans, an idea Republicans and business groups say they'll fight.
I am prepared to compromise.
The president has met with Republicans in the White House, saying he wants his infrastructure bill to have bipartisan support, but so far there's little sign of common ground. With slim majorities in the House and Senate, Biden has to balance the progressive wing of his party with the moderates, like Senator Joe Manchin. But progressives say Biden needs to be aggressive.
Well, we need to pass a $15 minimum wage. I led an effort to overturn the parliamentarian and get a $15 wage, and we need to figure out how do we do that. We need to make sure we end fossil fuel subsidies.
While Republicans are urging Biden to compromise.
I'd like to see more actions that meet the rhetoric of unity, of cooperation, of bipartisanship.
Biden insists he's willing to negotiate.
I'd like to meet with those who have ideas that are different, they think are better. I welcome those ideas.
But to get his priorities across the finish line, Democrats may once again act on their own. In Washington, I'm Jessica Smith.
For more on this, we want to bring in Congressman Tom Malinowski of New Jersey. And Congressman, thanks so much for joining us here. Let's just start with what President Biden has done in his first 100 days. Jess Smith just laid that out for us. Of course, he tackled COVID-19. He had that $1.9 trillion COVID package. He's laid out plans for infrastructure, for education. He's also talked about his plans for foreign policy. I'm curious just to get your take on the initiatives and the actions that President Biden has taken over his first 100 days.
I think it's been incredibly refreshing. There's been a focus on solving problems and taking action, less on creating drama and tweeting and social media craziness. I think most of my constituents profoundly appreciate that. We appreciate the American Rescue Plan, which is keeping individual families and small businesses alive in New Jersey and across the country, which has lowered the cost of health care by hundreds of dollars a month for a lot of my middle class constituents, that is allowing the small towns in my district that I represent to be able to provide services to their people without raising property taxes. It's a pretty big set of achievements. It's one bill, the American Rescue Plan. If we had split that up into 12 bills and passed all of them, I think people would be saying already that this has been one of the most productive legislative sessions in modern American history. And of course, we're now hard at work looking at the jobs and infrastructure plan that's going to, I think, propel America to a much more productive and competitive economy. So I'm very pleased.
And Congressman, to follow up on the infrastructure piece, because that's the next big initiative that the president is going to be embarking upon, it seems like this one is going to be more of an uphill battle. For you, as you talk to constituents, what do you think is the sort of most important measure or piece of infrastructure that they want prioritized?
Well, that's easy to answer for New Jersey. We need the Gateway Tunnel. It's a massive infrastructure project that connects New Jersey and New York, allows our railways to continue to carry commuters to their jobs and our economy to keep moving forward. And that's a symbol of what the country needs, because across America, we have years, in some cases decades, of overdue investments in basic infrastructure, from roads to bridges to tunnels to railroads to airports to ports to broadband connections to the electric wires that bring electricity to our homes, to the pipes that bring water to our homes, clean water, we hope. All of that needs to be done, and we have this opportunity now coming out of the COVID crisis with interest rates at record lows to make these investments. This is not a partisan issue in New Jersey. It has become, like everything else, a partisan issue in the Congress, but I think we're going to overcome that and deliver what the overwhelming majority of Americans want.
Congressman, something else that perhaps has bipartisan support is the U.S. posture toward China. And I want to talk to you about that. But before I do, I want to play a little bit of what the president had to say about China in his address.
The investments I proposed tonight also advance the foreign policy, in my view, that benefits the middle class. That means making sure every nation plays by the same rules in the global economy, including China. In my discussion with President Xi, I told him, we welcome the competition. We're not looking for conflict. But I made absolutely clear that we will defend America's interest across the board.
And Congressman, I know you have been vocal on China as well. I want to ask you specifically, though, on China policy. Are tariffs on China going to be permanent? Should they be permanent?
So let's take a step back. I think we are in a contest with the Chinese government, with the Chinese Communist Party, about the most fundamental questions facing the world, about human rights, about whether big countries should be able to bully small countries without consequence, about the rules of trade, about whether we have an obligation to be good stewards of the planet, about the rule of law, things that matter to every single person in the world. And the tariffs are one tool in that fight, but the important thing is that the United States, with our allies, contest those questions and that we win. But you know the most important thing that we have done for our China policy in the last 3 months, in my opinion? The most important thing we have done is to make America first in the world in fighting COVID. We were last in the world in the last administration. It was an embarrassment to us. It made it impossible for us to say that the United States of America, our democracy, was the model that the world should follow. The next most important thing we should do in this contest with China is to invest in infrastructure in the United States so that when people come to our airports, when people drive our highways, when people visit our cities, when they see how Americans live every single day, again, they look to America and our democracy as the model. Let's open up our country to refugees once again, so we're that shining city on a hill that people want to come to, including people from Hong Kong. Let's rebuild our alliances with democratic countries like NATO, our European allies, South Korea, Japan, Australia, instead of treating them like dirt like we did in the last administration. Those are the things that are important. As for tariffs, I don't think unilateral tariffs on China work. I think the important thing there is that we act in concert with our allies. That's what makes us strong. And I believe this administration will do that.
Congressman, then, of course, is the enforcement part of this. So the U.S. still calling for China to do more to protect intellectual property. But what's the best way to go about that? How do we make sure China stops stealing our secrets and we become a leader on this?
The most important thing, as I said, is that we've got to be in this with our European and Asian allies. The thing that frightens the Chinese government the most is when the United States works together with others. Their strategy is to isolate us from France and Germany and the United Kingdom and Australia and Japan and South Korea. And the last administration basically did their work for them. Yes, they imposed tariffs on China. Yes, they were tough on China, but they launched trade wars against Canada and Mexico and the European Union and Australia and all these countries at the same time. You can't do that. We have to be focused exclusively, I think, in being tough on trade. We've got to be focused on China, work things out with the Europeans and our other allies, and make common cause on this issue of intellectual property rights. At that point, I think tariffs, particularly if they're multilateral, can be effective.
Congressman, thanks for your time this afternoon. We appreciate it. Representative Tom Malinowski, a Democrat of New Jersey. We're going to take a quick break. When we come back, the latest in the negotiations for that multi-trillion-dollar infrastructure bill. We'll hear from Senator Ben Cardin of Maryland next. Welcome back to Yahoo Finance's special coverage of the Biden presidency, the first 100 days. Senator Ben Cardin represents my home state of Maryland. He's also a key player in trying to get through the president's $2 trillion infrastructure bill. I spoke with him earlier today about the gulf that tends to happen between plans in Washington and reality. He talked about the prospects for infrastructure.
We hope that we can make significant progress on roads, bridges. We hope also transit systems and rail, that we'll be able to see some bipartisan work. I know that in regards to broadband, there are groups working to try to get a broadband proposal that could enjoy bipartisan support. So there is significant progress right now being done to try to see whether we can't get a bipartisan agreement to move forward on parts of President Biden's Build American jobs plan that includes the infrastructure package. So there's progress. Obviously, there are differences. The president wants us to act. I want to act. I think we should act as boldly as we possibly can. And I think we need to act promptly.
So when you talk about it, sort of different pieces of it, and there being bipartisan support for different pieces, what are the pieces that you think are going to need to go to reconciliation? I know that that is a possibility that you have talked about. What are going to be the trickiest parts of this that might have to go that route?
That's always an option that we can use. I think at this point, that's really up more to the Republicans and the Democrats. We hope that we could put together as much as possible, if not the entire package, using regular procedures. The advantage of that is that you can deal with policy changes that you cannot necessarily deal with in reconciliation. So we want to get as much done as we possibly can through the normal procedures on the floor of the United States Senate, but that requires the cooperation of the Republicans. And we saw on the American Rescue Plan, we weren't able to do that. So there will be a schedule. We're going to have to meet that schedule. We'll get as far as we possibly can. But to the extent that we can't get the bills to the floor under regular order because of the Republicans not letting us do that, then we will have to look at fallback process such as reconciliation.
What do you think is the most urgent matter within that bill at this point to get through?
They're all urgent. I mean, we have to modernize our transportation. Our current surface transportation authorization ends at the end of September. We need the predictability of a multi-year transportation reauthorization. It's got to be robust enough to deal with the current backlog we have in roads and bridges and transit systems, and rail and ports. But it also has to be visionary to deal with the challenges we have with adaptation and resiliency and social justice issues. So we have a lot we have to get done, certainly in transportation, and that is very, very urgent. But broadband is absolutely urgent. There's bipartisan agreement that every home in America should have access to high-speed, affordable internet service. It's critically important for their children and education. It's critically important for families on healthcare today, with more and more being done through telehealth, and just connection. You need to be connected, and the internet's part of that connection. So that's urgent. So it's hard to isolate one part of the package and say we can put that on hold. Our children are still exposed to lead. We got to get lead out pipes. That's critically important.
Yeah, fair points. Of course, part of the sort of area of conflict around the bill and bills has to do with how they're going to be paid for. And I'm wondering what your openness is to user fees, tolls, gas tax, and the like in order to pay for some of this.
Well, I'll be clear. I have certain areas that I would prefer to use over other areas. I have not announced that because I really do want to give all of our members a chance to talk among ourselves and see whether we can listen to each other and come up with consensus revenue sources. Clearly, user fees to support transportation has traditionally enjoyed bipartisan support, and I will support user fees that are reasonable in order to finance transportation. So I'm open. There's some new ideas on user fees. Let's talk about that. There's also ones that are more sensitive towards a cleaner environment. I'm certainly very interested in using revenue sources that support our climate agenda.
I want to move on to the American Families Plan, which, of course, is another huge, ambitious plan that is on the president's agenda. And you came out with a statement about the plan. You talked about how it will help women in the workforce. what happens if that part of the plan or the plan itself overall doesn't get through? What are the consequences for women as we come out of the pandemic?
Well, you're absolutely right. I mean, we clearly have a challenge with women in the workforce. We saw that during the pandemic. We knew about it before the pandemic. We still do not have equal pay for equal work in America. We have the issues of the affordability of daycare for principally women being able to participate in the workforce. We have so many challenges. We have the need for taking leave to deal with an urgent situation in the family. It affects both men and women, but women are affected more often than men on the need for paid leave. All those are critically important to make up for the historic challenges that women have had in the workforce. I see that firsthand in entrepreneurship. That's one of the areas that I'm responsible as chairman of the Small Business Committee in the Senate. And we are looking at ways that we can provide more defined tools available for entrepreneurship for women, because these challenges that they have affected their ability to start businesses. So yes, we recognize that we have a challenge. The American Family Plan deals with those challenges, and it's hard to say what's more important than something else. We got to rebuild our infrastructure. We got to make American families have the tools they need. We have to provide the job training so people can fill the jobs that we want to create under the American Jobs Plan. All of it becomes critically important.
And of course, a plan that is sort of winding down now is the Paycheck Protection Program. The small businesses got an extension. Now they have till the end of May in order to apply for that. Is that enough time? Do we need to see another extension of the PPP? Or as we start to see economic numbers improving, has that program sort of served its purpose and now it's time to sunset it?
Well, I think we have to recognize how important PPP program was. 10 million small businesses participated in these forgivable loans. Over $750 billion in help went to American small businesses through the Paycheck Protection Program alone. And that didn't include the Economic Injury Disaster Loan Program and Advance Program or Loan Forgiveness Program. So altogether, we've made close to $1 trillion available to small businesses. We're now interested in really fine-tuning those programs, not a broad program, but only dealing with those businesses that have extraordinary needs. They're in underserved communities, underbanked communities, the smaller the small businesses. In certain category industries, such as restaurants or shuttered venues, we have programs that are opening as we speak to help the shuttered venues. The restaurant program will be opening shortly. We need to monitor those programs to see whether additional help is needed. But we do think there's going to be additional help needed for small businesses, but not the broad plans such as the PPP, more finely tuned to those small businesses that need the help.
Senator Ben Cardin there of Maryland talking about the plan of which he was an architect, the PPP program. I want to circle back, though, to infrastructure and bring in our Rick Newman for more on this, because Rick, you've really been digging into, in a detailed way, all of the plans that President Biden has laid out. I want to pick up on one of the things that Cardin just talked about, and that is the idea of some sort of user fees, in other words, tolls, gas taxes, other types of use fees to pay for some of this, which, as you wrote recently, is pretty much a non-starter because of the limits that Biden has put upon himself.
And it's really unfortunate because Senator Cardin is right. This really is the best way to fund big programs that people who use the infrastructure should pay for the infrastructure. So he referred to the gasoline tax, the federal gas tax, which is 18.4 cents for every gallon. And he said there has been strong bipartisan support for the gas tax. Well, there's also been strong bipartisan neglect of the gas tax because Congress has not raised it since 1993. So in the meanwhile, inflation has eroded the buying power of the gas tax. Cars are more efficient, so that we collect less gas tax. And now we have electric cars, which don't even run on gas. So people who use electrics, they don't pay any gas tax whatsoever. That tax no longer pays for all the things it's supposed to pay for. Instead, the Treasury just borrows up to make the difference every year. A further complication is Biden's pledge not to raise taxes on any households earning below $400,000. Well, guess what? A user fee pretty clearly is a tax, and even if it's not, Biden's political opposition, without a doubt, would call it a tax if Biden were to impose a user fee on people for using whatever, the roads or some new element of infrastructure. So I just don't think Biden can do it. I mean, I guess he could impose a user fee on people who earn more than $400,000, but that's only 2% of the population. So if you exclude 98% of the population from such a fee because it would be a tax and you made a campaign pledge not to do that, you're not going to do it.
And Rick, just digging a little bit more into this infrastructure plan and the shift to renewable energy and electric vehicles, like you just mentioned, one of the things that President Biden has laid out is $400 billion investment in clean energy tax credits and getting rid of the credits there for oil and gas. We don't have the exact way of how this is going to work and how it will play out, but any thoughts just in how you think this will likely be structured?
Sure. Just to remind everybody, so Biden is not presenting legislation. He's presenting broad plans and then obviously working with Congress to turn that into legislation. But Congress has its own ideas. There are various chairs of various committees who want to do it this way, want to do it that way. And Senator Wyden, who chairs the Senate Finance Committee, he's actually introduced an interesting tax proposal. It would repeal about 40 tax breaks related to energy that Congress has passed over the years, and he would replace them with just three tax breaks. So it earns high marks for simplicity, and those tax rate breaks would be a tax break for clean energy generation. So if you generated energy that was considerably cleaner than the average, you would get a tax break for that. That would be money in the pocket of the utility, which could then pass it on to consumers if that's what they chose to do. There would be a second tax break for clean energy. That would be transportation fuel that is cleaner than average, and that would accrue to whoever the refiner is. And then a third one would be for efficient buildings, residential and commercial both, and that would be it. And Wyden says his bill would be technology neutral. It doesn't specify that the clean energy has to come from wind or from solar. It doesn't matter where it comes from. In theory, you could have natural gas utilities that would qualify for that tax credit if they were able to capture some of the pollution. So that's an example of how Congress might be able to do this. So instead of saying we're going to, remember the Obama stimulus, shovel-ready projects, we're going to go find the projects and shovel money at them. The thinking here is that if you create the tax incentive, leave it up to the private sector to figure out how they want to take advantage of that tax incentive. But tax incentives are very powerful. And I think that's a plausible way we could see some of this legislation work.
Now, I know one of the other things that you're looking into when it comes to tax incentives is incentives for electric vehicles. But as you pointed out to us in a discussion earlier, this is pretty new technology still, and the administration is effectively already picking a winner, right? There are other ways of fueling vehicles that are alternative ways to fuel them, renewable ways to fuel them. And so what is the risk here in saying all in on electric?
This is a fun economic argument for economic geeks because you get to the question of, is it better to create an incentive for the private sector to figure out the best way to accomplish the job, or should you pick winners and losers? And so Biden is effectively picking winners, and when you pick winners, you do pick losers because it's whoever the winners are not. He wants $174 billion in incentives for electric vehicle adoption. He wants to build 500,000 electric vehicle charging stations. I mean, we know this is underway. I think we talk about Tesla literally every hour of every day on our shows. So the private sector is already doing this, but Biden wants to speed it up. However, in the industry, some people think that electric vehicles are just going to be a stepping stone to an even better technology, which might be hydrogen-powered cars, which have an electric motor, but it's hydrogen that provides the fuel rather than electricity coming out of a power cord. And if that were to take off and become cost-effective, you would no longer need EV charging stations. You would need hydrogen filling stations, which are similar actually to gasoline stations. So there is a risk if you decide that the future of this one type of technology, and transportation is a huge part of the story here because so many emissions come from the transportation sector. If you incentivize this one type of technology, you could end up getting locked into that technology, and then you're stuck a little bit if a better technology comes along. So again, Congress has not yet written the legislation on this. We'll see how it comes out.
We will. All right, Rick Newman, thanks so much for hopping on with us. Coming up, we will talk the latest on the pandemic and the vaccine rollout. We'll talk with Dr. Patrice Harris, the former president of the American Medical Association, straight ahead. We'll be right back.
Welcome back. We've been examining different aspects and areas that the new administration has attacked in its first 100 days. Of course, healthcare has been a huge part of that story because of the COVID pandemic. Anjali Kamlani is here. She covers healthcare for us. Anjali, President Biden took a lot of credit this week for the coronavirus vaccine rollout. Here's a little bit of what he had to say on Wednesday.
We're already seeing the results. After I promised we'd get 100 million COVID-19 vaccine shots into people's arms in 100 days, we will have provided over 220 million COVID shots in those 100 days. Thanks to all the help of all of you.
So as we sort of assess here how the administration has done, how do we also assess the beginning of the efforts that started in the last administration and how much Biden has picked up and accelerated from the Trump push to develop the vaccines quickly?
Right. So to your point, definitely the Trump administration is credited with at least prioritizing the development for the vaccines, and that includes the research and development funding that went into that. But picking it up from there, once it was authorized, it was significantly a push from the Biden administration, getting both Moderna and Pfizer the help through the Defense Production Act and invoking that and making sure that they were in fact getting the products and materials that they needed in order to start producing and really scale up to what we needed. Of course, we know the storyline of the 200 million doses in 100 days. That also in itself is a long enough story, starting from December when he made that first promise after the election, but before taking office, then moving on to, and that was for 100 million doses in the first 100 days. Then it went to meeting that in March, well before the 100 days on day 58. And then fast forward a couple days later, he came back with that renewed commitment for 200 million doses in the first 100 days, and then also achieving that well ahead of time in day 93, just last week. And so put together really just a really fast-paced scale up. And that was, of course, because of the significant production. We also know that as of today, 300 million doses have been distributed. 100 million adults are now fully vaccinated. And there was also a lot of other sort of strategies that helped contribute to this. We know, of course, about the funding within that American Rescue Plan that helped states pick up their vaccination sites and help reach other communities, and a specific focus on health equity. And that was really key, highlighting some of the needs where some vaccination sites weren't ready yet. And so doing that, as well as the federal mask mandate. Of course, we can't forget how much Biden himself, as well as the CDC now, are really focusing on that and making sure that there are clear guidelines for that. So a lot has been done in these 100 days.
All right, Anjali, stick with us. We want to continue this conversation. For that, we want to bring in Dr. Patrice Harris, former president of the American Medical Association. And Dr. Harris, we just heard Anjali talking about the various progress that the Biden administration has made here over the first 100 days. Just quick, your take on what has been done so far and what you think needs to be done in order to ensure that we continue that progress.
So certainly it is significant that we have fully 30% of adults fully vaccinated, and around 43% of adults have received at least one dose. That is significant. Certainly vaccines and getting vaccines in arms has been critical from the very beginning. The Biden administration has also been focused on equity, and that is also critical. We saw the disproportionate burden on Black and Brown communities. And if we are going to reduce these health inequities that, by the way, existed pre-COVID-19 pandemic, we are going to have to be intentional. The Biden administration has been intentional with the task force on health equity. So we have seen significant progress since the beginning of the Biden administration. And by the way, just yesterday, we saw the announcement regarding menthol cigarettes and banning menthol flavors, by the way. And we also saw the elimination of the burdensome regulatory requirements to prescribe buprenorphine, which is an evidence-based treatment for opioid use disorder. So certainly significant progress on the healthcare front.
I want to go back to the equity piece for a moment, Dr. Harris. It's Julie here. Because the administration has talked about a bit, how have they actually done? If you look at the vaccination rates by ethnicity, what is available, because it's tough to even get that information, the rates are not looking as strong. So how can the administration perhaps better address that issue?
Well, I can tell you it's having that national leadership at the top that's critical. Certainly having a COVID equity task force that is focused on equity in general and making sure there's increased access to vaccines in Black and Brown communities, but also it requires that partnership on the local and the state and really the public-private sector. So I think really being focused and intentional and looking at all of the ways, looking at ways to make sure that vaccines are in the arms of communities that don't have access to broadband or laptops and walk up, and just expanding the eligibility. So I think the first step is being intentional, and a little bit broader than the vaccines. We saw an announcement, I believe it was a couple of weeks ago, regarding racism being a public health issue. Now, again, that's broader than vaccines, but that's certainly an important step. If we really want to make progress on eliminating health inequities, we have to name those upstream drivers of those inequities, and certainly structural racism is one of those upstream drivers.
Dr. Harris, Anjali here. Looking at the broadly what the Biden administration has been able to achieve, especially recently with that mask guidance and updating it. I wonder, through the lens of public versus clinical health, I know that there have been some concerns about how that has shaped the pandemic, and I wonder if you have some insight into sort of which lens we should be now looking at this pandemic through. Do we still need to be broadly focused on larger groups, or can we start narrowing down to individual needs?
Well, I think we should do both, right? I think we don't have to have an either or as we have this discussion. As always, we need to look through the lens of public health for, of course, a public health issue, but we also have to meet individuals where they are and make sure that we are meeting the needs that are tailored, interventions that are tailored to specific communities, what one community needs to drive vaccine access will certainly be different than another. So I think it's not one or the other. It's the public health framework where we have a continuum of viewpoints from looking at prevention down to looking at individual drivers and community drivers. And all of it is very important.
Absolutely. And on that note, still, I know that a lot of credit has been given to the administration, to your point about talking about health equity, but there also are still some concerns about incentivizing, say, small employers, or the idea of vaccine passports and some of these broader either mandates or incentives to really help with the vaccination process, as well as get us out of the pandemic a lot quicker. Do you have any sort of thoughts on that, or things that could have been done?
Well, I think, by the way, whenever we are talking about things such as vaccine passports or any other mitigation measures, it's important to tailor these interventions to communities and states. That's okay to look at these mitigation efforts, and certainly private business will have to look internally to see what they need, again, as we think about reopening businesses. So I think, and I am always frustrated when we politicize anything surrounding public health. We should continue to insist on evidence-based and fact-based and science-based information, and then let that guide us really not only regarding individual treatments, but also public policy. And so I hope and urge everyone to continue to use evidence and science. I know that we have an increased focus on that, and then let that guide both policy recommendations as well as individual treatment alternatives.
Dr. Harris, thanks so much for your perspective. That seems like a good message to leave it on, and one that has been pretty consistent through this administration, we have to say. Thank you so much, and thanks to our Anjali Kamlani as well. Coming up next, we turn to education. We will hear from the former Secretary of Education. We'll be right back.
Welcome back to Yahoo Finance's special, the Biden presidency, the first 100 days. Earlier this week, President Biden laid out plans for the American Families Plan. Now, some of this focused on education. Earlier today, I got a chance to speak with Margaret Spellings, a former Secretary of Education under George W. Bush, and asked her about President Biden's proposal, which includes funding for universal preschool as well as free community college. Let's listen.
Well, it's an eye-popping number, that's for sure, on top of the things that are going to our schools and universities in the infrastructure plan. So it's a lot of money. And one of the things I want to make sure is that we're going to spend those resources wisely and well, however the story ends, however much flows to states and universities and to students. So lots of things to like, but some things to be worried about. And the scale is just, wow.
And Secretary, what are you worried about? Because I think that that's one thing that people are questioning right now, whether or not the Biden administration is doing enough here to combat some of the challenges that the education across the U.S. faces at this point.
Well, I'm a big supporter of increased Pell Grants. I'm thrilled about that. Some of the investments in our HBCUs, community colleges, and the like. We know that most of the jobs will require post-secondary education, and we need to find pathways, as we say in the business, for more people to get those marketable credentials in our comprehensive universities, our community colleges, our HBCUs, most notably. So I'm really excited about that. I do think, free is not something that I would necessarily support. I think it's important for students to have skin in the game, for them to invest in themselves, for us to empower consumers to think about price and value when they are shopping for higher education. So we want them to be aware of what the needs are in the marketplace and the employer community and find pathways through education that align with that.
Well, Secretary, speaking of price and paying here to go to school, one thing that President Biden did not address this week was student debt. Some Democrats are urging President Biden to cancel student debt, and he has said that he is exploring his executive authority to do so. But how do you think the student debt crisis then should be addressed right now?
Well, I think, as I say, we need to empower consumers with better information about how much they spend and what the value of it is in the marketplace. And we need to reward families and students who make really prudent, smart decisions by going to a community college, getting those couple of years under their belt, and then transferring to their private university that's more expensive or their comprehensive university. We want people to think about value and price when they shop for post-secondary education, just like they do in any other purchase they make or investment they make. And so I worry about delinking those things. When everything is free, we take the motivation for the consumer to really be smart and wise in how they think about what are they getting, how much are they paying, and what's the value in the marketplace.
And Secretary, speaking of what's been happening here in the U.S. over the past year, we've heard from a number of health officials recommending that schools reopen, yet we've seen a relatively slow reopening. It has, though, progressed more recently. I believe about 2/3 of schools across the nation are now reopened. What's required, do you think, at this point to help these young learners make up for that time lost while staying home during the pandemic?
More time on task, summer school, more interventions, one-on-one tutoring, all sorts of strategies like that are proliferating around the country using technology very wisely, and so on. But one of the things, and you pointed out, Shauna, is that I'm really worried about is that our most disadvantaged kids who need to be in school the most are the ones that are less likely to be in school. Advantage schools, charter schools, private schools, those students have found their way back to in-person learning. And so the pernicious gaps that we've had in education are growing wider, and we need to triage immediately and have a will to intervene and pull up so that all of our kids can get back on track immediately.
And speaking of that, I guess to what extent do you think COVID has worsened that already unequal system that we've been trying to address here in the U.S.?
It's tragic, and it is absolutely an acute and chronic problem. And our expectations for all of our students need to be to not just let that persist, because if we don't catch up, pull up, intervene now, these students and their families and our communities and states will pay consequences for many decades to come. We know what we do, what to do, and we can do it. We know how to get little young readers caught up and back on track, and we need to do everything we can to make sure that happens as quickly as possible.
Another issue facing the education system right now is a shortfall in the number of teachers. President Biden here did propose $9 billion to train and help prepare these teachers. But from your view and from your experience, how do we address that?
Well, it's a really worrisome trend. I mean, we are seeing career educators just who've pulled their hair out this year, leaving the profession. And so we need to recruit young whippersnappers into our classrooms. We need to make sure they have the tools they need to be successful. But also we're going to need to rethink how we use all of our resources and assets, including and especially our people, our human capital. And so, COVID has taught us that, wow, maybe you need to have the world's best lecturer or teacher who's beamed out through technology and have others working one-on-one in small groups or engaged in tutoring. And so how we think about our business model away from the sage on the stage and into more, innovative strategies to deploy our best people as effectively as possible.
Secretary, are you confident that education is something that can bring Republicans and Democrats together at this time? And I guess, how do we make sure that that happens?
I sure am. In my office, I have the passage of No Child Left Behind. The vote counts 87-10 in the Senate, 385 to 40 some or something like that in the House. So we've done it before. We can do it again. The last reauthorization of the K-12 Act was bipartisan. And so you bet. I think it can happen. And, we all understand the centrality of our schools to the recovery of our families, our economy. And I'm really optimistic that we can and will come together around our young people.
And that was Margaret Spellings, a former Secretary of Education under George W. Bush. And Julie, there's a lot to get into from that interview, but first just talking about what she had to say about higher education. That was the first thing that stuck out to me, because President Biden here pushing for free community college for 2 years, but Secretary Spellings not so much pouring cold water on that, but saying that she doesn't necessarily think that that is the right way to go. And when, in her words, saying that it is important for students to have skin in the game. But of course, we have to remember that so many of these students still years and years and years later do not have the money that they need now to pay back some of these loans that they were forced to take out.
Yeah, I mean, I think maybe if her phrasing in saying these kids that need to have skin in the game maybe sounds a little callous. I think the concept that she's talking about, the return on investment, the lens through which kids need to view their education needs to be radically revisited. This emphasis on expensive Ivy Leagues, that you have to get that particular degree. I really think that, as a culture, we would benefit from taking the emphasis off that and figuring out whether it is worth it for that individual kid to go to that particular school and spend that money if they are indeed going to be deeply in debt for a long time. And hopefully, if that happens, you then get maybe a little bit of a repricing of the whole system.
Yeah, certainly. You also have to remember that these kids are 16, 17, some 18 years old when they're making these types of decisions. So how much do they really know about real world experience and what that debt will be like 10, 20, 30 years down the line when they're making these types of decisions? That's something that also needs to be accounted for as well.
Yeah, they definitely should be using those debt calculators that are available. All right, coming up, we're going to wrap up with the Yahoo News editor-in-chief on what he's watching for the next 100 days. We'll be back in 2 minutes. Welcome back. Joining us now, Yahoo News editor-in-chief Dan Kleidman. And Dan, we've been looking back at the last 100 days, but I want to look forward also to what we can expect. Because, we've heard all these big plans, right? And now it comes maybe the harder work of actually getting more of this done. Do you think we're going to see a contentious next 100 days in Washington?
Yes, I do. I think that, Washington is a contentious place these days. It has been for quite some time. It's still highly polarized. But I will say that Joe Biden and the Democrats still control Congress. And Biden, I think, has shown that he is willing to push through his agenda with just a bare majority, and that he's willing to be aggressive and use tactics like reconciliation, so he doesn't need to get 60 votes in the Senate. And I think he is going to bulldoze through and probably get a lot of this economic agenda passed. The question is not how many Republicans he gets. The question is, can he keep his Democratic caucus together, particularly senators like Joe Manchin from West Virginia and Kirsten Sinema from Arizona, who are more moderate. But I think in the end, he will. And I think he's going to get most of this economic package through. It is a stunning amount of money, as I'm sure you guys have been talking about all day long, $6 trillion in all, twice the GDP of Germany. But it's more than that. It's a kind of rewriting of the social contract. And it is a philosophical shift in this country, making a bet that he can change the perception of the American people of the government. And that is a big deal. It's a big gamble. I think if he succeeds, he will go down in history, maybe not be the next FDR, but I think it'll be pretty significant.
Dan, what do you think of the case that he's made so far for this large spending that he has approved, that's very important here to his administration, at least in the first 100 days? Has he done a good job selling it to voters?
I think he has. In fact, I think he's learned some lessons from both his tenure in the Obama administration and from previous Democratic presidents who I think he thinks didn't sell these kinds of packages well enough. In some ways, the most important thing is that Joe Biden has pushed an agenda that is largely popular with the American people. The COVID Relief Act, especially so, but also the Jobs Plan and the American Family Act are fairly popular. We have a new poll out today that shows that these policies are popular. And the important thing is he is not pushing kind of big government programs that are not popular. So, for example, he is not pushing a single payer healthcare system like Medicare for all, consistent with what he said during the campaign, where a lot of his opponents were pushing for that, and he is not. And so I think that in some ways the policies sell themselves because they are very popular. First of all, putting money in people's pockets, education, all.
That is something we will certainly continue to follow here at Yahoo. Dan Kleidman, Yahoo News editor-in-chief, thanks so much for taking the time to join us today. Well, thanks everyone for joining us as well. And stay right here in the weeks and months to come, because our coverage, obviously, of President Biden's administration will continue right here on Yahoo Finance. But for now, thanks so much for joining us.